buyers coming back. But we did see, even with mortgage rates, above 7% last year, there was this surprising resilient demand for housing in 2023. There was resilient demand for everything, but people couldn't buy homes because, people were not willing to sell. But we've actually in the last, 6 or 7 months seen listings of homes come up. They're above, levels of the last 2 years, and there's not demand now. So it does feel like, that resilient consumer is waning everywhere.
I also think this question of prices that Jonathan Miller also talked about is fascinating. Not just do people come back, but what happens to pricing of homes? Could we be in a scenario that he thinks will happen that kind of ironically the Fed cuts, but instead housing prices go up because demand comes back? Yeah, it's not so clear. I mean, we have seen softer demand in the last 6 months or so, and that has been accompanied with softer prices. We've not seen the very strong, exceptionally strong prices of the last couple years in the last 6 months. So I think in the near term, at least, this is still a soft demand story, and so there's not quite that upward pressure on prices. But longer term, we are somewhat structurally short housing. Obviously, new construction will be pulling back. You're going to stay short housing. Yeah, that could put longer term pressure on prices.
Dana, when it comes to the American consumer, you talk about how they're also trading down in types of services they purchase. What kind of cracks are you seeing in the U.S. consumer?
Sure, absolutely. Well, let's just start with the fundamentals. While most consumers are working, that excess savings from the stimulus is gone. Also, many consumers are financing their expenditures with debt. And so all that's really coming home to roost. And so what consumers are doing is they're not buying goods. We saw that goods spending slowed at the end of last year. It was negative in GDP growth. And also when we look at retail sales so far in the second quarter, they're signaling another downswing in terms of goods spending. When it comes to services, consumers are still interested in going on vacation. However, they are trading down in the types of services. So, for example, instead of going to the movies, which might cost them $100 for a family of 4, they're going to stay home and stream. And also, consumers are looking at spending on services that are necessities. For example, healthcare and insurance premiums for your cars, but certainly not those highly discretionary types of services.
Dana, just to put this all together, what are you looking for to understand whether this is sort of a welcome softening and disinflation versus something that does have more pernicious legs?
Well, this is all part of the Fed's plan, right? This is basic monetary economic theory. You slow demand, which helps reduce inflation. That's what the Fed's doing. The challenge is that the Fed has all these other supply side elements that are leaning against what they want to do. Again, going back to labor shortages, which is a supply issue, raising wages. But this is all part of the program, making sure that consumers pull back on spending. That also includes home purchases. And certainly if you're not buying a house, you're not buying all the items that would go along with it. So this is good. And the thing is that the Fed is probably pleased with what's happening because at the same time, most people are working. You don't have massive layoffs. Indeed, we do think the unemployment rate's going to tick up, but maybe we'll land at 4.2%. That's well below the natural rate of unemployment, and that's still a really low unemployment rate. So if we have this perfect scenario of weaker consumer demand, weaker demand for housing, but also most people working and inflation slowing, that suggests that the Fed can go ahead and start cutting interest rates probably by the end of this year.
Dana Peterson, Veronica Clark, both of you, thank you so much for being with us as we get you set up for the weekend into the week ahead. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Move over NVIDIA. Microsoft is retaking the title of the world's most valuable public company. AI chip maker NVIDIA losing the crown after slumping over 3.5% in yesterday's trading and losing over $100 billion in market value. The stock is down again this morning. And in a filing with the SEC, it was revealed NVIDIA CEO Jensen Huang sold a fraction of his stake in the company for just under $32 million. Shares of CarMax are higher in the pre-market, the company reporting stronger than expected first quarter profit. That overshadowing a revenue drop. Retail unit sales decreased 3.1%, and the average used vehicle price also dropped around 3%. CarMax said vehicle affordability challenges continue to impact sales, with ongoing headwinds expected due to inflation, higher interest rates, and tightening lending standards. And New Jersey Transit says rail service has been suspended again for trains going in and out of New York's Penn Station. The operator saying unspecified issues with overhead wires owned by Amtrak were causing the disruption. This is the third time this week that local commuters have faced delays. Amtrak also says services between New York and Philadelphia will be on a delayed or modified schedule due to a disabled commuter train. That's your Bloomberg Brief. Lisa?
Messy and hot. Yahaira, wonderful as always. Thank you so much for those updates and throughout the morning. Up next, setting you up for the day and week ahead, this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Asia is at the forefront of some of the world's biggest stories. I'm Chevryan in Tokyo.
And I'm Heidi Stradwatts here in Sydney where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Counting you down to the opening bell, here is the trading diary for the week ahead. S&P Global PMI data coming out at 9:45 a.m. and then existing home sales at 10 o'clock, which should be interesting given all the discussion we've had throughout the week on that. Monday, the Fed's Mary Daly and Chris Waller speaking. Tuesday, consumer confidence. Wednesday, new home sales. And Thursday, durable goods, plus another round of jobless claims. So, honestly, to me, when I take a look at what we heard from today, a lot of it was kind of this tipping point, inflection point that people aren't willing to sort of lean into. Danny, what's your final takeaway?
I think that was specifically for the consumer. I mean, we had the retail sales data this week that I think showed some more weakness than some folks were expecting, but also what we're hearing from companies. I mean, Dana Peterson said it there, that instead of going to the movies, people are staying at home and streaming. We heard it in Kroger's earnings yesterday, that budget shoppers are coming to them for the first time in a long time. And restaurants we've also heard from too, saying that they're getting less foot traffic. This idea that it was a PTSD of consumers who were locked up in COVID and they're coming out and they're revenge shopping, and that would last forever because we were so scarred by COVID. I think this week has really laid bare the truth that as soon as you're worried about prices, that goes away.
Well, at McDonald's, for example, coming out with a $5 meal. Starbucks also, actually, a Wall Street Journal story coming out today talking about half price. This coming out, 50% off a drink. It's on. Keep checking the app all summer long for the deals heading your way. That coming after a real weak period in terms of sales, especially given some of the concern people have.
People have concerns about inflation. Shows up in the polls every single day, which is why people aren't going out and spending big on, say, all these lavender lattes and Starbucks having to drop their prices. But that's why I'm interested in the politics going into the weekend, because it feels like it's the final calm of a weekend before the storm. The debate takes place on Thursday, and Terry Haynes said earlier to us this week that this is going to be both candidates trying to frame the next few months before November 5th.
So what are you looking for with the debates?
Well, let's go back to what Greg Valliere said. He said that Trump, what Republicans are saying in private, is that his overconfidence is at too much of a risk. Does he come out too angry, too boisterous potentially? And then for Biden, this is Greg Valliere's point, does he carry the debate with a lot of excitement and energy for the entire 90 minutes? And Greg Valliere said this, his words, not mine: if Biden shows that he's clearly in decline, speculation will begin immediately about replacing him on the ticket. That's a major risk.
And that's something that we haven't heard a lot of. Will that gain some discussion as the week progresses? Coming up on Monday, we've got RBC's Lori Calvasina, KBW's CEO Tom Michaud, BlackRock's Amanda Lynham, and Stephanie Roth from Wolf Research. We're going to be looking at housing prices next week. We're going to be looking at consumer confidence. We're going to be looking at some personal spending data. Right now, you can see the S&P claw back a bit of the losses from earlier, but still down about 0.1% as yields go lower. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is did you take the tumor out? And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and
Effective Fed funds rate 5.33% June the 20th, unchanged from June the 18th.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Futures taking a bit of a breather on this triple witching Friday. The countdown to the open starts right now. Coming up, it's triple witching. Traders brace for volatility as $5.5 trillion worth of options set to expire. Business activity loses momentum in Europe on French election fears. U.S. PMI numbers out later this hour, and expensive markets stay expensive. We'll speak to the biggest bull on the street, Julian Emmanuel, about why he raised his year-end price target. We begin with the big issue, the AI-driven stock rally taking a breather.
I think markets are a bit priced to perfection, if I may say, so all this Goldilocks scenario. But as long as we get the earnings in place where expectations, I think, are quite high, I think that's sustainable. But if there is some disappointment on the earnings, then of course there could be a kind of consolidation in the market.
Joining us now is Young-Yu Ma, BMO Wealth Management Chief Investment Officer. And you write in your notes that May's CPI report, it was a psychology shifting reading. Describe to me what you meant by that.
Yeah, it's great to be here. Thanks. Well, we think that May CPI report, where the headline CPI came in at 0% increase on the month, is really going to get people's attention and has gotten people's attention and gets the idea in mind that we are resuming this downtrend in inflation. And we're seeing that not just in the U.S., we're seeing that globally as well. And we think that's what's helping to prop up the market and support this next leg higher that we think will happen over the summer.
Well, tell me why that matters, because you think about Fed rate cut pricing, for example, it's been all over the place this year. So when you think about inflation to cut pricing to the actual stock market, does this market actually need rate cuts at this juncture?
That's a great question. The market has actually shown us that it does not need rate cuts. The market has done surprisingly and even amazingly well this year in aggregate without any rate cuts happening so far, and with the prospect of rate cuts has been kept getting pushed out further and further. So we think what actually matters most is the trajectory of inflation and that longer-term consideration of where inflation is going to fall, where rates might ultimately fall, whether we get a rate cut in September, December, one rate cut, two rate cuts. We think that matters quite little for the markets, but this downward trajectory of inflation, resuming that path, we think that's what's going to be most important and what the market is going to key off in these summer months.
Well, let's talk a little bit more about the trajectory of inflation and a slew of Fed speak in the last few days. And of course, even more eco data on deck. Mike McKee, Bloomberg Chief Economics and Policy Correspondent, joins me now. And I want to highlight Austin Goolsbee saying that the Fed can cut with more inflation reports like what we saw in May. It really seems like May is the blueprint here.
May is the blueprint, and that's what pretty much everybody has been saying from the Fed this week. We had 10 voting, well, not 10 voting members, but 10 members talking about the economy. A couple others spoke on other topics. And basically what they said was what everybody has been saying, that if we get more reports like we got from CPI and what they're expecting from PCE, then they may be able to start thinking about cutting. There are some trades out there for July, but that seems still rather far-fetched given the Fed speak we saw this week. So maybe September is what to look for when we get the PCE report next Friday and then CPI in the middle of July. Things to keep an eye on. Meanwhile, today, there's not a lot to trade on, but we do get the S&P global PMIs for the United States. And here's what happened in Europe. Almost every single one of them went down. And it wasn't too long ago, just last month, that we had a bad PMI report on manufacturing, and it set the markets lower. So it's something to keep an eye on. That's at 9:45. I'll be back with those numbers for you. And then at the top of the 10 o'clock hour, Katie will be giving you the housing numbers for existing home sales. And that's an interesting number because while the markets have priced the fact that nothing's happening, when you look at what is not happening, it's kind of bad news for the economy overall. This is non-seasonally adjusted and seasonally adjusted sales, existing home sales. And look what happens. This is the time period when we are supposed to see the white line going up, which is the seasonally adjusted sales, because this is the peak of the spring selling season, and it's not happening. And so if that doesn't change, we're still going to get deeper into this housing hole the U.S. has.
Well, Mike, I know I'm talking to you in 40 minutes time, but before I let you go, something I've been thinking about this week after what we saw from the Swiss National Bank, how it was kind of a coin flip going into the decision. And of course, we ended up with a surprise rate cut from the SNB. When it's time for the Fed to cut, I just feel like we'll know that they're going to tell us in pretty certain terms when that's actually coming.
Oh, sure. They will start making it plain. We've got a Fed meeting at the end of July. We have the Fed Chairman Jay Powell testifying in mid-July, and then we've got the Jackson Hole Conference at the end of August. So if they're looking at September, many opportunities for the big guy to give us some hints toward that. And of course, the rest of them will be speaking as well. They don't like to surprise like the Swiss do. So the markets will be volatile, but we'll get advance word from the Fed.
Yeah, plenty of opportunities to set the table for that first rate cut. Mike McKee, we'll see you in just a little bit. Let's get back to Young Yu Ma of BMO Wealth Management. And as you were saying, it's the inflation trajectory that matters more than the rate cutting trajectory. And talk to me about why that is. When you think about the psychology of the C-suite, how does falling inflation actually work its way into the stock market?
Well, in a few ways. One thing is that stocks are long-lived assets and very long duration assets. So if we're actually looking at what's a fair value to pay for stocks and what's reasonable, investors are rationally going to be looking at a longer term trajectory and where the ultimate level of interest rates are going to end up, not so much where they're going to end up at the end of the year. If you talk about the C-suite, I do think that the C-suite just wants to see that trajectory to be comfortable with more spending plans, greater expansion, and to be confident that the soft landing has actually happened. And once that confidence really sets in, we think companies are going to turn more toward growth mode. They've been in cautionary mode for quite some time. And once they turn more toward growth mode, there's going to be an additional jolt of spending in the economy that's going to be helpful for overall growth.
So what do you do until that point? Do you just buy tech, for example, where you have companies spending billions and billions, if not trillions of dollars on things such as AI?
Well, that's certainly where a lot of the money's been flowing, and it's been very much a one-way trade so far. We do think as inflation continues to moderate and the Fed does start to get a rate-cutting campaign by the end of the year, we do expect the market to broaden out. But really just staying invested here, not being shaken out of the market, especially as we start to, in the third quarter, approach the election season, which could inject its own dose of volatility, really just focusing on the underlying fundamentals, which between earnings growth, which look to be accelerating, between stable underlying economics, we think there's a lot of reason to be optimistic here still, despite the run-up that we've had in tech. And we think we're in the relatively early innings of the AI boom. So even though there's been a big rush in the space, we don't think we're near this being played out.
And where do you also see opportunity? I mean, we talk about tech all the time. We could talk for the next hour about tech if we needed to. But outside of just that sector, I mean, where are you looking right now?
Well, there are some other areas that do benefit from the tech spending as well, or the AI spending, which is infrastructure and improvements to the electricity grid. So there are some industrial companies and part of the industrial sector that focuses on infrastructure really benefits from that. We think a lot of companies are actually going to benefit from the productivity gains, which we think will start to be apparent in the data probably next year from implementation of AI. So we expect this to be much more broad-based than we're seeing in the early stages. In the early stages, the number of winners tends to be relatively narrow, but we think this is going to broaden out as we go throughout toward the end of the year and into next year.
Makes a lot of sense, of course, just buy the sectors where big tech is spending money. But let's talk about what you don't like, because I found this curious in your notes. You write that you're cautious on consumer staples, and I found that a bit unintuitive because you think about the state of the economy right now. You have relatively sticky inflation. Prices are much higher than they were just a couple of years ago, and you have a pinched consumer. Wouldn't it make sense that consumer staples would kind of be the play here?
Well, there's a lot going on in consumer staples, but we do see the multiples there as relatively high. The growth is low. And we do have some pinched consumers on the lower end of the socioeconomic spectrum, but a lot of consumers are trading down. A lot of consumers are looking for a deal. I think you saw that in the May retail sales numbers. And if consumers are looking for a deal, that's not necessarily going to flow to the top brand names that are a big part of that consumer staples sector. So we think there is somewhat of a trade down that's happening or likely to continue to happen in consumer staples, and that might pressure the overall area. And without much growth and supporting relatively high multiples, I think investors are going to look to where the growth actually is.
And do you follow that trade down? Is that an investable trend that we're seeing?
In consumer staples, is that the...
Or just when you think about across industries right now, you're seeing it in retail, you're seeing it in restaurants, for example, that trade down. I mean, do you go to those sort of lower rung, maybe discount sort of offerings?
Well, that's a challenge to do as well. That's a tricky trade to play. The trade down play is tricky because you might think that some areas should benefit, but it also turns out sometimes you find that those areas that get a proportion of the trade down play also lose a proportion of consumers because they're just strained at those that lower end of the spectrum. We think that's just a tricky place, and you're probably better off just staying away from that trade down play, both for the companies where the trade down is going away from them and even supposedly toward them. It's just a tricky area to navigate.
Yeah, fair point there, that it's tough to pick the winners in the trade down scenario. But let's talk about what seems like it's been an easy trade over the past couple of years, and that's cash earning 5%. How are you feeling about cash levels right now when you think about overall portfolio allocation?
Well, we like staying invested here. We think the dynamics of the market between having earnings growth, a stable economic backdrop and labor market, inflation falling, corporations starting to spend more money, both on AI and otherwise. We like the idea of staying invested and not trying to hunker down in cash. But for those investors that cash gives some extra comfort to, we do think it is a big benefit, not just to investors, but to the economy overall, that you're getting a pretty good return just from sitting in cash. And it's a return that is well above inflation. So that is actually helping to support spending in the economy. I think there's about $150 billion per quarter that investors are getting just from bank interest paid on bank accounts relative to where we were a couple of years ago. And that just supports spending the economy. So overall, it's okay to hold some cash, especially now when you have the returns on those cash being much higher than inflation.
And as of the latest reading, $6.1 trillion still held in money market funds. Young-Yu Ma, really enjoyed this conversation. Have a great weekend when you get there. That, of course, is Young-Yu Ma of BMO Wealth Management. And joining us now with a look at the stocks moving ahead of the opening bell, let's get to Abigail Doolittle.
Well, Katie, the major indexes here in the pre-market barely moving, but beneath that benign surface, we have some outsized movers, including the shares of Sarepta Therapeutics, up more than 30%, heading to the best day in 5 years. This after one of their therapies for muscular dystrophy was approved for a broader purpose. Some analysts saying it's the best case scenario. Those shares right now up 33%. Again, the best day potentially in 5 years. CarMax also trading higher. They beat earnings for the most recent quarter just slightly. Most analysts saying it was an inline quarter, but with this reaction for the stock, it seems as though there's maybe a bit of relief. And then one reason we have futures down, NVIDIA heading to a potential second down day in a row. Yesterday down more than 3%, maybe a little bit of consolidation of what had been a 180% rally on the year, still pretty close to that. And then, of course, Katie, you were mentioning the fact that it's triple witching, the rebalancing, lots of volume and volatility. That could also be a factor in why there's some repositioning in NVIDIA. That stock right now down in the pre-market.
Down in the pre-market, and certainly that's weighing on futures as well. Abigail, thank you. Now coming up, the SoftBank founder says he has plans to bring about an era of artificial super intelligence. More on those plans next. This is Bloomberg.
Times in Tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Shareholders, don't worry about that SoftBank share price stuff. Jim dreams a big dream. Why don't you support Masayoshi-san, who has a big dream? I was born to realize ASI. AGI stimulates AGI and drive evolution. Less than 10 years, ASI will come.
And that, of course, was the founder of SoftBank speaking at the company's annual general meeting earlier this morning. And for more on Sun's ambitious plan to get into AI, we're joined now by Bloomberg Technology co-host Ed Ludlow. And Ed, it wasn't AI, it was ASI, which is artificial super intelligence. What exactly is that?
Well, by his own definition, it's AI that's 10,000 times more powerful than the human brain.
Oh.
It's an interesting moment in time for SoftBank, right? Because they are riding higher as a conglomerate or as a startup investor than they have done for quite some time, largely because of the performance of their investment in ARM Holdings, ARM being a chip design firm that has itself convinced investors it's going to be a central part of the AI story. And, I think you and I were talking off air about, well, what do we actually learn from SoftBank overnight? And if there's only one substantive thing, it's probably that SoftBank's bet on ARM is the focus of their AI strategy. In other words, they think that all of the chips that ARM will design will be leaders in the fields for data center chips or robotics chips or all the other hardware plays that we're seeing right now in AI. But what I found so interesting overnight is no matter how emotional Masayoshi-san was, he literally said to investors, root for me, I have a big dream. They were more interested in shareholder returns, which is a bit sort of beige, but important in this environment.
Yeah, according to our reporting, Sun at times was visibly overtaken with emotion. And I mean, like you said, he laid out a really grand vision here. He obviously has huge ambitions, but not a lot of details on what the actual plans are here, Ed.
Yeah, I think a lot of investors would look at the share price. The Japan-listed shares are up, I think, around 60% year to date. Their net asset values have climbed back because remember, that many of the bets that SoftBank has made on startups in all fields in recent years have not paid off. And they have recovered largely on the back of their majority holding in ARM. And so you look at the chart on your screen of where the elevated share price is, that is in yen, and lots of investors asked him throughout the AGM about stock split, share buyback, dividend, and he said, just don't worry about it. Don't worry about that. Think about my dream. I'm giving you my dream. But remember, in the background, Elliott, a familiar name to us on this program, has built a more than $2 billion stake in SoftBank. They're returning for a second time as an activist, and they just want buybacks. They want shareholder returns because you look at that chart, and to many, that would be justified.
And that just seems so quaint when you think about really super intelligence and the evolution of humanity. But even still, I mean, talk a little bit more about that pressure, because you think about AI and outside of course, our humanity, I have to imagine there's a lot of opportunity to make money in that space.
Earlier this year in February, some colleagues at Bloomberg News and I reported that SoftBank has this big ambition, or actually Masayoshi Son has this big $100 billion ambition to dominate the semiconductor side of the AI story. That might sound familiar to you because it's something that Sam Altman of OpenAI, we have reported, is also thinking of doing to build up a big war chest. And he was asked about that, Masayoshi Son, during the AGM. He didn't explicitly acknowledge the project's code name and the specifics of it, but basically said he will do whatever it takes to get there. SoftBank's in a position right now where, again, we keep the chart on the screen, the share price gives him some wiggle room to fulfill this vision, but it's just not of interest to shareholders. And again, I call it beige, but think about the euphoria around NVIDIA's stock split and the access to retail investors got as part of that, and some of the other valuations that are driven by AI right now. NVIDIA's trading at 45 times forward earnings. You know, investors are basically saying, well, how long is it going to last? And give us some money back on the table, please, because we've supported you thus far.
I do love that tableau of course, Sun visibly emotional about sort of the promise of AI, and then you have shareholders saying, can we please talk about dividends? But in any case, you mentioned scaling up here, investments, et cetera, and I believe it was yesterday that we were talking about Dell with teasing this AI factory that they're going to build, and it just seems like there's an incredible arms race going on right now, Ed.
Yeah, the way I would think about it is quite clear that NVIDIA makes the GPU, the brain of what goes into a supercomputer that trains AI. And NVIDIA is kind of riding super high, but they have no experience or background in selling their products into the sort of rest of world channel. NVIDIA's stock performance and top line growth has largely been driven by 5 customers, which is the hyperscalers and Meta. Dell, by comparison, is very good at selling its products and services to small and medium enterprises and governments. And so basically, if somebody wants to buy NVIDIA GPUs or AI accelerators, you don't just knock on the door and say, Jensen, can I have some of those? You need an intermediary. And so there is some beneficial read-through that Dell and Supermicro and other server rack assemblers are going to get from that. The problem is that Jensen Huang also realizes this. He wants a bigger piece of the pie, and so NVIDIA is very much thinking about how they can just control the whole ecosystem themselves, become more of a systems vendor rather than just sell the GPU.
All right, Ed, it is always a joy to talk to you. You, of course, can catch Ed Ludlow on BTech at 11 a.m. Eastern. But coming up on this program, the morning calls, and later, Julian Emmanuel, Evercore ISI, the biggest bull on Wall Street with a year-end S&P 500 target of 6,000. But on the topic of AI, here's Howard Marks of Oaktree speaking about it earlier on Bloomberg TV.
Obviously, there's optimism surrounding AI today, and it is to some modest degree pervading the market. But I think that AI will not have a profound impact on non-AI companies for a good period of time.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
Morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
All right, it's time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. And first up, we have Bernstein downgrading Northrop Grumman to market perform. The analyst doesn't see any immediate catalysts on the horizon as the Department of Defense's budget gets constrained in Congress. Next up, we have Craig Hallam upgrading Penn Entertainment. The analyst says that M&A and activist interest provides a compelling opportunity for the stock, even still currently down about 1% in the pre-market. And finally, we have Monness Crespi cutting its recommendation on Palantir to a sell. The analyst cites the big data company's, quote, gluttonous valuation. And I mean, some of that is getting worked off right now. Palantir currently off by about 3.4% before the bell rings. Let's get a check on the markets. We are just minutes away from the opening bell. And you can see the S&P 500 taking a bit of a breather here. We saw its record run break a little bit yesterday, closing about 0.3% down and currently off by about 0.1%. Of course, we are still on track to close out a third straight week of gains unless something amazing happens. And of course, it is triple witching day, so you never know. But in any case, you take a look at the NASDAQ 100 right now, currently flat in the pre-market. And then small caps, we haven't seen this in a while, relative outperformer on the day. Now coming up, the biggest bull on the street. We'll speak to Julian Emanuel of Evercore about his 6,000 price target for the S&P 500. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
So we're looking now to the market on open imbalance. S&P 500 is 565 million to the buy side. NASDAQ 100, 60 million to the buy side. Dow 30, 70 million to the buy side. Mag 7, 20 million to the buy side.
NASDAQ 100, but still biased lower. And small caps, they were rising in the pre-market, but fading a little bit, of course, as that bell rings. So let's take a look at what's going on outside of equities right now. You take a look at FX. You can see Euro USD, that pair, down to 106 right now. You take a look at your 10-year Treasury yield. A little bit of a rally building in the bond market. 10-year yields currently off by about 3 basis points, and crude pretty quiet this morning, currently up by just 0.1%. Now, one stock to watch at the open is Spirit AeroSystems, soaring after a report that Boeing is near a deal to buy back the aircraft parts supplier. Abigail Doolittle has more.
And Katie, this of course isn't really new news. It's just confirmation of what we've been hearing for quite some time. Off of the September of last year lows, more than a double for Spirit AeroSystems. So again, some of this priced in. Right now the stock up about 5.2%. So a very good day indeed. I'll actually be able to see exactly since how long using the SINS function within the Bloomberg terminal. It is the best day since March 20 of this year. So investors liking it. But the relief is about the idea that there is this report, Reuters saying that Boeing is nearing a deal to buy back the aircraft parts supplier in terms of splitting the different programs, and then Airbus will take another. And then there's a possibility that a third category of programs may be sold or dealt with separately. Since this stock was spun out back in 2007 or so, into today up about 30%. But between there and now, lots of moves up and down. I think investors really like the certainty of what's happening here, Katie.
Yeah, some needed relief for that stock, of course, down pretty mightily over the past year. Abigail Doolittle, thank you so much. Meanwhile, earnings season never ends because CarMax out with results this morning. Let's bring in Bloomberg's Jess Menton.
Well, taking a look at CarMax this morning, Katie, that stock up more than 3%. So this is a key company to look at because when you think about the Federal Reserve's trajectory with interest rates, obviously we know that when it comes to used car dealers, especially CarMax, because it is the biggest one in the U.S. and the pressures that came under, especially during the pandemic and then coming out of that, when it comes to new car sales, there's been a lot of improvements there just because a lot of those used car dealers have been issuing different sort of deals to get consumers to come back in. But when it comes to the used car side, even though you are seeing a profit beat there, but it offset a sales miss, when you look at this, especially when you think about affordability when it comes to some of these used cars, if you look toward the end of last year, the average was close to around $30,000. Now it's hovering around $26,000. So of course still pricey, but they are seeing those affordability improvements there, which is crucial. And especially when you think about what the trajectory of when it comes to the Federal Reserve potentially trimming borrowing costs later this year and what that could mean for the company. If you look over to some of its rivals, so if you look at, say, AutoZone, that stock is actually up just about 0.4%. We know Carvana can be quite volatile, but that stock's down about 1% there. And then when you look at the sub-industry group, when it comes to auto retailers right now, it's up about 0.8% for that group in the S&P 500. And of course, I can't leave out when it comes to buyback programs. It did reinstate that at the end of last year, and it said in this prior quarter that it did buy back about $100 million of stock, Katie.
All right, Jess Menton, always great to see you. Thank you for that. And in the next hour, we'll be talking cars with the CEO of Ferrari. That's coming at about 10:10 a.m. But before we get there, finally, let's talk about Sarepta Therapeutics soaring after the FDA approved expanded use of the company's gene therapy. Natalia Kunijevic joins us now with more.
So the stock is up by 30% today. This is a huge win for the company. Basically, this gene therapy called Elevidys is for children aged 4 and above to treat DMD, Duchenne muscular dystrophy. It's been very controversial, this whole approval process. Basically, it failed phase 2 and phase 3, which is a benchmark. However, this therapy showed really good results during some of its secondary analysis. Eventually, FDA got granted an accelerated approval process, which is basically a shortcut to get drugs for devastating diseases to the market. So this drug therapy has been available on the market since last year, but only for children to treat children 4 and 5-year-olds, but now it's approved for patients who are at least 4 years old, but with no upper age limits. What it means for the company, basically that was the main thesis why investors have been holding this stock for a few years. It will accelerate sales dramatically, analysts are saying, and even during this timeline when this drug was available, but that was a kind of like a limited availability for some patients, it generated sales of about $200 million.
So in 10 minutes time now at 9:45 a.m. Eastern time, we see the release of the US S&P PMI flash data for the month of June. So the manufacturing PMI forecast is 51 on the prior 51.3, with a range of 52 to 50 expected. For the services PMI, the forecast is 54 on the prior 54.8. The range is 55 to 52 expected. And the composite PMI, forecast 53.5 on the prior 54.5.
Year-end price targets on the S&P 500. The highest now sits at 6,000. And joining us now is the man behind the call. His name is Julian Emanuel. He is Chief Equity Derivatives and Quant Strategist over at Evercore. Great to see you in person.
Great to be here, Katie.
Let's talk about the big call heard around Wall Street, because you went from 4750 to 6,000. Show your math here. What gets us to 6,000 by year end?
So I think when we step away from it, okay, and clearly this is something that there's an element of stepping out of one's comfort zone because we consider valuation to be a rather large part of the puzzle. But in going back and looking at history, valuation alone has not been a reason specifically to sell stocks. And frankly, in an environment where we think the AI revolution is really in its early stages, just an example here, we've been giving a series of webinars about macro topics for the last 6 months, and the company introduced an AI device about 2 weeks ago. We were able to take 45 minutes worth of a conversation and distill it in 3 minutes. And so for me, that was sort of a crystallization of how this technology is going to really enhance productivity. And so for us, the combination of that, the combination of the fact that we are, in our view, nowhere near a bubble, and the idea that past expensive markets have gone on for 1.5 to 2 years and have gone 40 to 60% higher. And this one is only 6 months old, based on crossing 20 times trailing earnings, and has only risen 11% from there. We think there's more to go.
I do want to get to the bubble talk, but let's talk about AI a little bit more and the revolution that is AI, because some of the themes that you're highlighting, you could have made that case at the start of 2024. So did anything change in the past couple months, or is it just your own experience with AI that really informed this?
Well, and to be fair, we did make the case throughout 2023. Actually, we were reasonably early to identifying the significance of it. But frankly, it's sort of anecdotal. It's talking with clients and corporates, and it's personal use that you can actually see the benefits accruing. And I think it's fair to say that that was the same sort of mentality that hit people in the late 1990s and the early 00s, even after share prices had turned down, with regard to the internet, and the long-run implications for productivity are quite significant in our view.
And you mentioned that, I mean, high valuations are something that you kind of had to digest here. And I was actually speaking just casually with a portfolio manager yesterday, and we were talking about NVIDIA, and they haven't invested in NVIDIA yet. And they said, how do you buy NVIDIA right now? Basically at all-time highs, really briefly becoming the world's most valuable company. And I'm curious, I mean, how do you square FOMO versus really just the valuations? Do you just have to hold your nose and buy here?
So there are certain stocks, and that's certainly one of them, given the gains, where it's very difficult, particularly if you've got, you know, a multi-week or a multi-month horizon. An entry point could be challenged here, but you really have to think about the long term and the implications of where the technology is going. And as well, when we talk about the stocks that we consider AI revolutionaries, we also include companies in other industries that have been very front forward about implementing the technology and showing how A, it controls costs, but more importantly, how it actually engages and really elevates the customer connectivity experience.
Yeah, I do find that a fascinating narrative. The broadening of the AI rally, maybe not the overall rally, we haven't seen that yet, but just where AI could actually influence other parts of the market. Let's talk a little bit more about the underpinnings of this 6,000 call, though, because you also notched up EPS forecast from $231 for the S&P 500 to $238. Where is that growth coming from? Is that just tech?
So in 5 minutes time now at 9:45 a.m. Eastern Time, we see the release of the US S&P PMI June prelim reads. So manufacturing PMI forecast is 51 on the prior 51.3, with a range of 52 to 50 expected. The services PMI flash forecast 54 on the prior 54.8, with a range of 55 to 52 expected. And the composite PMI flash forecast 53.5 on the prior 54.5.
The Fed will be there to, with plenty of ammunition to mitigate against the downturn. But B, the economy is on a path where we do think that earnings will broaden out.
Yeah, for better or worse, that Fed put, it still exists, it sounds like.
Look, for about a year and a half, the Fed wanted to say that it didn't, but frankly, and if you think about it, it continues to be an inflation story. And this environment is unique in that actually long-term rates have risen since the Fed's last hike last July. The market unusually is not looking towards a material slowdown, but yet the Fed is still there if inflation cooperates as we think it will.
Let's talk about bubbles. Like you said, this isn't a bubble, and we're lacking some pretty key ingredients here when it comes to M&A, for example, and when it comes to IPOs. We really still haven't seen those companies come out of the pipeline. What do you make of that?
Essentially, there could be a part of it is the capital markets are waiting to see what's going to unfold in Washington. This is, as we know, a reasonably consequential year for politics, and so that's an unfolding story. But again, it is part and parcel of most sort of climactic emotional rallies, which this one is not, that you do get M&A activity and IPO activity. And frankly, when you look at the bullish sentiment readings, they're not there yet either, which, again, is heartening to us.
And I feel like depending on how I wake up in the morning, I could feel like the lack of IPOs is either bullish or bearish, because it could be taken bullish as in, okay, we're not in a bubble. It could be bearish as in, what do these companies see that is keeping them out of the public markets, keeping them from leaving that pipeline? I mean, how has your view on that evolved?
Well, I think, look, the private markets have been very robust. We know that there's been swings in valuation over the last 4 or 5 years. But ultimately, as in past cycles, the eventual strategy for a good swath of those companies will be going public. And we do think that that is part of the calculus. And then, of course, on the M&A front, there's just a huge amount of cash on hand in corporate America that, whether it's AI-driven or just, other forms of synergies, we do think that that cycle will reappear before this, rally ends up peaking.
And Julian, before I let you go, I do want to talk a little bit more about private markets, because I'm having to pay a lot more attention to them, not just when it comes to private credit, but to that point, it feels like private markets are extremely hot right now and they're getting bigger. And obviously you live in public markets, but are you finding yourself paying attention more to those still private companies?
Well, you have to, and particularly on the credit side, because I think that
1 minute remaining. I'll lead with the US S&P manufacturing PMI flash.
Both public and private has been very material since the pandemic, really driven by actually long-term rates going so close to zero as they did in 2020. And there will be liquidity issues at some point. There always are in every cycle, but we think we're a long way away from that. And frankly, the resilience of the credit markets has been part of this ongoing story of the rally in the stock market.
All right, Julian, I think that's a good place to leave it. Great to see you. Thank you for joining us on this Friday. That, of course, is Julian Emanuel of Evercore ISI. Now, coming up, we're going to dive into U.S. PMIs next. This is Bloomberg.
10 seconds. $51.7, higher than forecast at 51. Services PMI 55.1, 55.1, higher than forecast 54. Composite PMI 54.6, 54.6, higher than forecast 53.5. So looking to the markets, dollar seeing some strength here. S&P 500 extending this weakness off the back of this hot PMI data out of the US. So again, US services PMI coming in hotter than expected at 55.1, forecasted at 54.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
From the beating heart of global finance, economics, and politics, and wherever newsmakers...
We have posted out the US S&P June prelim PMI report on the feed for anyone interested. It does note that US business activity growth accelerated to its fastest for 26 months in the month of June.
Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, the latest U.S. PMI numbers just crossing the Bloomberg terminal, and it looks like a beat across the board. Let's get to Michael McKee. He is Bloomberg Chief Economics and Policy Correspondent. And walk us through these numbers, Mike.
Well, we've been hearing from a lot of people who think the economy is slowing and the Fed's going to have to act, but not with these numbers here. The manufacturing PMI from S&P comes in at 51.7, up from 51.3, and the services 55.1 from 54.8. The composite then ends up at 54.6 from 54.5. So still strength in manufacturing services and the overall economy, according to S&P Global. Now, this makes the U.S. an outlier with the rest of the world because we got European PMIs today that did not look so good. Pretty much in every country, France, Germany, the UK, and the European Union as a whole, we saw declines. So in manufacturing services and composites. So it is not a particularly global effect. It's the U.S. as the strong outlier, Katie.
Yeah, and I mean, I feel like I keep asking you, when do we start to worry about growth in the U.S.? When do we go from worrying about inflation to worrying about growth? And I'm not really seeing it in these numbers at all.
Not today, at least. We'll try again next week if you want something to worry about.
And let's talk a little bit more about that divergence that we're seeing between the big global developed economies. You mentioned, of course, Eurozone activity. It slowed in the latest reading. And you think about the divergence in the economies going to lead to a divergence in the central banks, at least for the next couple months.
Well, the ECB, the European Central Bank, did cut rates once, but they're being reluctant in terms of trying to give people clues to another cut anytime soon. Their inflation story is a lot different from ours because they use the harmonized version of the CPI.
At 10 a.m. Eastern Time, we get U.S. existing home sales forecast 4.1 million on the prior 4.14 million, with a range of 4.27 million to 3.85 million. U.S. existing home sales change forecast minus 0.9% on the prior minus 1.9%. U.S. leading index change month over month forecast minus 0.3% on the prior minus 0.6%.
Splash than the Bank of England did this week.
Well, that's exactly where I wanted to go, because we talk about political and election risk when it comes to the U.S. all the time and how that factors into the Fed's thinking. Take us over to what's going on with France. How are we seeing that effect both in the economy and potentially at the central bank level?
Well, it's an interesting situation because basically Emmanuel Macron, when he called the snap election, they figured that the right, the Le Pen group the National Front would be the main challenger, but then the leftist parties all got together and formed an alliance, and so now he's got problems on both sides, and so do the markets, because the markets see both the far left and the far right as willing to spend a lot more money, and France is already in a deep deficit hole, so there are questions about what's actually going to happen, and the argument there is sort of the same as the argument here in terms of some of the politicians and their promises, that these are promises, don't worry, they're not going to happen, but it has boosted the spread between France and Germany and the yield curve, although when you look at it, France is only in the 3% range. The U.S. is well over 4% for its 10-year. So is it as bad? Well, we'll have to find out.
All right, yeah, definitely something to watch there over the next couple weeks and months. Mike McKee, have a great weekend. Meanwhile, take a look at the market reaction to those U.S. PMIs. Again, a beat across the board. You do see yields rise a little bit here, still lower on the day, but a little bit of a reaction in the bond market. Let's go back to the equity market, though. And for some of the sector price action, Abigail Doolittle joins us now.
So right now we're looking at the S&P 500 down slightly, down about 0.3%. More of the sectors are higher, including staples. That, of course, though, is a defensive sector, as is healthcare and utilities, services, communication services, and discretionary and energy in there, but no big gains. What I'd really like to highlight is take a look at that tech weakness, down 1.1%. Now, a piece of this is NVIDIA. Today, down about 5%. Over the last 2 days, down 7.7%, the worst 2 days since April 19th. And if we take a look at what's happening for Apple, because that was another one that did an interesting reversal yesterday, actually that one right now is a little bit higher, offsetting some of that NVIDIA weakness and the AI weakness. Taking it to the week, Katie, let's take a look at some of the subsectors. So we are looking at an up week right now, at least for the S&P 500. We have the casino sector up 4.4%, oil service index going up with energy up about 3%. But take a look at some of the weakness right there for that tech index. That is super interesting. I'm guessing, and I'm going to put it in as quickly as possible here, that the information tech index down on the week, down 1%. Most of that is coming from to today, and that is the worst week for tech going back to, well, it's actually not that far back, just 3 weeks ago. We also have real estate lower and the home builders down as well, Katie.
All right, Abigail Doolittle, thank you so much. Coming up, the market-moving events you need to be watching next in our Trading Diary. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say
At 10 a.m.
company
Eastern
needs to
Time, we get
become
US
an
existing
intelligent
home
software
sales
company.
forecast for spot 1 million on the prior 4 spot 14 million, with a range of 4 spot 27 million to 3 spot 85 million. US existing home sales change forecast minus 0.97% on the prior minus 1.9%. US leading index change month over month forecast minus 0.3% on the prior minus 0.6%.
It will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
All right, it's time now for the Trading Diary. What you need to be watching today and next week. We get existing home sales at the top of the hour, and then next week on Tuesday, the World Economic Forum begins in China. Wednesday, we get May new home sales. Thursday, it's the first debate between President Joe Biden and challenger Donald Trump, and then we round out the week Friday with PCE. Meanwhile, take a look at markets right now. The S&P 500 building on losses just about 30 minutes into the session. You can see currently down about 0.3%, and all those small cap gains we were talking about in the pre-market, they're gone now. The Russell 2000 down about 0.4%, and the NASDAQ 100, it's your laggard on the day. The NASDAQ 100 currently off by about 0.5%. Now, this was the countdown to the open. I'm Katie Greifeld, and this is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision,
1 minute remaining. I'll lead with US existing home sales.
Is aligned with all what employee wants to do. That's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
10 seconds.
All right, we're 30 minutes.
4 spot 1 million, 4 spot 1 million higher than forecast, 4 spot 1 million. Existing home sales change minus 0.7%, minus 0.7%. That's higher than forecast, minus 0.97%. And US leading index change month over month, minus 0.5%, minus 0.5%. Lower than forecast, minus 0.3%.
Set to cost €500,000. We'll get the details from the company's CEO in just a bit. And Swiftonomics, we'll talk to one analyst who says that Taylor Swift's Eras tour in Europe could influence what the BOE does in September. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at markets right now, and we are seeing a bit of a decline in the S&P 500. You can see currently off by about 0.2%, not as far down as it was just a couple minutes ago. We're squiggling back and forth, but the direction of travel has been lower so far this morning. You're seeing a little bit of volatility come back into the market, at least measured by the VIX.
So home prices hit a record high in May as sales stall.
We were below 13 just a couple days ago. Still very historically low levels there. And then the 2-year yield, we're still lower on the day, down about 1 basis point. But of course, after what we saw with PMI, and now we are getting some existing home sales, seeing some of that rally come out of the market. So let's get to those numbers. U.S. May existing home sales falling 0.7% to a 4.11 million rate. You can see that actually the estimate had been for 4.1 million. So it's a little bit above that, but still, you compare it to the prior release, 4.14 million, and a definite decrease there. So we're going to continue to follow that. But let's talk about triple witching, because it could provide traders with some short-term market swings today. It will see an estimated $5.5 trillion worth of options tied to indexes, stocks, and ETFs fall off the board. And Bloomberg's Abigail Doolittle is here with a preview.
This is a closely watched one for sure, Katie. As you mentioned, $5.5 trillion estimated worth of options tied to the indexes, stocks, ETFs expected to expire. This can certainly bring volatility and volume for this particular triple witching, and it's also the S&P 500 rebalancing. Traders are closely watching two things. First, they are watching long gamma rolling off, basically the near-term incessant selling of options. Some are saying that this has really kept the market sort of in lockstep going higher, but that after this expiration, stocks could trade more freely, and implying that that could bring some volatility, maybe to the downside. But I did speak to Chris Murphy over at Susquehanna, and he said, yes, it is having a real impact right now in terms of the selling of those near-term options. And yes, there's going to be a lot of movement in trading today, but he's not convinced that it's not going to come back very quickly. In other words, we may not have a huge surge in volatility.
And let's talk a little bit about volume, though, because it seems like it's really the market close that is the event to watch today.
Certainly, that volume is going to really climb much around the market close, as a lot of these, or, again, that $5.5 trillion expires. Plus the rebalancing, you're going to still have some index managers reshaping their portfolio to the newly refashioned S&P 500. And I was also mentioning, Katie, another big influence today, and this will certainly be on gamma too. There's one particular trade that's often watched, but right now is being particularly watched. It's the JP Morgan collar on the S&P 500. The exact level is 5570, and that apparently it's had a big impact both psychologically and in terms of price. It's very well tracked and watched by the market. So if we grind higher in the weeks ahead, that could have a big impact, but that could go back to that long gamma. Does it come off, or, as Chris Murphy was saying, is it more likely that we're going to see not so much of a change as some investors and traders are thinking?
Certainly a lot of technicals at play in this market. Bloomberg's Abigail Doolittle. Thank you so much. Let's turn to the broader markets right now. We're going to do that with Barbara Reinhard. She is Voya Chief Investment Officer joining me on set. Great to see you.
Thank you.
So let's talk about some of the economic data that just crossed in the past half hour or so. Of course, we've got U.S. PMIs at about 945, a beat across the board. And it's interesting to contrast that with what we saw from the Eurozone when it came to some of their activity numbers earlier this morning. So a bit of a divergence there. How do you play that in the stock market?
Well, you know, Kate, this has been something we've been seeing all year, that the U.S. has been one of the sole markets. It's been powering ahead. Economic growth in the U.S. has been strong, but it's been trending down towards 1 to 2% growth, and we think that's a very favorable environment for risk assets. On the other side, Europe has continued to struggle, and even we're starting to see Japan struggling, and China's data, which was out over this week, was really not all that strong. So it's the U.S. seems to be the market to be in. We have been overweight in our portfolios in the U.S. and underweight international, developed, and emerging markets, and it's really paid off for us.
So overweight U.S. at the expense of the rest of the world. And you mentioned the economic growth picture. Of course, that's a huge part of it. But talk to me about tech. I mean, I hear the case all the time that you think about the U.S. tech sector, you just don't see that in Europe, for example.
Well, I guess when we really think about the U.S., we also look at the overall earnings picture. You know, the U.S. went through an earnings recession. It's unlikely that you would see another one so quickly on the back of that. And when you look at first quarter earnings, over 80% of companies had beat estimates inside of tech and outside of tech as well. So we think that's a very good underlying potential strength for the U.S. Yes, tech has really been powering the market ahead this year. It certainly has some of a setup to maybe take a breather at this point. I can tell you even what we're seeing in the European markets with the European election coming up in France, it's causing a lot of uncertainty, and markets don't like uncertainty. You could see something similar around the U.S. election this fall, but we think that the underlying fundamental picture, 1 to 2% economic growth, 1 to 2% in terms of inflation, we think inflation is going to come down, and it just makes the U.S. a better place, tech or no tech.
Well, let's talk a little bit more about that election risk, because like you said, it's probably not going to alter the underlying fundamental picture. But do you trade around that? Do you invest around that? Or do you just try to ignore it, that volatility that might come around the vote?
So we're running multi-asset portfolios that are generally for retirement or for our college savers that are going to college. These have long investment horizons, 40 years in some cases. We're going to continue just to invest through it. Generally, investing around politics does not pay off, and we have a much longer time horizon.
Yeah, it's a fair point there that when you're investing with a 40-year time horizon, maybe the 2024 presidential election doesn't truly matter. But let's talk a little bit more about earnings, because you make the point that when it comes to the latest round of earnings, it wasn't just tech that beat. It was a lot of these other sectors as well. But even still, you have this very narrow market. And it feels like we've been asking this question for months now. But why aren't we seeing that broaden out?
I think you're not seeing it broaden out yet because there's a little bit of concern about the U.S. economic slowdown. So growth is not powering ahead as fast as it did last year. Think about this, Kate. This time last year, we were adding something around 400,000 jobs a month. Now we're adding something closer to 200 to 250,000 jobs a month. So it's a downshift in growth. Of course, in that type of environment, investors and market participants tend to go to where the strongest earnings outlook is. I mean, everyone's talking about AI. But I do think that as you see the fundamental picture broaden out, as you see the Federal Reserve start to lower interest rates, which we think will happen in September, you should start to see some other parts of the market do well. I would note there have been some divergences in this very narrow leadership that we've seen in the market. It may mean that we get a breather at this point, but any correction that we see at this point we think would be technical in nature because the underlying growth picture is very good.
And it's a good point, too. You think about big tech. You have seen divergence. You think about Apple, Tesla, for example, kind of falling out of bed this year. And then you just have the likes of NVIDIA covering all those sins. But let's talk a little bit more about that 40-year time horizon. I'm really enchanted by it. And we don't often talk about fixed income on this show, but you've had people come out and say, we've seen a generational reset when it comes to bond yields and to the Treasury market. Are you in that camp as well? Is this a generational sort of moment?
Well, Kate, we think it's been a big move off of the 2020 lows that you saw in fixed income. So You've been in a very big bond bear market really since the pandemic. Peak to trough decline in long-dated treasuries of about 55% over the 2020 through 2022 time period. So we think that there's been a big reset. The financial repression that had been in place and the intervention that had been in place since the global financial crisis has indeed exited. This is a much healthier bond market that we've seen really in the last 15 years. You have positive real yields, which are great for our plan participants that are working on living on just fixed income. And we think it also gives a better health to the market as well. It's not normal to have zero interest rates, and it certainly isn't very healthy for any market to have negative real interest rates. All that's behind us, so we think that the market's much more in balance, and we think fixed income is a really interesting asset class.
Yeah, indeed, and definitely a lot of people would agree with you there. Barbara, great to see you on this Friday. Have a great weekend when you get there. Our thanks to Barbara Reinhard of Voya. And let's take a look at what's moving underneath the equity markets right now. We're going to do that with Bloomberg's Isabel Lee. And tell me about Spirit AeroSystems.
So Spirit Air shares are now rising because Airbus is edging closer to an agreement with Spirit to take over parts of its business. So this paves the way for an acquisition of the bulk of the company of Spirit by its arch rival Boeing as early as next week. So the final terms are still being negotiated and are still being discussed, so that means they could change or even fall apart. And Reuters was the first to discuss this and to report this earlier today. So Spirit, as we know, has come under financial strain, especially as Boeing slows its output of 737, and this is the main source of revenue for both manufacturers. So it's not a surprise that investors are looking at this news as something sort of good news.
Yeah, definitely. Of course, the news there that Spirit AeroSystems and Boeing nearing that potential deal. We're going to continue to watch that. But tell me about the earnings picture, because we did hear from CarMax this morning.
So CarMax reported a good earnings. The company beat its first quarter estimates. Sales fell, though, and that missed. But still, investors are celebrating the news. We have Truist saying that results were in line with expectations and adds that CarMax seems to be ceding share both to Carvana and to just broader new vehicle dealership base. But we also have RBC saying there's something for everyone, both the Bulls and the Bears. And RBC said that it's really not a thesis-changing quarter, but it's still a decent quarter. They continue to like the stock over the long term, and they said that, there's likely not going to be that huge positive catalyst down the line unless the macro picture improves. But at least for now, it's looking good for the company.
Yeah, not thesis changing. That's good, and that's also bad. But let's finish on MicroStrategy. We haven't talked about this name or crypto in quite a while, Isabel.
So shares are edging down. We're seeing some pressure, but there is good news because we have TD Cowen raising its price target for the company to $18.80. That's from $14.50. So this implies a roughly 30% increase from the close. So that's good news for a company that's known in Wall Street as a Bitcoin company. It's also good news because Bitcoin now saw its 1-month low. So that's really not good news for the cryptocurrency. And also MicroStrategy news bought yesterday. It was announced yesterday they bought 786 million in Bitcoin between April 27 to June 19. So that's roughly 12,000 Bitcoin. And this is the third largest acquisition of MicroStrategy from its last purchase in March. And this brings its total holding to 226,331 Bitcoin, Katie. That's around 15 billion. And Michael Saylor started buying Bitcoin in 2020, 4 years ago, as a hedge against inflation.
And he just keeps on buying. You can rely on Michael Saylor for that. Bloomberg's Isabel Lee, thank you so much. Now coming up, Ferrari inching closer to unveiling its first all-electric vehicle. We'll be speaking to Benedetto Vigna. He is the CEO of Ferrari next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Well, Ferrari is raising the hood on a new EV factory in Italy as it gets closer to unveiling its first all-electric supercar later next year. For more on the road ahead, I am thrilled to say we're joined now by Benedetto Vigna. He is the CEO of Ferrari. It's great to have you with me. How should we be thinking about this new factory? Is this the new crown jewel in your portfolio?
It's a new crown jewel factory for sure, but it's a factory that has a good name. The name is E-Building. The E in front of it stays for three things. It means energy, it means evolution, it means environment. Because this is a factory where we'll make new strategic component with for electric cars. We will make all the cars that we intend to make for the future, and then we will do everything in full respect of the environment. That's the name of this factory, E-Building.
E-Building, I'm going to write that down. And let's talk about what the goal of E-Building is, because you shipped just under 14,000 vehicles last year. Is the goal of this new factory to increase your annual output?
Now, the goal of this factory is to increase the capability of what we are doing here. We want to provide to our designers, to our engineers, something that allow them to continue to make unique Ferrari on one side, and we want to provide our client the freedom to select the propulsion scheme they want. If they want an ICE, if they want an hybrid, if they want an electric car, well, they can have the choice to select which car they want. We are strong believer of the technology neutrality when it comes to cars for our segment.
All right, appreciate that clarity there, that it's not about just increasing the numbers. But that being said, how many cars could be produced at this new E-Building?
Look, this is about capability, it's about ability to personalize more and more the cars. It's not meant to increase the capacity, it's meant to increase the ability to develop unique product. It's meant to increase the possibility to personalize more.
I'll move on, I promise. Let's talk, of course, about the all-electric
For the time being, we have several prototypes on the road. They did several thousand kilometers, and everything is going as planned.
Everything is going as planned. Well, I do want to talk a little bit about pricing here, because there was a Reuters report in the past couple days reporting that this new EV will cost at least 500,000 euro. Is that accurate? How should we be thinking about pricing here?
But look, usually we define the price of our car 1 month before we unveil them. So this is something anyone can speculate. This is a speculation. I think that you have which is going to be the price for our first electric car.
Is there any sort of range that we should be keeping in mind, of course, as we await for the official price?
You know, we don't like to talk too much about these things. Cars that are unique for our client, that are delivering unique emotion. So let's wait for that, and then we'll talk about
it. I'll take you up on that. But let's talk a little bit about hybrids versus ICE versus, of course, of the cars that you sold in the first quarter were hybrids, which was definitely interesting to hear. Do you 5-10 years or so, do you see all electric demand outpacing hybrid or even ICE demands?
Our duty is to be able to provide our client the motorization they want. If they want that, we have to be ready for that. So for us, for me, I think it's fair to tell you which is the to our client. For forecasting what is the sales is difficult. If you want my point of view, it's clear of colors, the three kind of car will stay together for a while. And then we'll have different kind of client. We'll have stick to the thermal car. We'll have client that will take also the electric car. And then client of Ferrari because they buy the electric car.
So let's talk a little bit more about that, because I think that's really interesting. With this EV that you're putting out, this all-electric super customer base, or do you see actually potentially pulling in new clients who maybe aren't in Ferrari currently?
I keep discussing with many clients. As I told you, there are clients that like the then they will stick to that. They tell me, Benedetto, I will not buy an electric car, as well as there are clients telling Benedetto, when can I buy it? Because I want to use also the electric car. And then there are clients telling Benedetto, I cannot become your client till you have an electric car. Different client, depending on the relation they have. So it's a little bit, it's interesting, let's say. Flexibility is important, and this building here is giving us the flexibility that we are asking.
Fascinating to follow that. And I do want to talk about some recent news this week outside of just Ferrari's business, and that is DK Global's dealer management system. Has that affected any of your U.S. stores at all?
That we are having have been touched by this, but no impact for us.
All right, no impact.
For us. Some dealers are working on it, but for us there is no impact.
All right, Benedetto, can't say how much. Back soon, of course, when we do have those pricing details, we'll definitely be in touch. Our thanks, of course, to Benedetto Vignetti. Come to Italy for that one. That sounds like a good trade-off. Until then, really appreciate your time. That, of course, is the CEO. The most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence. Modern only on Bloomberg. Context changes everything. On July 4th, amid debates about tax policy, border security, foreign policy, Bloomberg has full coverage leading up to the election and will bring you the results after. Tune in for continuing coverage on Bloomberg Television. Context change.
Headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market. p.m. Eastern. Bloomberg. Context changes everything.
All right, it's time now for Social Climbers. A look at the stocks making way on earnings. The gunmaker says that sales in the first quarter will be down by about 10% thanks to softer demand. U.S. election nears. Next up, a big step forward in the fight against HIV. Pharma giant Gilead was 100% effective in preventing HIV infections in a late-stage clinical trial. In the HIV market. And finally, we have American Express cardholders. They may find it easier to dining and event ticketing platform Tock from Squarespace for about $400 million. Tock, of course, is including hotspots like Per Se and Jean-Georges in New York City. And you can follow on your Bloomberg terminal. Meanwhile, let's get a check of these markets right now. Of course, just about an hour into hanging out about 0.2% lower. We are going to finish this week higher. It looks like of gains. Of course, things could get funky around the close as we near that triple witching X. But for right now, it's pretty quiet. S&P 500 down 0.2%. Even still, you do have the VIX just 13 handle. Feels like we haven't seen that in a while. Of course, the VIX doesn't do much these days. Volatility pretty low. Giving up the rally, of course, we got PMIs at 945, beat across the board, which was very interesting. That the rest of the world continues. Now coming up, Taylor Swift's record-shattering Eras Tour is supercharged. Also delay a BOE rate cut. We'll discuss. This is Bloomberg.
Arch has laid plenty of ground. Now, Mark Messler's most pressing challenge as CFO is conserving capital.
Around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and because things change by the day.
Archer went public in 2021. Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over United Airlines and Cathie Wood's ARK Investment Management.
Does that ARK investment open lines of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with my top targeted list of investors over the next 2 to 3 years, and investment a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of progress. I want to create credibility with them that we are marching towards our goals of commercialization.
The heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you experts.
Well, Taylor Swift is in her London era. The pop and Swifties are more than ready for the show. But just how prepared is the UK economy? TD Bank's rate cuts, and joining us now is the man behind the research. His name is James Rossiter. He is TD head of global macro strategist, and I am so excited for this conversation. Let's start off with, how do you go the impact that this concert tour might have when it comes to the European economy?
Really matters. It's something we put a lot of effort into forecasting that, and we collect a lot of hotel prices as part of that program. About a week ago, and started noticing some spikes, and looked into those spikes, and started noticing some overlap with some Taylor. You know, it's not a new story. We've seen it reported a little bit before, but we had some raw data to turn to, and we could see it very clear. So we figured, why not just write something about it and put it out there.
Yeah, it's pretty amazing. I mean, people making a destination out of her tour locations, of course, flying from other parts of the world. And like you said, this isn't a new story. Of course, she's been on tour for years, it feels like. And with that, when it comes to some of her previous locations, and especially when you think about the U.S. Eras Tour.
Reported in the media, right? And I think the places you tend to see the biggest impact are the cities that, you know, effectively are it is easily of a tour of, you know, tens, if not hundreds of thousands of fans converging on a city. At it over in Europe, you know, in Sweden, in April, we saw increased pressure on the travel service. We had the Eurovision finals around the same time. And then in the UK, you know, cities like Edinburgh, cities like Liverpool, they're mid-tier fans converging at the same time. The hotel capacity just isn't there to take on everybody at sort of competitive. We see it in inflation.
And let's talk about this in comparison to some of those other events that you ran through. For example, we have the Olympics coming up in France. Where does the Eras Tour rank when you think about some?
That's a good question. I think because it is so short and intense, you know, we're going to see those impacts. That's it, and then it disappears. Something like the Euros, for example, in Germany right now, or the Olympics in Paris, we're going to, you know, and from a technical point of view, I mean, the statistical agencies gathering this inflation data only pick, and there is a chance they just missed the Eras Tour entirely if they're picking, you know, a different day than Taylor Swift's in town. Somewhere like in Germany or in Paris with the Olympics and the Euros, you may get a bigger impact because there's going to be that more sustained. People are making even bigger holidays out of it. And it's going to make the inflation data really noisy, really hard to interpret.
Well, let's talk about that a little bit more. And like you said, short and intense, that is the Eras Tour. Let's put some numbers to that. The New 100,000 people are expected to see the shows when it comes to London. You think about the timing here. What does that mean potentially for the Bank of England?
So look, I think at the end of the day, understand what's driving it, what's temporary, what's persistent. They've got their eyes on inflation really 1.5 to 2 years down the road. 2024 in London are probably not going to affect inflation that far down the road. What really challenges them, you know, we already had been flagging in the UK data, there have been signs of intense pressures. Same sort of stuff that Taylor Swift fans are going to be spending money on. So, you know, the Bank of England may have noticed that a few months ago, and then suddenly you get here, and what's just a temporary blip that's going to go away? It's going to make reading that data for, you know, for the Bank of England, for the ECB, a lot harder, and to some extent they're probably going to want to wait to see what the following month holds, just to make sure that things was temporary and not signs of kind of stronger underlying demand.
Well, it's an interesting question, right? Can you consumer spending from what we're seeing when it comes to just the demand that we've seen so far for the Eras Tour?
these expected figures, it seems like this is a consumer that's still willing to spend on these types of experiences.
But inflation coming down, wages still fairly strong. Real incomes are rising now, right? People are feeling better off. Drop though, and this is what we really have to be watching for over the next few months. Is we've seen some warnings from some big travel firms that the revenge spending we saw last year, which was really, really intense, is starting to come off a little bit. So those extra holidays people took a year ago, maybe not so much this year. Maybe it's because they're spending all their money at Taylor Swift. I don't know, but you know, we've got to kind of keep the bigger picture in mind. And if that revenge spending's kind of unwind, that the Taylor Swift thing is just, you know, a very narrow, sharp thing, and actually we see kind of trending down the course of the summer. You know, again, there are early signs of that, but I think for now it's just going to be.
Well, it's interesting, of course, on this program we talk about the U.S. consumer all the time. So give us a few more details on the British consumer, because in the U.S. the story has been for several years now that sentiment is surveys, but still the consumer just keeps on spending. The American consumer is resilient. Does that story?
And not so much. I mean, America really does stand out. When I look across sort of the cover, you know, the G10, the countries we some underlying signs here and there of weakness, but it is a different animal to, say, a European consumer. Now, you know, I contrast that a little bit. We got great data out of the UK this morning. The retail sales data shot up way more finding the previous month's weak number. So to some degree, you know, there's signs of some life in the consumer. And as I said earlier, the fact that wages are still growing by more than inflation, and inflation has come down from double digits in Europe down, you know, we're getting towards target. We're at target in the UK even. That means real wage growth is there. And, you know, maybe we're at a turning point. We're actually quite optimistic on kind of the European, you know, the UK, the Eurozone economies. A lot of the big negatives that we've seen over the last few years from higher energy prices and all that, those have kind of worked their way through the.
And James, before I let you go, I have to ask, are you going to the Taylor Swift concert?
I think my little girl would wish we were.
All right, well, maybe next time she comes to Europe. James, really appreciate your time on this Friday. That, of course, the head of global macro strategy. Let's get a check on these markets. We're going to do that with Abigail Doolittle.
Now on the week, up 0.6%. So given the fact that it is triple witching, we do have the rebalancing, and we could see on the day indexes are down a little bit today. Perhaps this goes away, but otherwise, again, a third up week in higher. That probably has to do with all of the option contracts that are rolling over, expiring, I should say. Just a little bit, so bonds down. So this is basically a risk-on picture, even with that VIX up a little bit. Basically flat. Let's take a look at the S&P 500, because earlier you were talking about volume on a triple witching day, and there are contracts do expire. You can see going all the way back to 2021, 2022 on each of these days. Back in on this next week potentially to see whether or not it goes into that area. And then finally, a piece of the volatility, at least trade rolling over just a little bit. This was true yesterday too. Nvidia declined yesterday by more than 3%. Micron, which isn't directly in AI, but some analysts recently products could be helpful. Applied Materials, the semi-cap equipment company, going down with the overall, which of course put up a good quarter recently, helped out by AI. Big rally. Well, similar of it back today.
All right, Abigail Doolittle, thank you for that roundup. Now coming up, we're going to take a look at Russia's growing Group president and founder. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
To me, teamwork is key.
You need to identify opportunities and push people.
That goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just
more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just
more than the profit today, it's building the future of tomorrow.
Get passion, perspective, and more from the new season starts July 10th, only on Bloomberg. Brought to you by Workday. Released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Covers the world with unmatched reach and resources from more than 120 countries. 24 hours a day. Bloomberg. Context changes everything. The Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. Look at those vintages, even the GFC vintages have done actually pretty well in the
changes everything. The top names in business are on Bloomberg.
We used to say that every company needs to think about becoming a software company. Now we say that every company needs
It's time now for our daily Wall Street Week conversation, and today we're taking a look at Russia's expanding influence in Treasury Group. President and founder sat down with Wall Street Week's David Weston to explain the potential impacts.
The Russian government has secured direct access to, gold to get it from Russia. Russia is on the ground, essentially the lead supporter of many of these illicit governments, these military regimes in Central and Western Africa. The Russians are going to end up also having control over some critical nodes of the minerals that are necessary for a transition energy revolution.
Ian, West Africa has historically been a zone of influence for France because they colonized it. At the same time, Mr. Macron right now is distracted with a few other things closer to home, with this snap election he's called less than 3 weeks away now. Give us a sense of what the possible ramifications of this are.
Macron's own party, Center Party, lost historically 17 points under the national rally far right of Marine Le Pen. And so on the back of that really embarrassing, much larger than expected loss, and by the way, historic, over 50% of French registered voters turned out to vote in this European parliamentary election. That doesn't sound high, but for a European parliamentary election with not much at stake, it's by far the highest that France has ever had. It's a huge embarrassment. It felt like he was going to get censored by the government over the course, by the parliament over the course of the fall. It meant that his budget wasn't going to get through. He wasn't going to be able to continue to be fiscally responsible. So he decided to call a snap election, which in France means 3 weeks of campaigning, and then they go and vote. And the idea for Macron being, if he wins, because you'll have 70% turnout for a parliamentary election as opposed to 50 for the European parliamentary elections, that suddenly his party will do better. He'll be able to scare people away from voting for the far left or the far right. But the left-wing parties have all come together and they are working to not run candidates against each other in Parliament. So that's a big problem for the center. And the average French citizen doesn't believe that Le Pen and her party is a threat to democracy. Only 40% say that she is, that they are, compared to 80%, David, 20 years ago. So look, anything can happen, but right now, and we're only a week and a half away, these elections look very bad for Macron, very dangerous. And if Le Pen and the National Rally are able to capture government and her party takes the premiership, well then, anything in the European Union that requires agreement of all the parliaments, she will be opposed to. So France will no longer be one of the strongest supporters of, for example, more aid for Ukraine or greater defense spending for Europe or more fiscal accountability or more coordination on industrial policy. No, instead, one of the largest and founding members of the EU will be strongly opposed to EU consolidation and sovereignty, supranational governance. It's a huge risk, especially against the backdrop of U.S. elections, which if Trump wins, you'll have a president that supports a Frexit from the EU and a much weaker EU, very different from Biden.
Just my question, Ian, is it too far to go to speculate about the possibility of, as you said, a Frexit, not Brexit, but Frexit? Because, as you said, Marine Le Pen has been fairly hostile to the European Union.
She is very hostile, but Brexit went very badly for the UK, and one of the reasons why Marine Le Pen is polling so well in her party is because she's backed away from a Frexit, instead just picked up all of the policies that show Euroscepticism. So I certainly think that were she to become premier, I don't think they would agitate for an exit, but I think she would be very aligned with Viktor Orban's Hungary, and she'd be very aligned with a Trump policy on Europe, which essentially means that Europe would get weaker, not stronger, at a time that a lot more countries, including Ukraine, are counting on a stronger Europe for their own well-being.
Ian, at Eurasia Group, you take a global look at a lot of these things. Are there trends you're seeing more broadly? Now we're seeing it in France and in Europe to some extent, a rise of populism, often on the left and the right, not the center. I could argue that you might have seen something like that in India, where Mr. Modi won, but it wasn't nearly what we thought it would be, in part because some of the less fortunate people didn't like what he was doing. Certainly back here with Donald Trump, is there a rise of masses who are fundamentally displeased with their economic situation?
And not just their economic situation, but yeah, you're seeing incumbents are getting weaker. Generally speaking, you're seeing a strong push for change elections, except in the small number of countries where the leaders were really seen as being themselves very, very supportive of local working and middle classes. So Mexico is the exception because Mexico's Morena party was itself the anti-establishment party that went against the business oligarchs and the traditional parties that controlled Mexico to support the poor, support Mexico's South. But otherwise, you're seeing underperformance for the ANC in South Africa, for Modi's BJP in India, in France, soon in the UK, and perhaps in the United States. David, all of these countries, places where higher inflation, anger about migration, and lots of disinformation in the country that is polarizing and angering people makes them feel like their countries are on the wrong track. And when lots of people feel like their countries are on the wrong track, they want to throw out the people that are running the government. And that is absolutely something that is a principal challenge for Joe Biden as we look ahead to November.
And that, of course, was Ian Bremmer. He is Eurasia Group president and founder, alongside our own Wall Street Week host, David Weston. And you can tune into Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
One of the world's most prominent technology ETFs is set for a major rebalancing. Joining me for more on this ETF Friday is Bloomberg's Emily Rufeo, sitting to my left. So we're talking about XLK here. And first of all, just set the scene for us. What currently is going on with NVIDIA and its weighting to NVIDIA?
So XLK has only about a 6% weight to NVIDIA. It's the third largest holding in the ETF, but the two other larger holdings, Apple and Microsoft, have about a 20% weight in the fund. You can see on that graphic there, it really drops off when you go to the third holding. This is due to the kind of wonky, we'll call it, index and diversification rules that basically govern the ETF. And what it's meant is that a lot of the investors in XLK have really not captured most of NVIDIA's exposure this year. Its rally this year, that ETF is only up about 18% year to date, which
pedestrian.
Right, it's not that bad, but you'd think it would be a lot more given the fact that NVIDIA is up about almost 200% this year. When you look at the benchmark index, the S&P Tech Index, that's essentially seen as the gauge of like how are tech stocks doing in the S&P 500. That's up about 30%. So this ETF has really underperformed the benchmark gauge for S&P Tech.
Yeah, it's pretty wild that that big drop-off that you see in the allocation, as we just saw, that's by design. And of course, like you mentioned, the investors in this ETF, I would imagine they're a little bit frustrated. It's the Technology Select Sector Fund. You would expect that you're getting tech exposure. But even still, it's kind of up in the air whether we are going to see that flip-flop between Apple and NVIDIA.
Right. So a number of analysts, Chris Harvey at Wells Fargo, our ETF analysts at Bloomberg Intelligence, have now predicted that when the S&P indices rebalance at the close today, we could see a flip between the weight in NVIDIA and the weight in Apple. So right now, Apple's at about 20%. It would drop down to about the 5% weight that NVIDIA has, and then NVIDIA would get the second largest holding. But these market caps are kind of neck and neck right now. So it's unclear exactly if the rebalance will happen today. It could happen later on in the year. But what we do know is that like you said, this ETF has not exactly given investors the full gains of NVIDIA this year.
Yeah, it's just pretty wild because it meant, again, we're talking about indexes, and indexes imply passive, but even still these index, people who run it, they still have a lot of discretion. What can we expect trading-wise? Because we're talking about a $79, $80 billion ETF, which is pretty big, but you think about the trading volume that goes through these names every single day, and it's pretty ginormous.
According to Bloomberg Intelligence, if we do see this flip, we could see up to $13 billion of selling in Apple and about $11 billion of NVIDIA purchased after the close today. Again, that would occur if we do see the weights in this ETF flip, with Apple becoming smaller and NVIDIA becoming a lot larger in the fund. So a lot of billions of dollars changing hands today.
Yeah, it'll certainly be a lot of fun to watch, again, on this triple witching day, too. Right. Emily Rufeo, thank you so much. And let's take a quick look at these markets right now. Of course, about 90 minutes into the trading day, you take a look at the S&P 500. Man, that looks big right now, that letter. Anyway, you take a look, and it is lower on the day, down about 0.1%. Meanwhile, you take a look At the VIX, it's calming down a little bit. Of course, we have a lot of technical forces in the market today, but you're not exactly seeing that in the VIX right now. And meanwhile, that bond rally that we were talking about at 9 o'clock, it went poof. You take a look at the 2-year yield, it's pretty much unchanged on the day. Now coming up, we have Diana Lee. She is the CEO of Constellation. She joins Bloomberg Technology next. But that does it for Bloomberg Markets. I'm Katie Greifeld, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde's off. This is Bloomberg Technology. Coming up, we'll bring you the latest on the TikTok ban as the company argues the US disregarded its national security plans. Plus, Masayoshi Son announces his vision for an era of artificial super intelligence. We'll bring you the details. And car dealer chaos continues amid a debilitating cyber attack that's upending the $1.2 trillion market. Full coverage coming up. Happy Friday to those of you around the world. This is what markets look like over the course of the week. But remember, we had a market holiday here in the United States on Wednesday. This Friday, the market is facing $5.5 trillion of derivatives that are due to expire, the so-called triple witching. That's having an impact on markets. But right now, there's this conversation around valuations, particularly in some of the mega caps that has seen a really AI-driven rally. Later in the show, we're going to go over some charts and have a brief conversation about one name in particular, Apple. But I'd note this Friday that NVIDIA is down a couple of percentage points, coming off what's been an astonishing rally in that stock, and that is having a factor in the markets. We're also going to talk about Bitcoin, that it's near a one-month low right now. There's a lot going in the market. We'll go in-house to Bloomberg Intelligence to ask some key questions about what's going on with Bitcoin. Let's get to our top technology story. TikTok and its Chinese parent ByteDance are arguing the US government could have put more options on the table and taken less restrictive action than simply banning the app to address national security concerns. In a court filing Thursday, TikTok said that Congress disregarded a 90-page national security agreement that was made with the federal government, in which TikTok argues it offered multi-layered safeguards. Let's get out to DC and Bloomberg's Mike Shepard. Mike, you lead the intersection of tech and politics for us. Basically, what they're saying is we offered lots of options. We offered you technological solutions that we think would have safeguarded US user data, and the only option Congress gave in return was an outright ban.
Well, that's right, Ed. And let's step back for a minute. This TikTok saga has just become such a focus of attention here in Washington because of all it symbolizes. It's not just about the app. It's also about this geopolitical tension between the world's two largest economies and their visions for how governance should be handled. And the concern here in Washington that the Chinese government ultimately could have access to U.S. user data through TikTok's Chinese parent company. Now, TikTok and ByteDance, the Chinese parents, have claimed that their setup, this so-called Project Texas, where they invested almost $2 billion and worked with Oracle to try to set up some sort of a shield and firewall that would keep U.S. data secure and away from any purported prying eyes in Beijing. That was not enough to satisfy U.S. lawmakers. They were aware of the proposal. They were aware of the project. And Senator Mark Warner, who heads the Intelligence Committee, expressed skepticism from the start that that would be an adequate safeguard to satisfy lawmakers' concerns.
It's difficult for users of TikTok, and in this country there are 170 million or so of them, and for the public to kind of get a sense of where we're at. So after this legislation made its way through Congress, legal challenges were brought by TikTok, ByteDance, its parent company, but also the users themselves. When the court filing hit last night, the DOJ came out with a statement and said, you know, the legislation accounts for a lot of the issues we were worried about. A long preamble to ask, Mike, where do we stand? What happens next?
Well, right now we are in that kind of tennis match of court filing. So it was TikTok's volley yesterday, and now we're waiting for the Justice Department to return the serve. They face a July 26th deadline to respond with their own brief papers. And then in early September, we're expecting the appeals court here in Washington to hear this case. And the company is asking for a ruling by December 16th or so that if need be, it can go straight to the U.S. Supreme Court for an emergency injunction if it doesn't get relief here at the appeals court level. So it's moving fast, but so much of it is happening in court. And it will really come down to a handful of judges to decide whether the national security concerns raised by Congress override and overwhelm any free speech concerns and considerations that the company is raising as part of its bid to overturn the law.
Bloomberg's Mike Shepard, Washington, D.C. Thank you so much. Let's get to another story in the realm of social media. New York has become the first state in the nation to place curbs on how social media platforms present content to minors under a measure signed by Governor Kathy Hochul yesterday. Platforms such as TikTok and Instagram will now need parental consent to use algorithmic feeds or notify underage users between midnight and 6 a.m. according to the language in the bill. I want to break that down with the Chamber of Progress CEO, Adam Kovacevic. I was interested, Adam, to read through not just the content of the bill and what it will provide for, but also the idea that New York did this first. What do you make of it?
Well, what I make of it is we know there's concern among parents about kids and teens and social media, and I think that's understandable. Unfortunately, I think that in this case, they went after the wrong target, which was algorithms. I think they got into their head And a variety of critics have focused on algorithmic feeds as being kind of a problem here. And so the bill, as you said, bans algorithmic feeds in services like TikTok and Instagram, YouTube by default for teenagers unless their parents opt them into those algorithmic feeds. And just the problem with this is that I think that chronological feeds are actually going to be a worse experience for teenagers. They're more likely to surface, the last post that might be spammy, clickbait, hate, harassment, and algorithms are actually providing a pretty important role in making these feeds better for teenagers. Usually they're allowing them to curate their experiences. And Common Sense Media, which actually ironically is a supporter of this bill, actually had a survey of teenagers about 2 weeks ago where they said most teenagers are liking, or actually use curation in their feeds. And unfortunately, this bill kind of will do away with that completely by default. So unfortunately, I think it's well-intentioned, but it goes after the wrong target, in my view, and I think is likely to make feeds worse for teens.
Adam, the Chamber of Progress, of which you lead, is basically an industry group, but
Right.
your work is to look at public policy and make sure that it is impactful to society in a fair way. So you think that they went about this in the wrong way. How would you have done it differently?
Well, I think what we're starting to see is, for example, this week in California, the Governor Newsom talked about, well, maybe schools should have a blanket rule against phones in school. They're proving to be a distraction. I think there's pros and cons of a policy like that. But one thing about those policies is they're not getting involved in regulating platforms at the speech level. One of the things we've seen, and again, New York's not the first state to do a bill related to social media and kind of content. They've gone about it a little bit differently. But one of the problems that all of these laws have faced, and now this has happened in California and Arkansas and Ohio, every single time state legislators say, well, no, we're not regulating the content of these services, we're regulating their design, right? And that's different. That therefore doesn't run afoul of the First Amendment. Every single time so far, courts have said, no, that's actually not true. You are regulating the platform speech. And I expect the same will be true here. So I think we have kind of this dynamic where this bill feels really great to Governor Hochul and policymakers who pushed it, but it will, in my view, inevitably be struck down in court. And then I think, we'll be right back where we started from. So unfortunately, I don't see a lot of legislators saying, look, how can we approach this in a way that is really like constitution-proof, legally sound? They've asserted that it is, but I don't think this will be in the end.
Adam, I want to go back to the latest on TikTok that our editor, Mike Shepard, was giving us from DC a few minutes ago. This is not a new conversation for you or I. The idea that TikTok and its users have frustrations that they feel they put forward technological and policy solutions that would have allowed TikTok to continue to operate in this country. And they feel the only option that they were given by Congress was a ban. What did you make of the court filing which hit last night?
Well, I think what TikTok is trying to do in their court filing is they're trying to address what's called sort of the least restrictive means, right? Which is to say that if you're concerned about TikTok and Chinese connections, for example, is there some other way the government could have gone about addressing that concern short of passing the law that it did? And that's what their Project Texas is all about. And that is legally relevant at this stage because that is an actual principle under the law. And so I completely understand why TikTok is doing it. I have a concern about TikTok and Chinese control, but I understand that. And ultimately, right. I actually think it's kind of a jump ball. I think whether or not TikTok succeeds in its legal challenge is truly a legal jump ball. And so it's completely understandable to me that they would make that argument.
But what is the Chamber of Progress's position on whether TikTok should be able to operate in the United States?
We haven't taken an organizational position on it. I think that I share a lot of concern that this is a really unprecedented situation where an app that is so popular, frankly, has this nexus and really is obligated to advance the Chinese government's interests. That's always been a concern for me, more than the data concern, more just kind of like the idea that look, after Russia invaded Ukraine, we look back and said, why did we allow RT, Russia's propaganda network, on our cable systems? And I think I feel the same way about this.
Chamber of Progress CEO Adam Kovacevic, thank you. An intense start, actually, to this Friday's Bloomberg Technology. Coming up, we're going to be joined by Fiona Sinkota from City Index. We're going to dig in on markets. But at the top of the show, I mentioned valuations. And here's a name where valuation is a concern. Palantir, the stock down 4.8%. Biggest drop since May 7th as it stands. Brian White, an analyst over at Monness Crespi, basically saying it has a gluttonous valuation. And he's pretty concerned about like these software names with a higher multiple, and is worried about earnings season. But there had been a lot of momentum behind Palantir because of its AI story. We will continue to talk about valuations throughout the hour. Stick with me. I'll be right back. This is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Okay, you're about to be looking at the US listed shares, or ADRs, of SoftBank, the Japanese tech conglomerate. Kind of like Japanese trading overnight, down the most in about 3 months. Overnight, founder Masayoshi Son pledged to help create AI that's thousands of times smarter than any human. At SoftBank's annual meeting, he outlined a future that's built on SoftBank's investment in the chip design firm ARM, and argued that ARM's technology will go into a thriving ecosystem of robots and powerful data centers. And at times, Sun was visibly emotional, talking about his goal of realizing artificial superintelligence.
It may sound strange, but I think I was born to realize ASI. I am super serious about it. I think ASI will continue in the next 10 years. It will be 10 times smarter than humans.
So SoftBank's Japan-listed shares are up almost 60% this year, and the net asset value of its holdings has hit $214 billion, largely on ARM's performance and a turnaround in some of its startup bets. But activists are circling. Elliott Investment Management has built a stake in SoftBank of more than $2 billion and is calling for buybacks. Sun brushed off questions and pleaded with investors to, quote, root for him as he chases his dream of artificial super intelligence. Joining me now to discuss the markets and a bit about SoftBank is Fiona Sinkota from City Index. I mean, what was so interesting about this kind of spectacle almost in SoftBank's annual meeting is Masayoshi Son wanted to talk about the big picture, ASI, but investors wanted what investors always want: dividend, buyback, stock split. What did you make of that?
Yeah, completely. You know, I think it's quite an interesting because it sort of almost brings up about a change of strategy for SoftBank from this sort of defensive position that I think it has had over the past few years to a much more offensive position as we have this really ambitious vision from Sun about ASI and the future of AI and what that means for for SoftBank. But I think you can't get away from the fact that at the end of the day, investors do want to have returns. They have seen strong gains on the share price. You know, as you pointed out, we've seen a 60% rally in the share price so far this year. That obviously comes on the back of a 124% rally in ARM Holdings. But, you know, at the end of the day, yeah, investors want to see what those numbers are bringing back, and they want to see, you know, share buybacks. That's going to be useful for them as well. Although, as we said, you know, the share price growth has been strong.
It's hard to pick out what the prevailing factor is in the market right now. You know, at the top of the program, we talked about the concern with valuations. Nvidia is trading at 45 times 12-month forward earnings. We're going to look at Apple's valuation later in the program. And then if you take the SoftBank example, like many investors, to summarize, there just seems to be a wholehearted belief that you have to be in AI at all layers of the stack, and if you're not, you'll be left behind. So which comes out on top?
Yeah, you know, I think we can't get away from this idea that AI has really driven such a strong rally in AI stocks, and obviously that's sort of bled out into or transferred out into record highs in the S&P 500 and on the NASDAQ this week as well. So, you know, I think at the end of the day, there might be this sense that perhaps the AI trade right now is a little bit overhyped. But I think over the long term, that's just not the case. And that's the sense that investors are having. You know, we're just really opening the door to the realization and the understanding of what the real world applications of AI actually are. And that's what's really supporting the rally that we have seen. So, you know, although, as you mentioned, there are some suggestions that there could be some level of lofty valuations involved here, I think at the end of the day, the long-term case is very bullish as far as AI is concerned. And that's really supporting the share price. Obviously, we're going to have some pullbacks. You know, no rally is just 100% higher.
Sure.
But I think, you know, investors are in. They're in on this case.
We just showed Nvidia, it's down 2% in the session, but over the course of a week where it became the world's most valuable company, it's down a percentage point. Is this rally over?
Yeah, do you know, it's just a very small move lower after some very strong moves higher. You know, this month so far, Nvidia's up around 16%. Had impressive gains last week. I mean, I don't think the rally can necessarily maintain the speeds that it's had, because it has been a really impressive speed that we've seen this share price rocket. You know, it's up 170% so far this year, and that's not maintainable. It's not going to be maintainable, but I don't think that's to say that the rally's over. I think we could just perhaps potentially expect it to slow to a more sustainable pace going forward.
Fiona Cincoto, City Index. Happy Friday. Have a fantastic weekend. And thank you for joining us on the show. Coming up, OpenAI makes its first big and genuine acquisition. We're going to bring you the details next. Be right back. This is Bloomberg.
Trends in Tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
It's time for Talking Tech. And first up, former President Donald Trump finally appeared on the All In podcast. After a month of teasing, the podcast, co-hosted by David Sachs, Chamath Palihapitiya, covered a range of topics, including real estate, the war in Ukraine, and artificial intelligence. Trump defended his tariff proposal, saying it would be crucial to keeping the dollar the world's reserve currency. Plus, Huawei nears 1 billion active devices. The Chinese tech company saw sales of its smartphones climb 72% in the first 5 months of 2024, growing the number of Huawei's gadgets, which also use its operating system, to over 900 million. The latest figures underscore how the US sanctioned company is taking on the likes of Apple in the Chinese market. And Indian grocery delivery startup Zepto is preparing to go public. This after the company more than doubled its valuation to $3.6 billion from a financing round that was led by US and local investors. The company says it's on track to handle more than $1 billion in goods a year and plans to double its warehouses to more than 700 by 2025. Also, car dealers aren't the only ones to be hit by recent attacks. The data of QuoteWizard consumers, a LendingTree subsidiary, are being sold off by hackers. Unauthorized access was detected on a cloud database hosted by Snowflake. LendingTree shares are down as the company continues to investigate the size and scope of the hack. All right, let's get some M&A. OpenAI has bought Rockset, an enterprise search and analytics startup, marking the most significant acquisition to date for the high-profile artificial intelligence company. Joining us now, Bloomberg's Shireen Ghaffari. So this was kind of interesting. The terms won't disclose. We don't know how much money was involved, basically. But it's kind of new and novel for OpenAI. Give me the details.
Right. So this is the first time that OpenAI is acquiring a company where they're not just taking in the talent or doing what's called an acqui-hire, but they're actually going to integrate the technology as well, which makes this significant.
What I don't understand is, why does OpenAI need a company like Rockset? Like, what's the point?
Well, if you think about it, OpenAI is really right now trying to grow not just their consumer, but their enterprise business. And this is a company that has experience working with major customers across industries, from finance to gaming. One big one that I saw in previous reports was JetBlue, for example. And what they do is actually work with customer data to help those customers index and search through that data. So, if you kind of put two and two together and think about where OpenAI is trying to grow their business, it might make sense that they would go acquire a company that's specialized in dealing with this kind of more detailed business data to help them build that out.
Bloomberg's Shireen Ghaffari, I have to say, it's been a tremendously busy week for you, all across the AI beat, from Anthropic to OpenAI, and a lot going on in enterprise as well. Happy Friday to you, and have a nice weekend. All right, coming up, we're going to discuss the recent cyber attacks on CDK software with Diana Lee from Constellation. The team over at Bloomberg News has done an incredible job of basically wrapping up the past 48 hours events on CDK. But what does it mean, bigger picture, in a cybersecurity context? What does it mean for a massive industry for the buying and selling of vehicles? We're about to show you some beautiful pictures. Stick with us. We'll be right back. This is Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the This is Bloomberg.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco. So I've been talking about valuations, and there's one chart that I saw this morning on the terminal and on Bloomberg.com that I wanted to share with you, and this is it. Apple trading at around 30 times forward earnings. And there's been a rally in Apple shares driven largely by artificial intelligence, the idea that we now have a clearer understanding of Apple's AI strategy. A lot of concern from both the buy side and sell side is, well, when does that strategy pay off? If you look at Bloomberg estimates for top line growth, there is some recovery in the second half 2024, later in the year. But as the chart behind me shows pretty clearly, when Apple gets to a level of trading at 30 times forward earnings, it historically finds it really hard to sustain that level. And this is a conversation that's happening quite a lot across the mega caps, where we're trading. We keep referencing NVIDIA trading at 45 times forward earnings. There's going to be loads of you out there. Contact me on X, LinkedIn, Instagram. You're going to say, oh, well, look at top line growth of the two. You can't compare. But I'm just saying this is a chart that's got a lot of investors talking. And we're happy to share it with you on Bloomberg Technology. Okay, let's get back to cyber security and hacks. Checking in on shares of all the automotive companies. Lots of the car dealers, lots of the retailers, and you can see some downward pressure sustained. AutoNation down 0.4%, Group 1 Automotive down 0.5%, Penske kind of stabilized, and there's a warning. CDK is the company that basically operates the software platform, and they've warned their customers that their platform's going to be down for several more days. It's crippling car dealers across the United States amid a cyber attack on the company, the second round of which was felt on Thursday. Joining us out of London is Bloomberg's Craig Trudell, who's our global autos editor. And Craig, you're joining us from London. This attack was in the US and Canada, but you've kind of been leading the team that's been covering this around the clock. And the impact on this industry has been very big. We got a news story out on the terminal this morning. Just summarize it for us.
Yeah, I mean, this came at a really inopportune time on the Juneteenth holiday. For car dealers, a day when a lot of their customers or would-be customers, have more time to go through the rigmarole of buying a new car or getting their current vehicle service. For their software system to go down has been extremely disruptive. We also have, an end of quarter push that we're in the midst of, which, retailers do want to sort of close deals before the end of the month, before the end of the quarter. So this has been a really disruptive attack because there's only a handful of these companies that provide these dealership management systems that CDK is one of the leading providers of. So for them to go down and not be able to sort of provide those services for their many customers really has thrown a wrench in things. So we're hearing from dealers about, having to close deals with pen and paper as opposed to, going through their computer system. And, it already takes time to close deals, as we know. It's not, even in the year 2024, a seamless process. This is only throwing sort of more of a wrench in things.
Pen and paper. I don't even know what that is anymore.
Stone Ages.
There is a serious side of this that, in the US and Canada, if I'm a consumer and I'm participating in this end of quarter sprint to get myself a new vehicle, what are the brand names involved, those impacted? I think I read Subaru and maybe Toyota.
Yeah, Subaru and Toyota, at this point, at least out of Japan, have sort of downplayed this for us. And we are touching base with them in the U.S. and have heard from the likes of Ford and Volkswagen, Mercedes, BMW. All of those last few companies I mentioned have confirmed that their dealers use CDK. They're not necessarily being particularly forthcoming at this juncture about how many of their dealers are affected. But this is a substantial number because, again, this is a space, a sort of sliver of the auto retailing industry where there's been a lot of consolidation over the years. So you only have a handful of companies that aren't necessarily household names that provide this really important sort of, piping that makes everything work. So, we've heard again from dealers also talking about challenges with lining up credit, having to sort of, themselves make judgments as to whether or not, somebody is worthy of a loan by sort of cobbling together what information they can. Parts repairs and not being able to sort of confirm whether or not a part is available for a customer who has a Jeep, say, in the shop. So this is just causing a mess. And so if you're a consumer, I guess the general sort of takeaway here is if you're planning to go to a dealership this weekend, maybe hold off on it and wait until the storm passes.
Bloomberg's global car editor, Craig Trudell, great to have you on the program. Thank you. Let's bring in somebody who knows the automotive space very well. Diana Lee is the CEO and co-founder of Constellation, the leading marketing technology and data intelligence company in the automotive space. Personally, have 3 decades of experience in the world of cars. And, I think what our editor, Craig Trudell, set out is that the timing of this hack is bad because the industry is under so much pressure. What are you hearing from clients, customers, and those you work alongside?
Absolutely. It's just mass chaos at this point. I've been in the auto industry since 1989 and also in retail automotive. In all of those years, I've never seen a DMS operating system down. The dealer requires to actually run a DMS for sales, service, parts, for every single functionality, even stocking in a vehicle you can't do without the DMS system. So it is a disaster. I feel like it's even worse than COVID when it first hit the dealerships because you're not functioning at this point.
So what you just said really jumps out at me. Worse than COVID, the impact, because I remember covering that. That was my beat, March 2020, working for Craig, who was my editor. Let me ask you this. If you were advising CDK and telling them what to do to manage this fallout, what would you suggest?
I think it's printing services at this point. I know that sounds so crazy, but at this point, nobody can actually just have a DMS pop up overnight. So there's only two other DMS providers that are really known in the automotive industry, and it's Techion and Reynolds. So there is no way that either one of those companies could start uploading any type of DMS system for any dealers that are down. But printing services is what basically anybody can do right now, right? Which is loading up the printing services to allow dealers to be able to hand print contracts as well as all the ROs, repair orders that need to happen right now. So we're going back to ancient stages right now where this is what we need to do is print.
We joked with Craig about the use of pen and paper, something we will do a lot less in this day and age. There's a serious side of it, though, right, which is the consumer and the consumer psychology. You have very high interest rates. Buying a vehicle, or even leasing a vehicle, is your biggest financial consideration after your home, normally. And we have, 9 days left of June. Do you think this is going to have a really big impact on sales in the sprint to the finish of the quarter?
It's absolutely going to. And I think the only way that a lot of these dealers can actually survive right now is if they have friends of theirs that already have a Reynolds or a Techion system where they could tell them what the deal structure needs to be so they could actually put something together, at least fax it to them, email it to them, and then you're going to have to handwrite every single contract at this point.
Right.
But the only way, and I think dealers that are super innovative, they've called me and they said, I'm limping right now, limping. I mean, this is some of the biggest dealerships in the country that sell 1,500 units a month. Their service departments are limping at this point, but obviously they're like fighters. And I love that about dealers because in many ways, think of all the employees that basically are also under fire. But if the auto business goes down, and this is why I really fight for dealerships out there all the way across, it's all the Americans that would also be out of jobs if we always go direct to consumer plans. And
so let's discuss modernizing then the dealership model, right? I just leased the Model Y a couple of months ago. I did it through the Tesla app. My credit was approved through the Tesla app. I took the wing mirror off after 2 weeks. It was fixed through the Tesla app. Is that something that the industry needs to move toward?
I am not actually a fan of the Tesla model in the sense that basically I understand this is a direct-to-consumer model that makes it easier for customers to buy a vehicle. But on the other hand, I think that the traditional automakers have to improve the customer process, but within it, there's so many people that actually support the automotive market. Think of all of the families and the communities, as well as the little leagues and all of the different types of charities within every community that gets supported by a local dealer. All of that goes down if basically we all decide, hey, we want a direct-to-consumer model. What happens to the Americans that will be out of jobs right now if everything went straight direct-to-consumer? And for me, I really do believe in that community atmosphere where we come in, we get to know each other, we get to actually service our vehicles, but get to know the people within the organization that support those communities. So I think there's different types of people out there that that purchase vehicles, but there's many types of customers out there. They must test drive the vehicle, look at the vehicle, know the color and the exact model that they want before they actually make a purchase. And those are not ideal for customers that are direct to consumers.
Diana Lee from Constellation Agency, just great to have you back on the program. Thank you so much. Okay, coming up on Bloomberg Technology, we're going to talk about investing in artificial intelligence with Shardul Shah of Index Ventures. That's coming up next in our VC Spotlight and private market focus for a minute. This is Bloomberg Technology.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
One of the things I really get excited about, because I'm a labor economist by training, and I think a lot about the distribution of opportunities across the nation and the world, and I think of AI as potentially being a great leveling the playing field, democratizing the expertise by giving people a hand up or a leg up in terms of starting.
That was San Francisco Fed President Mary Daly weighing in with her thoughts on the impacts of artificial intelligence. And I want to get more on that space with our VC Spotlight and bring in Shardul Shah, a partner at Index Ventures. And Shardul, it is June 21st, as I've just learned on Google and Wikipedia, summer solstice, the official start of summer. And I'm going to start this conversation by asking you, are we in the private markets in an AI winter, an AI spring, or an AI summer?
First, thanks very much for having me.
That's my pleasure. It definitely feels like summer. The sun is shining in venture land, not only in AI, but outside. AI is definitely bringing a draft and a windfall to different industries, including cloud and cyber. And it's led by public market companies. If you look at a cloud derivative like Datadog, which I've served on the board of for 10 years, they're definitely seeing acceleration in underlying markets thanks to the cloud. And use of AI driving increased compute and increased use of data. Second, in private markets, we're definitely seeing market-leading companies like Wiz and Databricks see acceleration in their business thanks to AI. So definitely the VC environment is talking about AI.
I want to look at deal activity in the private markets. You just mentioned that the AI summer that we're in is kind of led by public names, and throughout the hour we've talked about the concern around valuations. But deal activity in the private markets is really interesting to me, globally and at all stages. Like I'm seeing quite a lot at the growth stage as well. Do you see that, and what do you make of it?
You're right. We're seeing increased activity this year across geographies, across stages. Again, outside of AI, half of the investments that we've considered at Index in this year are in categories including gaming, in fintech, and cybersecurity. So the sun is definitely shining outside of AI. Second, to your point, it's at every stage. We've seen seed investments, early stage Series A investments, as well as growth stage opportunities in and outside of AI. So deal activity has definitely picked up this year.
You've put a lot of emphasis on security, cybersecurity names. Wiz is one of your portfolio companies. You are significant on the cap table of that company. Why? Why is cybersecurity such a focus? Loads of people come on this show, actually, at the moment and put forward cybersecurity as the area that they're most excited about getting a boost from AI.
Yeah, cybersecurity is one of the hottest sectors in tech, so it's no surprise that you've had many guests come on and talk about it. If you step back, there's about $250 billion of market cap amongst the top 4 security publicly traded companies. This is CrowdStrike, Palo Alto Networks, Zscaler, and Cloudflare. 10 years ago, the top 4 probably represented less than $50 billion of market cap. There are 4 drivers over the last decade that have driven this growth. First, we're seeing every single day a new global attack. I think on your show you've been talking quite a bit today about CDK Global, which is just the most recent example. Second, the SEC now has disclosure requirements for publicly traded companies. Third, chief security officers are under scrutiny and are being held accountable for fraud. And fourth, we're seeing hackers actually tell the SEC when they've created a material breach. As a consequence, we're seeing an enormous amount of activity in private markets. We've seen an explosion of startups. There's now over 10,000 companies that are trying to build new businesses to meet the needs of customers. At Index, we focused on kind of 2 primary themes. One are founders that are obsessed with the problems of their customers. And second, founders that are looking to build coherent platforms to meet the needs of organizations. Just as one example, to your point on summer, I feel like every small and medium business in the world should have insurance. Without insurance, it's like going to the beach without sunscreen. You're bound to get burned with enough exposure. And so we invested in the category-leading cyber insurance company, Coalition, which is addressing the needs of small and medium companies. On the other hand, enterprises have been served by large and growing security companies for over a decade. What's different now is the requirement for a coherent platform versus kind of a Frankenstein that acquires their way to creating a collection of solutions. And therein lies Wiz, which, to your point, just started 4 years ago, but has become the fastest growing software company of all time because of a strong point of view on a product that meets the needs of customers.
A lack of cyber security is like going to the beach without sunscreen, which on this, the official summer solstice, and the AI summer we're in, is an interesting point of view. Shardul Shah of Index Ventures, great to have you on the program. Thank you so much. Right, coming up, we haven't talked about it much since the top of the show, but Bitcoin reaching its lowest level since May. As risk appetite subsides, we're going to go in-house for this one with Bloomberg Intelligence. Be right back. This is Bloomberg Technology.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Bitcoin slumped to a more than 1 month low with this year's record-breaking rally showing signs of fatigue. In the absence of, frankly, fresh market catalysts, let's break it all down with Bloomberg Intelligence Analyst, James Seifert. It's been a long, short week for me. I'm trying to think about what's going on. Like, in the markets, generally speaking, maybe some risk appetites come off the table, triple witching, but there is this kind of close or opposite correlation with the equity markets. That's what I've read. What's your analysis?
Yeah, I mean, no matter how you look at it, I don't even know what the word is, the appetite for Bitcoin exposure has slumped. A lot of people were talking about trying to understand. So the last few weeks, we saw billions file into those Bitcoin ETFs, and the price really wasn't moving. A lot of that we think had to do with like potentially futures trading and basically arbitrage trading with the futures market. But the last 7-ish trading days, we've seen a total of about $1 billion flow out of the ETFs. Risk appetite on the crypto markets has kind of slumped off. I mean, if you look at all the altcoins and all the stuff that we don't really tend to talk about, those have been far worse than the likes of Ethereum and Bitcoin. But what we're paying attention to right now is we're expecting those Ethereum ETFs to get approval at some point from the SEC, over the final approval to launch at some point in the next couple of weeks. I think there's just kind of a malaise going on in the market right now, and it's pretty standard. I mean, honestly, everyone's used to these massive run-ups, but also there's corrections and turnbacks at different times.
That's the functioning of the market. I still follow the headlines a lot. One that hit last night was that MicroStrategy had used the proceeds from a convert to buy $786 million of Bitcoin. And we've reflected a lot in the last few weeks, like it's quite a liquid market, and correct me if I'm wrong, but does a headline like that have impact on the market at large?
It used to. I mean, when Michael Saylor was announcing and MicroStrategy was announcing these massive multi-$100 million buys of Bitcoin, it was impacting the markets. I think it kind of almost shows the maturity of the market that they finished this closing of those converts and then just dumped $780 million or whatever, I don't know the exact number you said, into the market over the last week or so, and the market is still down decently off its all-time highs, almost $10,000 off its all-time highs. And I think that just shows the liquidity and depth of this market at this point, as far as I'm concerned.
$786 million was the number that I said. Bloomberg Intelligence Analyst James Seifert. Happy Friday. Thank you. Appreciate the breakdown. That does it for this edition of Bloomberg Technology. It was a short week in the US. Wednesday was a holiday, but a busy week all the same. Recap the podcast. get involved in the pod. Find it on Apple, Spotify, iHeart, and the Tech Pod is also, of course, on all the Bloomberg platforms. It's good to be back here in San Francisco with you. A big week coming up next week. AI, Bitcoin, space, all of that's to come. There's beautiful San Francisco. Happy Friday. This is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, the debate on the timing of a Fed rate cut rages on, while the data shows some strains in the economy, and we'll discuss how all of this might play out in the credit world. But we begin with the big issue, the data driving the Fed's decision.
The market this week wants better data. It wants to be assured that the economy really is strong.
The economy is moderating, but very slowly.
We're getting that modest slowing in the economy.
That'll be music to the Fed's ears.
In general, looking at this all very holistically, it's really going the way that the Fed would like it.
What Fed
speakers need to do is to double down on their commitment to inflation stability and targeting inflation.
I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data.
I think the market recognizes what the Fed is trying to do. I think the market recognizes that the Fed is going to be data dependent.
Retail sales certainly supports the consumption side of the economy being weaker than what we've seen.
Downward revisions a month later that show a different picture when it comes to retail sales.
The market more concerned that maybe the Fed is more backward looking and not interpreting, not fully appreciating some of the recent slowing of some of the data.
Backward looking can be very dangerous in an environment where you have a lot of noise in the data.
There are a lot of questions out there about how the current level of interest rates is starting to impact the economy moving forward. And let's take a look at existing home sales data to begin with here, because the red line here is the month-over-month decline that you've seen recently in existing home sales. Now, they've fallen for the third straight month in May, particularly as prices hit yet another record, yet mortgage rates have fallen to the lowest rates since early April, declining for the third consecutive week, which can show you exactly what it means for investors to start taking their foot off the pedal here in terms of how high interest rates are and that ripple effect through the economy, particularly the mortgage market. Now let's take a look at the consumer, credit cards here in particular. According to Bloomberg Intelligence, delinquency rates could be reaching a peak, and this is across a couple of major issuers: Amex, Capital One, Discovery, Synchrony, and of course these are where you typically see lower FICO scores here. You did see delinquencies start to come down by April, and though they've started to fall, there's a question as you see the next couple of weeks as the banks start to report earnings, just how much they will continue to fall as interest rates may indeed remain a little higher than expected this year. Now, there's a question of when that first rate cut will be. Lazard CEO Peter Orszag spoke with Bloomberg earlier this week about the Fed's path ahead.
I don't think it matters how many cuts happen this year. I think what matters is that first rate cut is indeed a light switch, because what that signals is the Fed believes that it has won the war on inflation, and so it's all downhill from there in terms of rates.
And joining us now is Allspring's George Bory and JP Morgan's Oksana Aronov. And you heard it there from Peter Orszag, this idea that it doesn't necessarily matter when that first rate cut will be. Do you agree with that, Oksana?
Well, I think that the first rate cut, to the extent that it will be, let's say, a 25 basis point rate cut, that the Fed has kind of backed itself into a corner where they kind of have to deliver it at some point because they've been talking about it for so long. It really doesn't matter, because we're in a world where the Fed, the yield curve in the U.S. is so deeply inverted. What is that going to do when the 10-year is already in the low fours? Furthermore, I think you have to study history, and when you do that, you see that in the late 90s, for example, in the second half of the 90s, the Fed did execute a couple of cuts, and then they kind of held off. And you had elevated rates between 4.5% and 6% for a number of years. So I don't think the Fed cutting for the first time really is a long-term signal of anything. They are going to have to be data dependent. They tried not to be at the end of last year. It didn't work out so well. And I think they're going to tread carefully here.
George, relative to market consensus, where do you think that first cut will be, and how many do you think we can reasonably achieve this year?
Yeah, no, as Oksana mentioned, the Fed really has painted itself into a box by trying to preempt its move at the end of last year, and now they are acutely data dependent, which means we need several months of data to validate both a downtrend in inflation and then some degree of moderation. So our view is that they will have that level of data. It will come at somewhat of an awkward time given the upcoming election, the upcoming presidential election. So that may influence timing, but we think by the end of the year, they will have sort of air cover, if you will, to cut rates at least once. The question of whether or not this is a cycle shift, in that they are actually going to be moving rates down systematically over an extended period of time. Again, as my colleague just mentioned, it really will depend on where the economy sits. If it's purely in reaction to moderating inflation, then a few rate cuts and wait, that might occur. But if it's really in response to both moderating inflation and weaker data that's showing a downtrend in activity, then we can expect a rate cutting cycle. That is more, we're more in the latter camp than in the former. But we, like the Fed, as they made clear last week, the crystal ball is a little cloudy at the moment. And so we do have to wait to see what kind of data ultimately emerges over the next couple of months. But for clarity, we do expect the Fed to cut rates at the very end of this year, and then we'll see if that's an actual, kind of significant. If we're going to see many more.
George is definitely speaking to something many investors are struggling with right now. It's that mixed economic data you're seeing out there, and if you had to cut through the noise, Oksana, how do you really start to piece together how much room there really is for the Fed to cut, given where inflation is and given the weakening you're starting to see in the economy?
Well, I would contest that you're really seeing a tremendous amount of weakening in the economy, right? What is the Fed cutting cycle really telling us? And when we look at past Fed cutting cycles, what did we see? We saw higher unemployment rates. We saw significantly lower inflation. We would see housing issues. We would see issues with credit card delinquencies, which are starting to actually trend down. And by the way, never impacted the top 50% of income spenders. And that's really where the services and all other kinds of consumption is being driven by. And we saw services expanded this morning, again, I think the largest number in 2 years. So I would contest that we're seeing anything really breaking. And a Fed cutting cycle really is meant to address kind of meaningful breakages. And I think outside of something breaking here, I don't think there is any impetus for the Fed to do anything. And I think investors should really tread carefully around what is priced in. Right, so when they're looking at the 10-year at 4.2 or wherever it is today, really still priced for a 2% inflation world, is that really the world we live in, right? What is priced in? When they're looking at credit spreads that are razor thin, you guys wrote this morning about high-yield investors buying investment-grade credit debt because the spreads are so minimal between the two. Junk bonds are sitting within 1% of 3-month T-bill yields. So what is priced in when you're buying these junk bonds, right? Why are you taking on that risk? And is it really going to reward you in a world where rates may actually move up if there is a continuation of strong growth, or if there is that kind of falling off a cliff and the Fed has to cut? Credit is equally vulnerable to both of those scenarios here. So I think that's really the important question, is what is priced in?
Hold that thought on the prospect of rates actually going up from here. You brought up this interesting point here about the inverted yield curve. The 210 curve is actually more inverted today than it was to start the year. George, what is that telling you?
Well, I think it's telling you that, as we mentioned, that there's signs of a slowdown is starting to emerge, and that the Fed is kind of is boxed in by sticky inflation, so they just have not had the air cover to be able to kind of follow through on the expectations of rate cuts, and the higher for longer mantra is starting to affect the real economy. You are seeing signs of it. It's not broad-based. It's not extensive across the entire economy, but the most interest rate sensitive parts of the economy are starting to show signs of strain. The relatively high real cost of debt capital for borrowers, both on the public side, the private side, individuals, corporations, is starting to kind of change activity. And we think that the bond market in particular, is starting to get anxious or a little bit concerned about those growth expectations going forward, particularly as we get towards the end of the year and we get through our own election cycle.
Going back to that higher for longer narrative here, what would cause interest rates to move higher from here, Oksana?
So if you look at where unemployment is, where, again, housing is, right, where a lot of these sort of standard economic indicators are, where the stock market is, because we know that the Fed is watching it, even though it's not really part of their mandate. None of these things are really making for a start of a cutting cycle. If anything, perhaps the conditions for hike are in place. And I'm not saying the Fed is going to hike. I think the bar for hiking is quite high. But certainly, I think kind of basing a strategy in a bond portfolio, for one, on aggressively lower rates from here, again, outside of something breaking dramatically, is really not going to be successful. And the curve has been inverted for how many years now, right? So I think it's really hard to talk about the forecasting sort of capabilities of a curve when you have $7 trillion of bonds still on the Fed's balance sheet, right? We only had, what, 2 to 3 on the back of the financial crisis, and now we have several times that. And imagine what would happen if they did decide to actually taper meaningfully. So I think the predictive functionality or the predictive function of the curve is very much in question here.
Oksana sticking with us. That is Oksana Aronov and George Bory of Allspring. Now, to bring you some breaking news also that has been crossing the wire in the last couple of minutes, 4 of the biggest banks on Wall Street must improve their blueprints for a hypothetical wind down after the top U.S. regulators found weaknesses in their plans. The FDIC and the Fed reviewed the most recent resolution plans, also called living wills, which were mandated following the 2008 financial crisis. The regulators didn't identify specific weaknesses in the plans. The finding of a shortcoming doesn't result in bank penalties necessarily. They need to come up with new plans by July of 2025. Of course, this is JP Morgan, Bank of America, Goldman Sachs, and Citigroup, all found with shortcomings by regulators just days ahead from a Federal Reserve stress test. We'll bring you more later in the hour, but for now, stick with us. This is Real Yield on Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the auction block. Issuance all around saw strong demand this week. We'll start with Treasuries, focusing on the 20-year reopening sale, which saw the primary dealer award at the lowest on record since the tenor was reintroduced in 2020. The bid-to-cover ratio topped the average. And in corporate credit, Home Depot sold $10 billion. The deal saw as many as $47 billion in orders for the 9-part deal. It highlighted a week that saw $31 billion of debt sold, topping projections. And in high yield, Hertz works to bolster its balance sheet with a $1 billion capital raise. As part of the offering, it priced $750 million of first lien secured notes at par to yield 12.625%. And when it comes to credit, KKR's Chris Sheldon spoke to us earlier in the week discussing the potential for a wave of defaults.
We do envision increased defaults, increased downgrades. However, it's not sort of Armageddon in terms of a big spike of defaults. Not seeing like dramatic forced selling. I would say that when things are going into a default or things are really in dire, you see some more forced selling. But right now, it's not, Armageddon forced selling right now.
Joining us now is Ken Monahan, Managing Director and Co-Director of High Yield at Amundi Asset Management, and still with us, Oksana Aronov from JP Morgan Asset Management. And you hear KKR, propensity here to lean into triple C's, but then you have the spread problem. And so the question is, do you buy at spreads you're seeing right now, Ken?
Spreads are clearly tight, and it's hard to go out and say buy the entire market at the moment. I think you need to be very selective. Chris is an old friend. I've known him for a long, long time. And I agree with him that there is credit risk in the marketplace. I don't, however, happen to see the likelihood of a major increase in defaults in the next 9 to 12 months.
Now, it's interesting, Oksana, you made this point earlier about how you're not really getting much bang for your buck over treasuries. So why go into credit risk at this point in time?
That's my question. Why go into credit risk at this point in time? Double Bs, many double Bs, which is the highest kind of quality of junk, if you will, have a 6 handle on the yield, and you can earn almost as much in the 3-month T-bill. So why would you go into junk? But I think even perhaps more importantly, we typically, investors, associate growth with strength in credit. And our base case is that the economy will continue to do fine, will continue to do okay. These rates obviously are not tremendously restrictive. However, if we do continue to see growth, that means a higher for longer environment, which will make it more difficult to refinance. You know, that 12.6% rate that Hertz is refinancing at, that wasn't the case 4 or 5 years ago or even 3 years ago, right? That's going to continue to bite. Furthermore, if the strength actually somehow accelerates and you have higher rates, that is going to take a bite out of credit. And we've seen on dates when rates move up significantly, or even looking back at 2022 when rates caused all those losses, they caused them across the board. Because when spreads are razor thin, you just don't have the cushion there.
Now, how do you think about this in terms of potential interest rate cuts, Ken? If you see one this year, what does it mean for the money that might flow into different parts of the credit market?
I think, as Oksana has pointed out earlier, one of the issues that you look at it and you say to yourself, if I get one rate cut, where am I getting value at the moment? I think if we look at the 10-year Treasury, I think it's pretty much already priced that in. So that's why when we're looking at fixed income markets right now, we're thinking to ourselves, there are kind of 3 key watchwords. You know, one is to stay active, because there's very little differentiation in the market at the moment. 2 is to stay very selective, which I commented on regarding high yield. And then I would say the third thing is to stay at the shorter end of the curve, because I think there is more value at the shorter end of the curve. And going out long isn't necessarily going to get you a big pop when rates start coming down, when the Fed eventually moves.
Yeah, how do you feel about the idea of taking on credit risk versus duration risk at this time?
Sort of like trying to choose between 2 foes, which is the better foe. So look, there are times, you know, when we see, for example, the 2-year part of the curve hit 5%, that's a great kind of entry point, and we like that, even though we don't really like taking on duration here for all the reasons I described. I think our 10-year is still not really priced for the R-star, if you will, that we are experiencing as an economy, and I think the Fed will reevaluate their 2% target, which is an arbitrary number to begin with. But having said that, I think you have to really kind of change your lens, perhaps. So when we think about investing, we aim to generate positive returns irrespective of whether the environment is benevolent for bonds or not, meaning whether rates are falling or not. That's a very different prism than trying to lose less money than the index, right? When the index goes down, the index such as the Barclays Aggregate or the High Yield Index, whatever it may be. So my answer to your question comes from that point of view, which is don't lose money first, and then what's the best return I can deliver? And with looking at the market through that prism, where has there value? Where has there been value? It's been at the high-end floating rate on the market, high-quality floating rate. So that very short end of the curve, investment-grade corporate floaters have been great for a while. They're starting to get a little bit richer now, but you could earn, 6, even above 6% just a short time ago, and people didn't really like the floating rate nature because everyone expected rates to go lower, and they're not. So there are definitely things to do. Where has there been value? It's been very inexpensive to hedge credit risk. So to the extent that we believe credit risk will be repriced because defaults are going up, because some of these lower quality operators will struggle, it's very inexpensive to hedge yourself against that credit risk, and we've been taking advantage of that. So there are definitely things to do, but you don't need to be hero now And I kind of take exception with this consensus view right now that everything is great in bond land, extend duration, go buy credit, everything is great.
Everything has seemingly been great in bond land, and even if you don't see a big wave of defaults, let's scenario plan one more time here. We went through the one rate cut scenario, Ken. What if you see no rate cuts or even a hike in the next 12 months?
Well, I'm not sure a hike is in the cards. It's clearly a possibility, but I think the Fed's got a very itchy trigger finger to move the other direction. But if there were no hikes at all, I think the point is valid here that probably says something about the strength of the economy. Now, in theory, Oksana's point is correct, which is that means that credit spread should be doing all right and actually potentially tightening. On the other hand, it's hard to see spreads tightening a lot from where we already are. High yield spreads and investment grade corporate bond spreads are pretty close to their all-time tights, or at least the tights we have seen since the Great Recession. So that implies that there's not a lot of value there at the moment, which gets back to the point about needing to be very selective in this environment.
Ken, in this environment, favorite trade?
Favorite trade. There are no sectors we would point to at the moment where we'd say everything is sweet, okay? So you need to be, again, selective. So we like the airline sector in general, but it's not exactly cheap. But if I'm looking at emerging market airlines, in particular Latin America, there's great value there. We happen to like the casino industry from a fundamental perspective. U.S. casinos tend to be trading at a tight level. We happen to like some of the ones that are in Macau right now. I mean, those would be two good examples of places where we see a bit more value, and yet we see some good credit protection at the same time.
Favorite trade, Oksana?
That is such a stock-oriented question, Sonali. Come on.
There's got to be something that you like without being a hero.
Yes, again, so looking at the market through that prism of, as bond investors, right, it's do no harm first. It's sort of preserve capital first, and then what's the best return I can deliver. I do think there's going to be a significant dislocation. Credit, by the way, does not need to occur against the backdrop of a recession. You just have had so many companies that made it through 2020, for example, that probably shouldn't have and probably won't in their next refinancing cycle. So I think it does make sense to have a lot of optionality in the portfolio by staying shorter duration, ultra short, at the very front end of the curve, clipping that nearly 6% coupon, and then helicoptering out into high-quality floating rate, investment-grade floaters, buying that insurance on credit exposure, trading the curve, right? Where has there been volatility? It's been in macro, and we love volatility, and so trading the curve is another area that we've been active at. So there are many things to do, but I think the bigger returns are out there.
Ken Monahan and Oksana Aronov, we thank you so much. Of course, complicated credit pickers environment. Now, still ahead, the final spread, big week ahead. Investors are awaiting the Fed's preferred inflation gauge and a whole bunch of Fed speak next week. This is Real Yield on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
I'm Shonali Bassick. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up as a week bookended by Fed Speak. Of course, you have Mary Daly and Barkin speaking on Monday and Friday. And of course, new home sales, a 2-year auction, GDP and jobless claims throughout the week. All through Thursday and Friday, you have PCE data. Thursday night, of course, that U.S. presidential debate. And of course, starting Tuesday, that Bloomberg Invest conference. A lot of talk about that bond market. For my final thought, looking at the estimates of the PCE data coming in next week, the estimate for the deflator month over month is flat, up from a 0.3% rise in the prior reading. Of course, it's going to be a busy week ahead. We have a lot of inflation data and a lot of economic data, but for us, that does it for us here, same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Welcome to Bloomberg Markets. I'm Shonali Bassick. There is more than $5 trillion of options set to expire today, and it threatens to trigger some sudden price swings in the market. Let's get a check on these markets and how they're reacting before all of that is ahead. Of course, we had the S&P 500 earlier this week touching that $5,500 level, but we are now well below that. You have a market looking to hang on to some gains, but really just flat on the day. The NASDAQ 100, you're seeing similar type of story here, flat on the day, and as I'm speaking to the S&P 500 struggling with some red territory as well. The Philadelphia Semiconductor Index down more than 0.4%. The Dow Jones Industrial Average also roughly flat on the day. Midday movers now on the equity side, looking at AutoNation. Some 15,000 auto dealers are reeling from a cyber attack of CDK, which is used to complete transactions. Some dealers are handling some tasks on paper until the service is restored. You might remember what paper feels like. CDK has warned, though, that a second attack Thursday is likely to keep the systems down for several days, and of course you have it down more than 4.4%. And Amex today announced that it will buy Tock for $400 million from Squarespace. Tock is a restaurant reservation company known for catering to high-end and exclusive venues. It will complement Amex's Resi business acquired in 2019. Amex still down about 0.5%. And after reaching a record high of almost $74,000 in March, Bitcoin now hitting its lowest level since May. The drop comes as uncertainty about what to expect for cuts in U.S. interest rates has lessened demand for riskier assets. Bitcoin down more than 2%, Coinbase down almost 4%, MicroStrategy down 0.25%. Also happening today, Wall Street's triple witching event, where some of that $5.5 trillion worth of auctions is set to expire. This coincides with index rebalancing, where some ETFs must adjust holdings, including the $71 billion Technology Select Sector Spider Fund. Bloomberg's Isabel Lee joins to discuss.
Hey, Sonali, so this is a big deal because, to your point, this is one of the biggest ETFs. It's worth $71 billion. And for the longest time, the biggest holdings are Microsoft, Apple, and NVIDIA, with NVIDIA being the third place. And because of some weird or quirky rule, the third place gets trimmed. It's clipped. So NVIDIA's holding in this ETF has been 4.5% for months. And now, because NVIDIA last Friday, the reference date, surpassed Apple, it's now second place. And if you're second place, you get your full weight, which is now 22%. At the same time, Apple will see its weighting clip. So a lot of volatility there. We see NVIDIA rising to its full weight, Apple being clipped down, and this will create volatility on a day where triple witching is also happening.
Volatility, let's talk about performance as well, because how well has this fund been doing prior to the reshuffling, and what does the reshuffling even really mean for it?
So it hasn't been doing well. That's the point. It lagged its benchmark by 5 percentage points, which is the widest dispersion since 2001, all because of this quirky methodology. It hasn't been reflecting the full weight of NVIDIA. So if you're an investor, you invested in this ETF expecting that it will track the benchmark, but it hasn't been. But it really just dates back to how big this market has been and how narrow, because the diversification rules dates back to 80 years ago, and I don't think anyone 80 years ago really expected the big companies to be this big. But then we talked to State Street and they were like, we're going to stick with a methodology, it served investors well, and they're not looking anytime soon to change it, at least.
Isabel, thank you so much for your time, for your analysis. Now switching gears, 4 of the biggest banks on Wall Street must improve their blueprints for a hypothetical wind down after top U.S. regulators found weaknesses in their plans. The Fed and FDIC reviewed the most recent resolution plans, also called living wills. They were mandated following the 2008 financial crisis. The regulators didn't identify specific weaknesses in the plans. Bloomberg's Todd Gillespie joins me now, and it's interesting, you cover all these banks, but Citigroup in particular very closely. What's the difference between the likes of JP Morgan, Bank of America, Goldman, how they're being treated in these plans relative to Citigroup right now?
Exactly, Shonali. And Citigroup, right here today, the FDIC has said Citigroup has a deficiency in its plan. So that's one rank lower, essentially, than what they've identified with the other slightly problematic banks. On the other hand, the Fed has said they only identify a shortcoming with Citigroup. And because the two regulators don't really agree that Citigroup is deficient, they kind of escape the lowest penalty, the sort of worst penalty for these banks right now. But as you say, Citigroup is a bank that has had a lot of regulatory overhang. It's got consent orders, it's got issues with its technology and its data that it's been trying to improve for years. That's been a very costly weight on the bank. Earlier this week, when the Wall Street Journal first started reporting inklings of this ruling coming, it really did overshadow one of Citigroup's biggest initiatives this week, which was its Services Investor Day, as you were there as well. And that's really just a reminder to investors that just as Citigroup is trying to really push its transformation plan, there are still a lot of weights hanging over the bank.
This might be a fairly basic question, though I find it a fairly difficult question to answer for myself, Todd. Why is it that more than a decade after the financial crisis, you have banks still deficient in living wills?
Yeah, it's a great question, Shonali, and these regulators don't break out exactly what the shortcomings are. And obviously, as we move on from the financial crisis, as these banks are evolving themselves, they're constantly having to adapt these plans to the current environment. Managing different new types of exposures that people are worried about, whether that's CRE risk, whether that's different models of how they're exposed internationally. These banks are constantly having to change, and every year they're having to think about new issues that keep cropping up. And it's really a sign that some of these banks need to be better at adapting to these newer environments as well, and be a bit fresher and a bit faster on their toes. So.
Todd, thank you so much for keeping an eye on the story for us. That is Bloomberg's Todd Gillespie all over the banking system. Now, turning to the world of institutional investors, earlier this week, Hamilton Lane had raised a firm record of $5.6 billion for an investment vehicle to buy interest in private asset management funds. This is, of course, a fast-booming secondaries market. The fund itself was about 600 more than the initial target, of course, rare for today's fundraising environment. Joining us now for an exclusive interview, Eric Hirsch, co-CEO of Hamilton Lane. Interestingly, Eric, just before we get to the fund itself and the need for secondaries here, can you explain a little bit the investor conundrum now in investing in private markets? We're just hearing so much about the complicated picture that they're facing with kind of finding the liquidity they need right now to recycle money back into new funds.
I think you've exactly hit on it, Shonali, which is everyone knows the asset class over any long time period you want to look at has been a huge outperformer against the public equity markets. So from an equity standpoint, you'd much rather have more assets on the higher performing side, which has been the private side. But right now we are in a bit of a slowdown in terms of liquidity. And so investing continues, but sort of distributions are not keeping pace with that. And so investors are finding themselves a little bit tight on funding.
So what does this mean for new investments? It was interesting to see you raise particularly a secondaries fund to this effect. Is this a function of that kind of hidden liquidity crunch, or just a function of investors trying to find new investments in the private markets, trying to make the private markets look a little more like public markets?
I think it's a series of ands. So one, the secondary space and us particularly have been very strong. And so investors, I think, supported that very clearly with this fundraise. And our team did a terrific job. And you need more liquidity mechanisms, and secondary funds have been a way of providing that to investors. The secondary market really has been probably the most evolved inside of our asset class, which has been relatively traditional for a long period of time. The secondary market is providing liquidity in a variety of different fashions, in different sizes, in different strategies, in different spaces. All of that is a good thing. And investors see this as a way to sort of shorten duration in what is increasingly becoming a longer duration asset class.
Now, how do you think about the opportunity moving forward? I spoke to one of your colleagues earlier this week, and the interesting thing about your fund is that you're looking at places that are not for the faint of heart. It's for things like growth equity. How much opportunity is there now after what is largely being considered a valuation reset?
So I think the opportunity set is massive. So as the industry has gotten bigger, even if the percentage of trading volume has stayed relatively static, you have a lot more assets that are trading around the secondary market. And for us, one of our huge advantages is our database. We simply have better insights, better data into the market than others. And so we can use that data very effectively to find and price assets. And we're doing that. And to your point, we're not simply looking where everyone else is looking. Right now, the venture and growth space has some real challenges, but there's also some real gems that are sitting there that are frankly very attractively priced. And it's exactly a lot of those investors who went a little heavy in that space at the wrong time and now find themselves a little too full and need to get rid of some assets.
It's interesting. I think one thing that has been weighing on a lot of people here is the exit opportunity and the lack thereof. And you alluded to a lot of the pains being seen across the industry. How much is there an exit opportunity right now? Are part of these funds really occurring because that exit opportunity might not be there for some time?
So I think we have an issue here is that you have sort of buyers and sellers not seeing the world exactly the same. If today you are an owner of an asset and are contemplating selling, you're thinking to yourself, geopolitical risk, a big election looming, this economy's been a little bit volatile, I'm not sure what's happening with rates. And so as an owner of an asset, you're not thinking that today is the day to sell to achieve maximum value. As a buyer of assets, you're also looking at the same thing, thinking, well, things might get cheaper tomorrow. And so both of those sides are kind of staring at each other, waiting for the other to blink first. The seller at some point is going to need or want liquidity, and people will start to accept that this is kind of our new normal, and people will adjust, and we're seeing that happening now. Trophy assets are trading today, and they're trading at very high prices. So it's not that there aren't deals getting done. There are. People are buying plenty of assets, and they're still selling and getting liquidity. We're just not seeing it in an equilibrium volume where dollars out and dollars back are kind of equaling each other, and that's causing that sort of mismatch for the LP.
Now, I'm really curious about another story that was really interesting in the market this week. There's a company that you're invested in, Case, that sent a letter to thousands of investors saying that they were going to lower fees tied to feeder funds that make it into alternative assets. Really curious about what you think about this kind of a move. Do you think that there can be significant fee reductions in retail funds tied to alternatives?
I do. So I think what you've seen it in every other asset class, and ours will be no different, that as institutional demand continues to rise and you match that up with retail demand also rising, there is going to be fee pressure, again, as there has been in all other parts of the asset class. So over time, investors are going to focus on what is a commodity and what is a high value add proposition. And so I think what you're going to see is right now, a lot of the infrastructure around our asset class has been relatively expensive, and there's going to be moves made to try to reduce the cost of that infrastructure and bring down some of the friction cost for investors across this asset class. I think this is a great way to kind of further democratize what's happening and getting that access more broadened out and making sure that investor experience is as positive as possible.
Eric, we thank you so much for your time. Happy Friday to you. I hope you have a great weekend ahead. That is Eric Hirsch, co-CEO of Hamilton Lane. And want to bring you some breaking news. We were just talking about Apple. Some headlines now crossing the terminal in the company. It is withholding a raft of new technologies from hundreds of millions of customers in the European Union, citing concerns by the bloc's regulatory attempts to rein in big tech. Mainly, Apple said it would block the release of Apple Intelligence from users in the EU this year. It says the Digital Markets Act allegedly forces it to downgrade the security of its products and services. We'll bring you more details as we know them. There's shares of Apple as we go to break. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New season starts July 10th, only on Bloomberg. Brought to you by Workday.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
We fulfilled 100% of redemption requests over the last 4 months. Today we have ample liquidity, $7 billion plus. That is what differentiates us from other players in the space.
Blackstone's Nadeem Megji speaking earlier to us this month, bringing us now to the stock of the hour. The firm's $339 billion global property arm undergoing a change in strategy. The world's biggest investor in real estate is moving into riskier new terrain in the hunt for higher returns. Bloomberg's Patrick Clark joins me now to talk about exactly what's going on inside of Blackstone's crown jewel. You've been all over the story around how, and your team has been all over BREIT in particular, the liquid vehicles. What kind of new pressures does that put on Blackstone?
Well, the story is that they promised investors a dividend, and the investors can now very often get better returns much more easily in more liquid assets, right? Just buying treasuries, they're going to do better. And many of those investors have demanded asked for their money back. In fact, demand is the wrong word, because in many cases they can't get it, or they can't get all of it at once. So that story isn't over yet, right? We're going to continue to see that, I think, as long as interest rates remain high, and it will go up and down. Blackstone at some point did finally start making the redemptions that were requested. In terms of deploying new capital, I think they have a slightly different challenge, which is that for a very long time, commercial real estate was benefiting from zero interest rates, and drawing more and more capital into the space, increasing values, and Blackstone, with that $339 billion real estate for assets under management that you mentioned, I mean, it's Blackstone and its investors were tremendous beneficiaries of that low rate environment. Now all of a sudden, they've got to be more tactical, and they have to figure out, real estate or real estate businesses that they can buy that can succeed without the tailwind of low interest rates.
Yeah, no, it's interesting. 10% annualized inception to date return for BREIT, but only 2.3% year-to-date return. That is Patrick Clark of Bloomberg News, of course, all over that real estate industry. Want to bring you some more breaking news. Millennium Management planning to raise new cash equivalent to about 10% of its $68 billion in assets as the multi-strategy hedge fund looks to bolster its ability to access capital when needed. The firm plans to raise the cash by the end of this year or in early 2025. Remember, Millennium previously raised $14 billion in a similar vehicle. The firm has returned about $38 billion since 2020 and, of course, is one of the largest multi-strategy hedge funds in the world. Stick with us through the break. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg.
This is Bloomberg Markets, and I'm Shonali Bassick. The sales of existing homes in the United States fell for a third straight month in May, while prices set yet another record. And it underscores persistent unaffordability across the nation, particularly in the South. For more, we are joined by Brad O'Connor, Chief Economist of the Florida Realtors Association, and Bloomberg's Abigail Doolittle, always all over this complicated real estate market. Brad, you see the prices in Florida, for example. It's a really good indication of what's going on, probably to some extremes, frankly, in Florida relative to some other parts of the country. How do you describe the dynamic?
Well, yeah, Florida has been a hot market really since early on in the pandemic, right? So by June or July of 2020, we were seeing some of our highest sales numbers already, and that was a combination of Florida being a little bit more open than other parts of the country. We looked at data where people were coming from, and for instance, out of the New York Metro, where a lot of folks came from, was the more densely populated places that are a lot less fun when locked down, like Manhattan, Brooklyn, and that really hasn't stopped. It's dampened a lot, but we're still getting a lot of in-migration into Florida, which has pushed prices up and kept demand higher than maybe elsewhere in the country. But these higher interest rates since 2022 are affecting Florida just like the rest of the country, where we've seen a dampening of demand overall, and our current level of sales is about 5 to 10% below pre-pandemic levels.
So beyond rates, Brad, what else is dampening demand down there in Florida?
Well, of course, we've had some insurance rates problems that are occurring throughout the country, wherever there's been wildfires or flooding or anything else. Of course, Florida's been affected by those. Florida in particular also has been in a situation where over the last few years, maybe about 10% of home insurance claims each year are in Florida. And yet about 80% of litigation related to those claims has been in Florida. We had a problem with how our laws were structured, and the legislature just recently here in Florida addressed that. And so we're hoping that will bring more competition back into Florida from the insurance side of things, so that we'll see more evening out of prices. We've already started to see early signs that this is happening, but it's going to take a little while.
Okay, so those are some of the...
That's been a surprise for lots of buyers and existing owners, just seeing their property insurance rates going up.
Right,
But the interest rate thing is the bigger deal in terms of the overall effect, but they're both important.
Okay, so those are the factors, or some of the factors affecting demand down there in Florida. What about inventories? Have rates had any sort of silver lining in terms of pushing them back down to normal? Because we keep hearing about tight inventories, nobody's moving, and therefore that's an upward push on pricing.
Right, and nationally, I think if you look at inventory statistics, they're still down from pre-pandemic levels. Among the darling real estate markets of the pandemic, going from Boise, Austin, and then looking at Florida, Florida's the only one that's still seeing prices rising and still seeing a lot of movement in, but we've slowed down a lot, and inventories here, as a result, have been rising a little faster than you'd see elsewhere in the nation. So if you look at most markets in Florida, the inventory level is actually a little bit above where it was prior to the pandemic. And at that point, we were complaining that we didn't have enough inventory. So From an affordability standpoint, that's a good thing. If you've been trying to get into the market and haven't been able to because of low inventory, and there's more options available to you now here in Florida. But it does vary by which part of the state you're looking at. If you're looking at South Florida, their inventory is still actually quite low relative to pre-pandemic.
Brad, we have to leave it there. We thank you so much for your time. Just one view on what is happening in this hot housing market. That is Brad O'Connor of the Florida Realtors Association, and of course our own Bloomberg's Abigail Doolittle. Now, before we let you go, check on the markets, because of course we have been teetering on the edge here, and we are teetering a little into the red territory. When you look at what is happening with the S&P 500, you're looking at yields roughly flat on the 2-year going into the end of the week, as well as the 10-year hanging out at 425, though nice and low. Of course, PCE data next week. A lot going on into the close. Of course, we have a lot of volatility planned when it comes to rebalancing and such. Stick with us. That does it for Bloomberg Markets. I'm Shonali Bassick, and this is Bloomberg.
The UK decides. On July 4th, amid debates about tax policy, border security, foreign policy, and more, voters head to the polls to choose the next leader. Bloomberg has full coverage leading up to the election and will bring you the results after all the votes are tallied. Tune in for continuing coverage on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some refinancings done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. We used to have high prices, and if you look at those vintages, even the GFC vintages have done actually pretty well in the end.
Bloomberg. Context changes everything. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines in Washington, where we're following two stories at this hour: the Supreme Court and the presidential race. With less than 1 week to go until the first presidential debate, we have new fundraising figures that show Donald Trump outraised Joe Biden by more than $50 million in the month of May. We'll have more with Bloomberg's Gregory Cordy and our political panel, Rick Davis and Jeannie Shanzano, this hour. Plus, as the Supreme Court upholds a federal ban on those with domestic violence restraining orders from owning firearms, we'll talk with Elizabeth Wydra of the Constitutional Accountability Center. First, though, as always, let's get a check on the markets with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee. We're looking looking at a mixed market right now. Truth be told, stocks struggling for direction right now. The S&P swinging between gains and losses. Right now, the S&P down 5, down 0.1%. The Dow up 13, higher by about 0.1%. NASDAQ lower by 9, a drop there of just about 0.1%. We've got NVIDIA shares on a roller coaster ride today. The stock now lower by 2.4%. 10-year 4.25% with the 2-year 4.73%. Gold now down $35 the ounce to $23.24, down 1.5%. And West Texas Intermediate crude down 0.9%, 80.60 right now for a barrel of WTI. Apple shares up 0.2%. Apple will be withholding a raft of new technologies from hundreds of millions of consumers in the European Union, citing concerns posed by the bloc's regulatory attempts to rein in big technology. Again, Apple up now by 0.2%. Recapping, stocks are mixed. S&P down 6 now, drop of 0.1%. Balance of Power continues. Back we go to Washington. Once again, your host, Kaylee Lyons.
All right, Charlie Pellet up in New York. Thank you so much. I am Kaylee Lyons in Washington, and you're listening to Bloomberg TV and radio, watching it and listening to it, that is. And of course, here at Bloomberg, we care a lot about the data, including what the data tells us about the way people are funneling money to candidates in this presidential election cycle. We've got fresh figures from the Federal Election Commission, and what a story those numbers tell. This is for the month of May, and there was a wide fundraising gap between Joe Biden and Donald Trump. For his part, Biden, together with the DNC, raised $85 million last month, while Trump and the RNC, powered in part by a galvanizing of his base after his criminal conviction in New York last month, pulled in a significantly more robust $141 million. So here with more on the numbers and their significance is Bloomberg's Gregory Cordy. He is Bloomberg's senior White House and politics correspondent, joining me here in our DC studio. So Gregory, obviously, if you're the Biden campaign, $85 million isn't a small amount. In fact, it's actually significantly larger than they raised in April. It's just that it's smaller than Trump. So what happens if this begins to establish a pattern that's a reverse of what we'd seen so far this cycle? Biden outraising Trump, now it's the other way around.
Yeah, 2 months ago, I think you and I were sitting here and we were talking about how, it was Trump who had all the fundraising problems. He had been reliant on small dollar donors. He had squeezed all the blood he could out of that turnip. We were talking about donor fatigue. People just can't keep giving Trump money. Whereas Biden was doing pretty well among those small dollar donors and among the big donors as well. And boy, 2 months later, it does look like we're looking at the mirror image of that. And what changed, as you point out, I think certainly, and we've seen this all along, Trump's legal issues have become a galvanizing force for his supporters. So if you're Joe Biden and you've lost the fundraising race 2 consecutive months, now you got to be looking towards June and July when former President Trump is going to go back to that courtroom again to be sentenced. And you kind of have to think the more severe the sentence, the better the fundraising bonanza it's going to be for Donald Trump. Yeah. And now we're talking about a whole new ballgame in terms of the ability to raise and spend money. Yeah. Do you see something in July 11th and the 48 hours after, like we saw at the end of May with that conviction? Also keeping in mind that immediately following is the RNC, something that also could be a galvanizing force. You mentioned, though, this idea that there is a difference between those grassroots, small dollar donors and the big guys, the big fish, the billionaires, who we also like to pay a lot of attention to here at Bloomberg. All the billionaires that seem to be on the sidelines, not really willing to throw in for Donald Trump, no longer seem to have as many reservations, and they're starting to put money in the pot. Yeah, we saw this during the primaries where a lot of those names were looking for some kind of alternative, a more business-friendly face on Trumpism, somebody who could beat Joe Biden. Certainly, there's not a whole lot of love for Joe Biden's economic policies and his tax policies on Wall Street. He's talking about a billionaire tax, right? And so, but they were looking for somebody who they thought could beat Biden and maybe was a little bit more, spoke their language, right? That ship has sailed. Right? Trump is going to be the nominee at the convention in Milwaukee next month, barring some completely unforeseen circumstance. And so, yeah, they're rallying around the guy that they think can beat Biden, as flawed as they perceive him to be. Of course, raising money from wherever you do is one thing. Spending it is something else. How
we likely to see spending behavior change for both campaigns, given the fundraising trends that we're seeing?
Yeah, I'm going to be looking very closely at Trump next few weeks, because one of the things we've seen is, Biden has been out there. Biden and the Democrats have been on TV in all or most of the swing states, especially Pennsylvania, for the past few months. They've actually longer than that. The beginning of last year, they were up in the air on a lot of these swing states. Trump was on the air during the Republican primaries in Iowa, in New Hampshire, in South Carolina. After South Carolina, he clinched the nomination. We didn't really hear from him. And he has not really cut a new ad anywhere that we've seen on TV since then. Biden has continued not only to advertise in real time, but also to reserve time in September and October. That's going to be very important as we get to those last weeks of the campaign, because there's going to be a real scarcity of ad time to be bought. And so campaigns generally like to get that time reserved and booked and put down their deposit well in advance to make sure that they can be on the air, because in a state like Nevada, you will not see a non-political ad in the month of October. Car dealers, mattress companies won't be able to buy a spot because it's just going to be so jam-packed with political ads. And so we need to start watching to see who starts to put their markers down.
It raises the question, though, of what it's all worth. Why even spend the money on the ads when these are two candidates who have probably as close to perfection in terms of name ID as any two before them? It's a former president and a current president, right? You don't need to buy the name ID. So what can you buy if not that?
That's a really, really good point, Kaylee. And not only is this going to be the most expensive election campaign ever, but we could probably expect it to be the most negative ever. And it's precisely because of what you're talking about. It's not just about defining your opponent, but because these guys are so well known, there's not a whole lot new that you can say about Trump's policies or Biden's policies that's going to move the needle here. The ads have to be that the other candidate is completely disqualified, right? Biden because of his age, Trump because of his criminal convictions, and that's what we're going to be hearing about from now until November, because it's not these aren't comparison ads. These aren't, well, this guy is marginally better than the other on this policy or on this character attribute. It's that this guy we cannot trust this guy to run the country.
And certainly after Donald Trump's conviction, you saw the Biden campaign almost immediately rolling out an ad that calls into focus the idea that Donald Trump is a convicted felon, so immediately trying to capitalize on it. Going to be really negative, to your point, Gregory Cordy, Bloomberg Senior White House and politics correspondent, rather. Thank you so much for joining me in studio. Now, some other messaging we have seen from the Biden campaign thus far not only surrounds Donald Trump being unqualified for office, but the idea that if Trump is reelected or gets a second turn at the White House, he also would have the power to potentially nominate more conservative Supreme Court justices. And the Supreme Court certainly is in focus as we are in the final stretch here of this term. Just 1 week to go, 14 opinions that they still have to hand down, and they did drop 5 today. One of them, particularly interesting, an 8-1 decision to uphold the ban on a federal law that bars people under domestic violence restraining orders from owning a firearm. So we want to get more on this case and the cases that we have yet to get a ruling on, and bring in Elizabeth Wydra. She is president of the Constitutional Accountability Center and a Supreme Court litigator. Elizabeth, welcome back to Balance of Power. Great to have you here on Bloomberg TV and radio. What the court decided in this gun case specifically was that there isn't a way to read the Second Amendment so broadly to allow for someone who has been found to be dangerous to own a gun. Is that constitutionally sound?
Absolutely. So, as you noted, the case was 8-1. Only Justice Thomas dissented, and that really shows the soundness of the constitutional analysis finding this regulation of domestic abusers to be constitutional, and also just the common sense behind it. You know, the Second Amendment obviously states a constitutional right. The Supreme Court has held that right is not unlimited. And although the Supreme Court 2 years ago in a case out of New York called Bruin said that there had to be some sort of historical similarity in order for a present day gun regulation to pass constitutional muster, there didn't need to be an exact historical twin. And Chief Justice Roberts, in the opinion that was released today, said that in that Bruin decision from 2 years ago, they weren't trying to create a law trapped in amber, that there could be circumstances when there wasn't an exact historical twin, like in this case with domestic abusers. And that didn't mean that the law must be struck down. If it fit with the purposes and the traditions that went into firearm regulation at the time of the founding and the drafting of the Second Amendment, then it could be constitutional. And here the court said, yes, this restriction on domestic abusers having firearms is constitutional under the Second Amendment.
Elizabeth, surely there are people out there who may just have some questions around the idea that the court could rule this way by such a wide majority, as we've pointed out, 8-1, on a case involving guns, having just last week shot down the federal ban on bump stocks. And if all of this surrounds the idea of danger, something that could be attached to a weapon, making it more dangerous, how are these cases so separate, if you will, that the court could rule so differently on each of them?
Well, that's a really good question. And I think that it's correct for the American people to be watching the Supreme Court and scratching their heads a little bit. You know, I think that there should be no mistake. This court and its very conservative majority has been very pro Second Amendment, has looked extremely skeptically on gun regulations. And we saw that in the bump stock case, where, you know, if you read the dissents of the more liberal justices, common sense would seem to suggest a different ruling in that case, as well as an analysis of the text and history of the relevant provisions. You know, I think what makes the case today about domestic abusers different is that it is such an extreme argument. You know, you have a person who is subject to a domestic violence restraining order, who has been found to pose a physical threat to another person, and therefore is going to be disarmed under that restraining order. You know, this is a very extreme case of someone seeking to or presenting a clear threat of physical harm, and that's why the gun can be taken away or the firearms can be taken away. And the court today looked through historical analogs that showed that when there's a clear threat of physical violence, people can be disarmed, consistent with the right to keep and bear arms. One thing I thought was interesting that Justice Sotomayor noted in her concurring opinion, she agreed with the majority, but also wrote to separately say, you know, part of the reason why you don't want to look for a historical twin back to the 1700s is that, you know, there are differences, importantly, in how society has evolved today. In fact, if you look to the time of the founding, you're probably much more likely to find legal protections for spouses who abuse their wives and not accountability. Yeah. And so the fact that today the court said, look, we're looking at the principles, we're looking at the reasons behind why the Second Amendment could be consistent with disarming a person who poses a threat, that's the key point.
Well, there's also the question of the court having to rule on situations for which there is no historical precedent, like a former president being accused of many felonies and claiming presidential immunity. That is a decision we have yet to get out of this court. They need to do so within the next week, Elizabeth. And it's raised a lot of questions for people about timing, knowing that the ability for this particular case here in Washington to go to trial before the election in November really does hinge on an outcome here for the Supreme Court. What do you make of the idea that we've waited so long to get an answer and we'll wait at least days more still?
The timing is absolutely key for this decision. You know, the court could have taken the issue up earlier. Jack Smith, representing the United States in his role as special counsel, brought it to the court earlier, saying, please rule on this so we can move forward with our case in the interest of justice and the American people can have some resolution before the election in the interest of democracy. The court said, no, we want to wait. Then the court did take up the case. They scheduled expedited argument date, and then we waited. And It seemed from the oral argument and just from the weight of the scholarship and the legal precedent that President Trump's immunity arguments will fail as a substantive matter. They're extraordinary arguments that would place him above the law in a way that has never been before countenanced in our American legal system and constitutional democracy. So the fact that the court hasn't issued that decision, it could basically give former President Trump a win through timing, even if he doesn't get a win on the merits.
Of course, you raised Special Counsel Jack Smith. He not only brought that case against Trump here in Washington, he also brought the case down in Florida, the documents case. And in Florida today, Elizabeth, before we let you go, Judge Aileen Cannon is holding the first in what is going to be multiple days of hearings related to an argument that Trump and his defense have brought that Special Counsel Jack Smith was unlawfully appointed as such. Is there any reading of the law that would suggest that he was not appointed in accordance with it?
I think this is a desperate attempt by the Trump legal team to, again, create more delays, although it seems like that case is perpetually delayed. There's really no there in that case. I think a lot of what he's doing with some of his legal strategy is, again, these delay tactics, which frankly have been fairly successful for him in running out the clock in other cases.
And of course, Judge Aileen Cannon, we should point out, was a Trump appointee, just as there are multiple justices sitting on the Supreme Court who are Trump appointees. When you look at the delay in that case in Florida, when you look at the delay all the way up to the highest court in the land, Elizabeth, should people not feel that courts are political, even if they're not supposed to be? Or is it impossible to separate the two in the modern day?
I think it is getting increasingly difficult for the American people to separate politics from justice. And that is deeply unfortunate because it's really important for the judiciary to have the faith and trust from the people that there will be impartial justice, that there will be equal justice under the law for all, regardless of whether you're the most powerful or the most vulnerable. And I think we saw the American public's faith in the court plummet with the Dobbs decision overruling Roe versus Wade. And a lot of these delays, I think, in this Trump case are not really helping build back trust in the court, as well as some of the ethics potential violations that have been in the news and the court's continued refusal to enact a binding code of ethics. They have a voluntary code of ethics that was put in place this term, but doesn't really seem to be giving the public much more confidence in the court. So there is a real crisis of confidence in the court, and it's extremely troubling.
All right, Elizabeth Wydra, Constitutional Accountability Center President and Supreme Court litigator, thank you for joining us here on Balance of Power.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Invest, don't trade. Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't get involved in investment hobbies. Investment hobbies are generally not profitable.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Triple Witching Friday, in which derivatives contracts tied to equities, index options, and futures mature. We have got the Dow bouncing around, swinging between gains and losses right now, down higher by 2 points, little change there. S&P in the red, down 9, struggling for direction, down 0.2%. NASDAQ down 30, a drop there of 0.2%. 10-year, 4.26%, with the 2-year, 4.73%. Gold down $39 the ounce to $23.20, a drop of 1.7%, while West Texas Intermediate crude down 0.8%, $80.65 a barrel. NVIDIA shares now down by 3%. They're extending losses for a second consecutive session after briefly overtaking Microsoft and Apple to claim the title of the world's most valuable company. Again, NVIDIA down now by 3.1%. Recapping, S&P down 10, drop there of 0.1%. Balance of power continues, the Friday edition. Back we go to Washington, and once again your host. Here she is, Kaylee Lines.
All right, Charlie Pellet up in New York, thank you so much. I'm Kaylee Lines in Washington, where I might be getting a bit repetitive, so just bear with me. But these figures are very important. We have the May fundraising figures from the FEC. They've hit in the last 24 hours. And this is the money game in the presidential election cycle that could ultimately help decide its outcome. In the month of May, Donald Trump outraised Biden again. This is the second month in a row that it has happened, after the reverse being true for basically the duration of the cycle through April. In May, Donald Trump and the RNC pulled in $141 million. A lot of that came after Donald Trump's criminal conviction in New York on 34 felony counts of falsifying business records. For Biden and the DNC, they raked in $85 million. Not a small amount, but still more than $50 million less than what Trump and Republicans could do. So let's get right to it with our political panel. Rick Davis, Stonecourt Capital partner, is with me, and Jeannie Shanzayano. She is Senior Democracy Fellow with the Center for the Study of the Presidency and Congress, our signature political panel on this Friday. So Jeannie, first to you, if you were inside the Biden campaign, are you panicking at these numbers right now and the cash cushion dwindling rapidly?
It's certainly not the trajectory you want to go in for the second month. But if we put it in perspective, they say they've raised about $558 million in this cycle. That is record breaking for Democrats. So they are both taking in big money. But I do think it is a wake up call for the Democratic team and the reality of the fact that for all those on the left who thought that a convicted felon could not lead the opposition party. And these types of numbers, both the fundraising and the polls, quite frankly, are giving lie to that. So this is a wake-up call for Democrats. That said, they've raised a lot of money, and they will keep doing that. And maybe given the last 2 months, they'll raise even more. And also importantly, they've raised small dollar numbers over what Donald Trump has done, who's raising from million and billionaires.
Yeah, it's a really good point. You're seeing the big money coming in a more material way. But of course, when we're considering what happened that month, again, a lot of this came after his conviction in New York. In fact, there was one donor who gave $50 million to the MAGA super PAC after that happened. It raises the question of whether or not the Trump team can repeat this performance in the absence of another conviction, or is this really an event-driven campaign fundraising effort, if that makes sense?
Well, all campaigns use events to maximize their fundraising, especially small dollar donors who don't really pay any attention to it unless there's something big happening like a conviction. But I would say that the way I read these numbers is the big dollar donors are the ones really dominating the news. It's not the small dollar donors. I mean, when one person, donor Mellon, can give $50 million to Donald Trump, I mean, if you back that number out of it, it's basically they've raised the same amount. So it's really what you do with the money that I think is more interesting right now, because there is a significant diversion of strategy here, and that is Joe Biden's been putting his money on TV in the key swing states and sending out messages. Most recently, attacks on Donald Trump, which he hadn't been doing in the spring or early winter. And Donald Trump isn't doing any advertising. And we know he's got bills to pay for with lawyers. But when does he get in the game? When does he start placing bets? Even the Biden-associated super PAC has already reserved $250 million in TV time for the fall campaign. These are really important indications of the strategy to come. And I think the real pressure is on Trump right now to say, okay, you have resources. What are you going to do with them? Because he has got declining poll numbers. And there's going to be more pressure in the Republican Party to say, why aren't you engaging? Why aren't you advertising?
But to your point on the Biden camp having bought up so much ad space in the fall, is it more prudent in your mind as a campaign manager to sit on the cash and wait to spend it later, or to start spending it now when it's June and the election's not till November?
Yeah, you don't make up much ground in the summer. So husbanding your resources today is a good strategy. You're going to get a big bump at the debates next week. You know, all of America will zone in and see what's going on. You don't have to pay for that. You might want to buy some afterwards to sort of manage expectations. But then you have a convention in August, if you're Democrats, in July, and Republicans, and you don't have to pay money for that. That's going to be an enormous amount. 50, 60, 80 million people will watch that. And so you're really down to September, right? And so I think what I would be doing, and what I've done in the past, is you start husbanding your resources now, and you start putting them on availabilities. TV isn't equal. It gets bought up first come, first serve. If you wait too long, and this would be my admonition to the Trump campaign, if you wait too long to get those avails, you're not going to get good slots to advertise.
It also raises the question of the content of those advertisements, Jeannie, just not how frequently or in what time slots that they run. We were speaking with Bloomberg's Gregory Cordy about this earlier this hour, this notion that because these candidates are so well known, a former president and a current president, it's not about name recognition or even necessarily about their policy, because in large part that's well known as well. He said the way in which the American public knows these candidates suggests that actually what the candidates are likely to be putting out there is just a lot of negativity. You're bracing for as well?
Yes, and that is what is going to happen, because when you've got name recognition of this level, it is not a question of do people need to figure out who Joe Biden and Donald Trump are. And with such unpopular candidates, it is really more of an issue of defining the other. And so we are going to see that in all of these ads. We will certainly see that or an attempt to see that in the debate. And, it's been a campaign where you go across the board. It often doesn't matter care what they're saying policy-wise. It's more about how they are presenting themselves. And Joe Biden's, a week from today or a week from yesterday, rather, on the debate, it's not going to be what he says, but how he says it. He's got to show he's strong, and he's got to make Trump look crazy. And that is how they say it and how they define their opponent.
Well, Rick, we know that Biden is at Camp David right now trying to hone that messaging. But if all of this is about energy, what's the point of going through the whole exercise of answering policy questions or preparing your one-liners when people are just trying to see if your eyes are still wide open?
Well, I think for Biden, it is a test to see, whether or not he actually can talk articulately, even about the policies of his own administration. So he does have a bar to get over there. But I think, you and Jeannie are both right. I think that this is a race to the bottom. And Joe Biden wasn't attacking Donald Trump until recently. Why? Nobody can tell. His numbers didn't go up when he talked about himself. People think he's too old, and people think Donald Trump's too corrupt. So the difference there is, I think Donald Trump does spend quite a bit of time attacking Joe Biden, but he also attacks everybody else. I mean, it's a complete waste of his attacks to go after judges and prosecutors and things like that, because they're not on the ballot. Joe Biden's on the ballot. And so I think both campaigns are really dispersed in their messaging, much more so than any other presidential campaign I've ever seen. My question is, when are they going to narrow it down to one another, and what are those attack lines going to be?
Well, it's also interesting that as Rick talks about the various people that Donald Trump attacks at his various appearances, we are going to see and hear from Donald Trump this week, Jeannie. While Biden is at Camp David, doing his much more formulaic, we understand, debate prep, essentially shielded from the public eye, potentially until debate day, Donald Trump's going to be in Pennsylvania this weekend. Is it a mistake for President Biden not also to be visible, not just on debate night, but in the lead up to it?
I am one who thinks he's got to be out as much as possible. That said, the debate prep time, the rest, the ability to take a step back and think is critically important. He has been traveling around the country and obviously around the world in the last few weeks. So I think these days of rest and practice and rehearsal are important for Biden. But that said, after this debate on Thursday, he's got to get out there as much as possible. And, we can't forget, this is not only about the few hours or the 90 minutes during that debate, it's the spin afterwards. And it is brutal now because it is online. So we're really looking at a debate about editors in a way that we didn't used to 20 years ago versus just what happens during the debate. So he's got to be out there. If he doesn't do well on Thursday, making sure he can give lie to those attacks that are sure to come.
Yeah, it's just as much about Friday. Friday, we understand, according to CBS, Rick, Donald Trump is going to be in Virginia. Where should Joe Biden go the day after?
Yeah, I think Joe Biden needs to stay in the swing states where, he has a chance to win. And obviously the top tier priority of the blue wall, Michigan, Pennsylvania, and Wisconsin. He wins those three. He's president of the United States, I guess, along with Nebraska's 2nd district. So maybe he goes to Nebraska's 2nd district.
All right. I guess there's our answer. Of course, Rick and Jeannie, our signature political panel, always round things out for us on a Friday, in which we're now just 6 days away from that debate. Rick Davis is a partner at Stone Court Capital. Jeannie Shanzano, a senior democracy fellow at the Study for the Presidency and Congress. Great to have you here on this Friday as we look ahead to the debate. Meanwhile, there's a lot of other world and national news still happening in real time, and Amy Morris has been tracking all of it for us. She's here in the 99.1 newsroom here in Washington. Hey, Amy.
Hi, Kaylee. Thanks so much. The Supreme Court, as you know, upheld a federal gun control law. It's intended to protect domestic violence victims. Now, the justices ruled earlier today in favor of a 1994 ban on firearms for people under restraining orders to stay away from their spouses or partners. It is the justices' first Second Amendment case since they expanded gun rights in 2022. Michael Bloomberg, the founder and majority owner of Bloomberg LP, the parent of Bloomberg Radio, is a donor to groups that support gun control, including Everytown for Gun Safety. Manhattan prosecutors are urging the judge overseeing Donald Trump's criminal hush money case to uphold a gag order. Prosecutors with the Manhattan District Attorney's Office argued that portions of the gag order are still necessary given Trump's history of threatening statements. They agreed that one provision of the gag order that prevented Trump from attacking trial witnesses in the case can now be lifted. And a heat wave is moving closer to the breaking point from the Midwest to New England, but there is no immediate relief in sight for much of the rest of the country. The National Weather Service says a heat dome could send heat index readings above 100 degrees in many locations, possibly breaking all-time records. New York, New Jersey, Washington, D.C., extending into parts of the Midwest, all under heat advisories that are going to last throughout the entire weekend, starting today, well into Sunday evening. Global news 24 hours a day, and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something. There's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. Deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my
Are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Arch has laid plenty of groundwork. Mark Messler's most pressing challenge as CFO is conserving capital.
Cash. I mean, cash is oxygen. I know where every ounce of cash is going, and because things change by the day.
Archer went public in 2021 in a Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion. United Airlines and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with my top targeted list of investors over the next 2 to 3 years. An investment like that, a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, are raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment. I want to create credibility with them that we are marching towards our goals of commercialization.
UK decides. On July 4th, amid debates about tax policy, border polls to choose the next leader. Bloomberg has full coverage leading up to the election. Tune in for continuing coverage on Bloomberg Television. Context changes have. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Bloomberg Equality, celebrating inclusion this Pride Month.
Fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to take on equity to get some returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have a high interest rate environment. Look at those vintages, even the GFC vintages have done actually pretty well.
Changes everything.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. U.S. stock Dow up now, barely up by half a point, has been swinging between gains and losses. S&P NASDAQ down 46 now. That is a drop of 0.3%. 4.26% with a 2-year, 4.73%. Spot gold down $41. That is a drop of 1.7%. And West Texas Intermediate crude down 0.8 of 1%. Barrel of WTI. NVIDIA shares moving lower, part of a broader tech sell-off. NVIDIA. Apple is withholding a raft of new technologies from hundreds of millions of consumers in the United States, posed by the bloc's regulatory attempts to rein in big tech. And Sarepta Therapeutics gene approval to include more children with a deadly muscle disease, expanding the market. Still not proved its benefit in clinical trials. Sarepta Therapeutics shares surging now by 30. Index down 12, down 0.2%. Balance of power continues now. Back we go to Washington. It's Kaylee Lines.
All right, Charlie Pellet in New York, counting down the hours until the closing bell. Counting down the days to the first presidential debate. There's only 6 of them left before that debate. June 27th. And if you're wondering, yes, that is unusually early for a debate. Donald Trump or Joe Biden are actually the nominees for their respective parties. They're still just going to be. The conventions haven't happened yet. And that's not the only thing that's going to make this upcoming debate unusual. There's also live audience. So we wanted to get some historical perspective and bring in Barbara Perry from the University of Studies at UVA's Miller Center. Welcome back to Balance of Power, Barbara. Always great to have you on the program. Are people even prone to pay attention to a debate like this early in a cycle?
I've just come back from a bit of a holiday myself and took a little bit of a break from reading. But first of all, happy to be with you. And second, it is summertime, and it'll be the height of. I'm a little bit skeptical that as many people will watch as they would at, let's say, after Labor Day, as we get closer to the election. That could go in the favor of a high audience would be the heat dome. Should that continue, and it looks lots of people will be at home, they'll be in their air conditioning, and they may be prone then to watch.
For something to do as an added element that could factor in here. But there's also the question of what those people are going to be watching this on television with no cues from a live audience. Usually at a debate, what a candidate is saying, the audience at home is going to be kind of left for themselves to decide what the reaction should to be there for the first time in what is a really long time, I understand, Barbara. How should we be thinking about the live audience?
I, for one, Kaylee, will be pleased not to have the booing and the shouting and the clapping. But it might be a little bit like during the pandemic, watching the U.S. Open tennis match or watching body there spectating and cheering. And so the silence may be deafening in that sense. But I should tell you, Kentucky last week, and he's going to have all of his friends over to have a debate party. And they also have a pool, so it'll maybe be watching while in the pool. But he's going to have bingo cards. And he said, what could I have on the bingo card? What will these people be saying on the stage that is bingo card and yell bingo? So I think if people turn it into, I said, you're not going to do a drinking game, I hope. And he said, no, we're not going to. There are different ways to watch. And maybe it will be like, I know when I watch college basketball, I am cheering up and down. So maybe people will get into it at home.
Kentucky, home of not just as well, Barbara. As we consider the idea of no live audience, though, and what that brings, perhaps more focus to your point, which we know that Donald Trump typically likes. He feeds off that energy. It's also the factor of the mute button, being the ability to speak over the other candidate. Knowing what we know about these presidents, who do you think these rules?
I think this one certainly benefits the president, President Biden, because he should not have a bit skeptical that former President Trump will stop. In other words, will he continue to speak, and will that be distracting to President Biden, even though will the president be able to hear someone who's trying to talk over him even without a live mic? And anyone who does any teacher or professor knows that it's a little bit distracting and takes you off point. And if one is prone to, that can be detrimental, I think, to him.
Well, to that point, Barbara, is really all this to laughing, not pausing for too long, not giving any appearance of weakness as he debates at 81 years old? Does it even matter what he says or only how he says it?
Important as we look back through history. So yes, he has to be clear on his message, but speak clearly. As Sandra Day O'Connor once said to my dad, who had some hearing issues, my dad, when I turned 7, as he's speaking. And that's not going to be easy because he does have, as he's been very open about, the stuff stumbles or mumbles. And that goes for, as we know, former President Trump, who just turned 78.
One of which we could have development in perhaps the very day of the debate, Barbara. We're still awaiting. Is there any precedent in history in which you could have something like that presidential debate?
I can't think of one offhand. Certainly, there have been events during debates. The first televised debate between Kennedy and Nixon in 1960, the high Not anything like this, because we know it's the first time a former president has gone to a criminal trial and while on the stage and running for president again. So that's unprecedented. It wouldn't surprise the 1990s if they might not hold off until after the debate to announce that decision, whatever.
Yeah, maybe we get an opinion day added on Friday. Barbara, before we let you go, just the question of how much this ultimately will matter in the grand scheme of things. Looking back at history, in any campaign?
Absolutely. And I would say, given this past week's passing of, immediately it came to mind the catch, they called it. They didn't even have to say Willie Mays, the catch. Drops over his head, he catches the ball. If he had bobbled it, maybe it would have been remembered, maybe not. So I would say that it's the incumbent president. They want to have clean catches. They want to hit home runs, maybe even grand errors. And because that is what people remember. And it often has an impact on who wins or who loses the election.
All right, Barbara Perry, always great to talk to you. She is professor in presidential studies at the University of Virginia's Miller. Developments in that regard this week, and flagged Vladimir Putin has just returned to Russia. While Asia's relationship with Russia is one thing to watch, so too are other relationships like that with West Africa. You had a conversation with Ian Bremmer about this. What did he say?
Yeah, it does take us back to Russia. And we aren't really paying that much attention because of Ukraine, because of Gaza, because of China, South China Sea.
The Russian government has secured direct access to, gold in the Central African Republic, as well as in Sudan, platinum in Zimbabwe, as well as the CAR, uranium, as you mentioned, in Namibia. Right now, the United States still is trying to stop that. They're trying to actually ensure there's money to increase production in the United States. Again, you've seen the Bill Gates announcements on your own Bloomberg that they don't have to get it from Russia. But the more that essentially the lead supporter of many of these illicit government teams in Central and Western Africa, the Russians are going to over some critical nodes of the minerals that are necessary for a
there. And one of the reasons we really wanted to take a look at this is we tend to think about China in terms of African and as we need to with Russia going in there. And of course, at the same time, President Macron is a little distracted at the he's called coming up that are a real problem too that we also talked to Ian about.
Well, what did Ian say? That election in France and what caused Macron to call that snap election, the far right wins for Ukraine as it fights this war against Russia.
Yeah, boy, that is a big issue. There's no question about it, Kaylee. Yeah, I think didn't have too much of a choice because he was going to have problems with his parliament no matter what. There was going to censure, they're going to have problems with the budget. So he felt he had was the left coming together and really putting only one candidate per district in so that we really have like on the left and on the right with Marine Le Pen and her party. And that is and what he called right, Kayleigh, because Marine Le Pen and the far left is not necessarily going to be a big support. It could have ramifications for the EU more broadly.
So many elections throughout. What else do you have coming up on the program this evening aside from Ian Bremmer?
Well, of course, we have Larry Summers on. He's going to tell us about generative AI, because he's on the board of OpenAI now, and he has an fight the war. You don't want the AI developers to decide what happens with AI. You need some government regulation. Talk with him as well about OpenAI and why it's driving so much of the markets right now. Glenn Hubbard coming on saying, actually, there's a different economic model we should be looking at as we look at this election coming up in the United States. Just choose between mercantilism of Donald Trump on the one hand and sort of what he calls a fuzzy industrial the other. He thinks there's another way to carve it that would make more sense for the economy.
Fuzzy. Forward to the program this evening. You can, of course, catch that at 6 p.m. Wall Street time. Before we get there, though, Bloomberg Business Week with Carol Massar and Tim Stenovic. It's coming up shortly. Tim, what do you got on the program quickly?
Hey, we got and it could be near a deal to stabilize its supply chain, Kayleigh.
All right, looking forward to that. Meantime, I'll see you back on the late edition of Balance of Power at 5 p.m. Eastern Time, right here on Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, designed to do.
Well, that started in 1977 when research station, and 4 of my students were kidnapped, and everything shut down. An institute so that this research can carry on. Bless them. So that was 19 to study, conserve chimpanzees and other animals and educate. Then, so it's, you know, we've got 27 Jane Goodall Institutes around the world. At some point that people living, the African people living in and were struggling to survive. There was crippling poverty, lack of health and education, being exposed to diseases like Ebola and HIV from the chimpanzees. If we don't help these people to find ways of making a living without destroying their
From the beating heart of global finance, economics, and politics, Bloomberg brings you conversations that allow for deep discussions and important insights. How has Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. At 9 a.m. only on Bloomberg.
Is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and
live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week. I'm Carol Masser along with Tim Stenovec. Let's Friday, June 21st. S&P 500, Tim, actually on track for another week of gains. It would be the third in a new highs, but also a kind of a meh feel, if you will.
And of course, that break on Wednesday,
right.
4-day trade. Taking stock of what's going on there. We're going to have much more on the trade in just a moment. Also, speaking of stocks that are moving, the company could be near a deal to help stabilize its supply chain.
Yeah, we're going to get into that in just a moment. Plus, how is the doing? Just ask the nation's convenience stores. We're going to get into that a little bit later on, too.
And the honeymoon is over for the world's biggest. We got Sonali Basak joining us on that in just a few.
Yeah, one of the most read stories on the Bloomberg. And forget about it. Market Watchers has to say she's seen a lot of market cycles. She's going to get into what you really should be.
Checking the day's trade and top business stories. Here's Charlie Pellet.
Thank you very much, Tim and Carol. We got the Dow higher barely, in which derivatives contracts tied to equities, index options, and futures all mature. Right now, 0.1%. The Dow lower by 2 points. We got NASDAQ down 43. For NASDAQ, a drop right now. And your yield, 4.25%. 2-year, 4.73%. Gold is tumbling 1.8%, now down $41 the ounce to $23.18. West Texas Intermediate crude down 0.7%. WTI 80.70 for a barrel of WTI. Major sell-off in tech today with NVIDIA shares dropping now by 3.2%. CarMax shares, they are lower now. CarMax down 0.2% this morning. The used car dealers' first quarter earnings slightly beat the average analyst estimate. Again, recapping the Dow, the S&P, NASDAQ, all in the red. S&P down 0.2%. NVIDIA, the stock to watch, down now by 3.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie. Thank you. Boeing, once again, back on our radar. Shares little changed in the Friday trade, but this is coming as Spirit Aerosystems Holdings to take over parts of the aerospace suppliers business. So that would as early as next week.
Well, I hope keeping us current on it all. And back with us is Bloomberg Intelligence Senior Aerospace Defense. So, George, remind everybody, Spirit Aerosystems spun out from Boeing a little over 20 years ago with the 737 MAX and the door plug incident back in January. Remind everyone what Spirit Aerosystems, Airbus versus Boeing, part of sort of carving this company up.
Yeah, so they're an aerostructures, supplier. So that means they make the fuselages for aircraft. They make wings as well, but they make sort of the body parts is probably the easier way to say. They make a large portion of the Boeing 737. They make almost the entire fuselage. And when spun them off, that's the primary business they had, and they've added to that since gone out to other manufacturers like Airbus and picked up pieces of the A350, the A220 program, which is the old Bombardier CC programs, and most of it again is sort of is body structures. Still, the majority of the revenue and profit they earn at the company comes from Boeing. Typically, the 737 is by far the largest program, revenue generator, profit generator. As Boeing carves this path to improve quality on the 737, right through Spirit Aerosystems. And I think as they got into the problem and tried to figure out whether they could make, they decided that the only way to really have all the control they needed to and retake Spirit into the Boeing fold. But the challenge is, like I mentioned, there's the 350, the 220, and the A320, we think that are largely loss-making. Add business to their portfolio. Lots of times they would add business at low prices in hopes they built in efficiencies, they could turn it into a more profitable business. Now they got to get that loss stuff out of the company so they can reintegrate with Boeing.
So I'm curious, some kind of deal. It's often to, economies of scale, strategically it fits in, financially it's a bit of the Aerobus exposure, if you will. But for Boeing, is this more about move and helping to get their supply chain in order so that they don't have any more issues and problems or serious,
So I don't think there's much of a financial play here, especially sort of near term, right? So if you look at expected this year, it's right around zero, right? And that may be a little bit optimistic. And so we've seen this all through aerospace as we came out of the pandemic. There's been a lot of supply. The tier up has to come in and buy them to stabilize their supply chain. This aerospace.
So I'm really interested in the idea that this actually helps shore up. Is there any indication that this is something that getting this in control at Boeing to help Boeing fix its big issues?
So I think it can, right? It's doesn't mean everything's better and everybody can breathe easy now. Some of the testimony of CEO Calhoun, I think it was this week. All these weeks run together after. And it was before the holiday, so it seemed like it was another week. If you listen to his testimony, fuselages out of Spirit. And so those fuselages were even moving up to Renton and be area to go into Boeing's assembly facility and still being worked on employees up there with Boeing inspectors. So what this gets them at least is a very Boeing owns Wichita, the facility. Boeing can institute and inspections there, their training programs there. I do think one of the fixes here too is that between a supplier and the company it supplies to, right? Because Boeing was always looking down more of whatever. We want to lower the price on you, so because you're going to get economies of scale, that we can enjoy some of those margin gains and make more profitability. This gets rid of that, right? Boeing side of the world about what Spirit could make in efficiencies, and it gets rid of some of that tension. Important enough part of the airplane that will help a lot. This gets everybody on the same team.
A little bit like a soap opera, like I love you, keep the company, have the company, get rid of it, bring it back. But it's interesting because they ability. So it almost speaks to the broader strategy thing, right, at Boeing. under their roof all along?
So, I mean, I guess there are a number of other aerostructure manufacturers around the world. You don't find a lot of them. Sometimes our profit hurdles in the U.S., our return on capital numbers don't really make it fertile ground here in the U.S. for this business. So that said, I think had Boeing not had a grounding of the MAX and then a pandemic, there's a potential that Spirit could have continued to move along, maybe not with the greatest margins, maybe not the best, could have continued to be independent. So I'm not going to say the decision alone was wrong. I think in time, outside the U.S., but I think Spirit also has the right to build the 737 fuselage. 737, and so that kind of kept that business right there. But I do think in time probably would have been offshored to lower cost domiciles.
Hey, George, before we let you go, 30 seconds, because we have the U.S. Justice Department is going to require Boeing to install an independent federal monitor to oversee safety and quality issues of all this as Boeing tries to right the ship.
Yeah, I mean, it doesn't sound to me like it's, I would have thought there would have been more oversight, and this sounds like one of the ways to do it. So it's probably has to get it right themselves, right? Because they're the experts in making aircraft. They got to become that again. So, but yeah.
Analyst George Ferguson joining us from New Jersey. Boeing certainly top of mind, Carol, when it comes to company news today. It comes to the broader U.S. economy.
Yeah, Tim, that on a day when U.S. services activity picked up marginally early. Price pressures and prospects for lower borrowing costs. Also, we did get a data point on sales of existing homes. Straight month in the month of May, while prices set another record, that really underscores persistent affordability challenges. Another interesting data point when it comes to U.S. economic activity. We love this. With more and a look at the broader that's where we find Bloomberg News global economy reporter Enda Curran. Enda, good to have you here. We do want to get to that data today, the clues that we've got throughout this week, the retail sales data, which is what we're going to get into with you a little bit more.
Well, I think on the housing data that you mentioned there, it just reinforces the idea that the housing market continues this state of high interest rates, surging strong demand for houses, but high interest rates and low in a rut there, Carol. But more broadly, I think the mix of data this week, it sends mixed signals, but pace, not a crash landing, a hard landing or anything like that. But I think every week we seem to get a new data point suggesting the way policymakers want it, but the big question going into the second half of the year is how much slower will things get?
Newsletter that came out just yesterday, and we can't stop talking about it, Enda, because economic data that I think it's fair to say kind of rules our lives here at Bloomberg in a good way, but there's also the anecdotal data. A little bit about what one convenience store CEO is telling us about the state of the U.S.
To your point, this was a bit of a step away from the raw numbers. Yeah. I spoke with the CEO of one of America's Arco Core. Ari Cutler is the CEO there. So I had a chat with him. For context, towns, Main Street, sometimes in border areas. So he's on the front line of the trends, and what is that they're spending less. In particular, they're spending less on cigarettes and spending less. He reckons it reflects the high interest rates, the mix of inflation, and of course fluctuating. It's, again, he's not saying this is a crash landing or anything, but he's saying it's different to what it was last year. Consumers are coming to his They want bargains, they want value. He's seeing promotions for his hot dogs and his pizzas because they're watching their cents and their dollars. So, it's a tale from the ground when you speak to people like that what the official data is telling us, that things are cooling from that big boom last year. And this is what I was trying to say. Okay, but the big question is just where will it go from here? Will this glide path continue in the second half of the year, or will it be money? That's for sure.
Yeah, and it feels like it mirrors so many of the conversations that we have around the newsroom or with colleagues or with friends and family about where they're purchasing, or just still kind of cringing at some of the costs of different items. Having said that, it does feel like everything's falling off a cliff, and I don't hear a lot of people talking recession here in the U.S.
No, and that's because as long as the jobs market is strong, people have money, they will pay back their mortgage, and they will go and spend. Unemployment in free fall when things change dramatically. But again, the labour market, we see some cooling. A year ago, he was really struggling with either filling positions and turnover. He still is struggling. The door the way they were, they're hanging around, and he thinks that's a sign. That's a sign they have fewer options.
Yeah, that I want to get back to this one comment that I had to read a few times, and in your piece, it's that people are moving to more spending the money they did in the past. What did he mean by more valuable items?
What he's talking about there is, look, he's never seen as many promotions, he said, by the way, in his time. He's been in this business 20 years. That he buys products and goods off, they all want to run promotions as well, because everyone's looking for a bargain. Remember, at a record level, delinquencies in credit cards are picking up, so people are feeling some strain out. Into when you walk into a store, you're just not splashing the way you were last year. You're being a bit more careful about it.
It's interesting what we've seen from companies like Celsius Holdings and Monster Beverage in recent weeks. They're in that category. And if I think of something that's sold in convenience stores that is kind of pricey, it's energy drink in recent years. And if people are pulling back on that end, that could be a signal.
Yeah, for sure. What that Ari identified was cigarettes. And that's one of his biggest sources of revenue and sales. And rather than buying cigarettes, that's a trend, a clear trend that he's noticed. And he says when you see that, that's when and that's why he's making the comments that he is.
I have to say, I'm not a smoker, but I didn't to $60 in the United States.
It depends where you live, because the taxes are such a big part of it. Like New York City, they're extremely expensive.
McDonald's, like bringing back the value meal. We're seeing kind of a little bit of a kind of price war, if you will, among the U.S. economy versus the rest of the world. Still doing fairly well?
Still doing very well. Wages go so much stronger here than the rest of the world. No hard landing. But as I say, let's see how it all plays out into the second half of the year.
Thank you so much. Have a great weekend. Enda Curran, he's our global economy reporter at Bloomberg News, joining us there from our Washington, D.C. book. All right, anecdotes and so on and so forth. I think these are things that tell you so much about what's going on in the economy.
Stop, Admiral, Breadbox, Corner Mart, Dixie Mart, Easy Mart, Flash Market, Handy Mart, Jets, Jiffy Stop, and more.
You see a lot, right? And this dude has been doing this for like 20 years, so he sees a lot. He might not call himself a dude. I call him a dude. Biggest real estate investor is moving into riskier new terrain. That when we come back.
This is Bloomberg News Now.
News when you want it at the
All day on Wall Street, we're seeing big moves.
all eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on
Bloomberg News Now. Context changes everything.
The top names at the Fed are on Bloomberg.
The way I look at restrictive monetary policy in place, it has shown up in terms of moderating the balance.
I do think that our new steady state is likely to be higher than what people have known over the last decade, all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context.
People ask me all the time, what is the key to being a really good investor? And I tell them it's the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world.
Invest for the long term, i.e. when markets are challenged, don't get spooked. Don't invest in hobbies. The investment hobbies are generally not profitable.
Bloomberg surveillance and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and the UK decides on July 4th. Border security, foreign policy, and more. Voters head to the polls to choose the next leader. Election, and we'll bring you the results after all the votes are tallied. Tune in for television. Context changes everything.
It's 2:21 on Wall Street. We do check market. Turnaround for the Dow Jones Industrial Average since our last update. Right now, the Dow up 55 points. That in the red, Wall Street's massive expiration of options not only left stocks struggling, it also we're talking NVIDIA to a roller coaster ride. NVIDIA shares trading lower now by 3.3. Down 0.1%. NASDAQ lower by 24, drop there of 0.1%. The Dow up 0.1%. 10-year 4.25%. The 2-year 4.73%. Gold down $40 the ounce to $23.19, drop there of 1.7%. And West Texas Intermediate crude down 0.8%. 80.62 for a barrel of WTI. Four of the biggest banks on Wall Street must improve their blueprints for a hypothetical wind down. Washington found weaknesses in their plans. Those four big banks, J.P. Morgan Chase down 1.29% today. And among some of the other names, among those big banks, also, as I mentioned, Goldman Sachs had a shortcoming, according to the FDIC and the Federal Reserve. Recapping, S&P down 6, down Peloton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So you guys might recall, that caught our attention in a big way. It was when Blackstone, best known for its private equity business, began buying up foreclosed homes. And then they rented them out.
And then they spun off the whole company that did that. And they're still in real estate.
Exactly. Blackstone, investor, and as such, they've not been immune to the impact of higher rates and real estate stress, including withdrawals from the Black money to work. Bloomberg News global finance correspondent Shanali Basa caught up with Nadeem Medji. He's earlier this month.
We fulfilled 100% of redemption requests over the last 4 months. That is what differentiates us from other players in this space.
All right, well, Shonali joining us now with a little bit big take, which is among our most read stories on the Bloomberg, and it's all about Blackstone's gigantic property arms company.
It's roughly a third of Blackstone's trillion and some assets under management. It's Remember, Chief Operating Officer, President John Gray really grew up in this business.
Mm-hmm.
They've had some of their biggest profits on Hilton. They just stunning profit there. So they tell investors in times of stress or having blowout returns. What does this year look like? At BREIT, which is one of the main funds retail investors have invested, where we've seen fits and starts of redemption waves over the last return is 2.3%. Annualized.
Feels a little anemic.
Inception to date. What?
Feels a little anemic.
It does. Inception to date was 10%. And so what is happening now? Our team, Jack Sitters and themselves. One is from the co-head of the business, Kathleen McCarthy, who goes, buying cheap isn't a here is that prices they haven't said have bottomed, but they say are bottoming. So they are diving in. They have they have been spending billions of dollars this year. They plan to spend billions more.
It is, but like you said, Shonali, it's a different time than post-financial crisis when you have really low in value to go out and buy. That doesn't exist in the U.S. anymore. What is attractive to Blackstone?
About their strategy. If you think in the last several years, what they've doubled down on time and time again, they have this massive bet on data. About housing, they have been pretty prudent about it. They've looked to the Sun Belt, and when they have invested in housing, they've also invested. They've said they've shied away from much of the struggles you've seen in the office sector. But again, prices now are. They're also betting here that interest rates start to come down sometimes, and that inflation has peaked. And so if interest, even if they go higher, then you start to see more struggles in some of the asset classes that they're prone to.
I mean, to be fair, though, they have a
They certainly have, and I've got to say it's interesting because you have to understand the problems that they're facing now is just a matter of their exposure to real estate around the world, but also a matter of investor confidence. So when we think about you have a multi-year issue, you've had redemption start to slow more recently. The problem here is a couple of weeks ago, almost a month ago, Barry Sternlicht had a fund linked to Starwood Capital that for investors looking to redeem. Then investors started to pull money at a faster rate from Blackstone's fund going on in the market. So Blackstone did this really interesting move, and they ended up for that period going up. Investors.
So explain that a little bit in terms of pulling out money, right? Because typically investors, right, Blackstone starts a new fund or how does redemptions typically work? Is it when the investments are made, or is this the money that's
two types of investors, really? There's these long-term institutional investors that put these money into drawdown funds and they keep it there. Then there's things like BREIT, where you can pull money as an investor. These are typically made for wealthy individuals. You can interval between them. So you can only pull investors in aggregate to a certain amount. Now, are trying to make this possible for more and more investors. So every single private asset real estate fund and say, how do they navigate this? Most investors say they're doing what they're supposed to do. Blackstone has allowed them to. Now, to your point, this is money that has not been put into new deals yet. What they couple years ago here, when they started to feel some of that pain, they brought in a massive investor, $4 billion. I've got to say, this story is worth reading because they did this deal while the co-head of Blackstone Real Estate was off on his honeymoon.
Good. That's a great spouse.
But also on his honeymoon near where John.
Honeymoon near where your boss?
Exactly. I was thinking the same thing when I read that anecdote.
Well, and honestly,
love them, but no.
Your boss is listening and watching right now.
Love them, but no.
Okay.
Right.
They don't want to be near me, probably.
The wife might not have loved that too much. Week tour among investors too. So this is very much a live situation.
I want to talk about alternative asset managers and sort of like the portion of real estate that it has on its books versus at its peers.
It's greater. Blackstone is the largest. And if you let's look at other comparables, for example. Apollo, more than $500 billion in assets, is under private credit.
Right.
Yeah.
Whereas it's more like 3-4 credit exposure. Blackstone has been known for this real estate exposure. They have been diversifying at other places, credit, insurance. And also retail funds. These wealthy investors are piling into these private assets despite
You know this so much, right? Like the rise of alt assets in all their forms, whether it's real estate, whether it's private credit, to democratize and open up the access for all investors. But as you know, I was at Pershing Insights at Franklin Templeton, the head, and BNY Mellon, and just this idea that, yay, great, but people plain vanilla assets.
It's totally a massive debate in the industry. How do you structure these funds? And listen, if you're putting money in and they need to take that money and put it into strategies for 10 years, it's hard to pull out. So you need to figure out that liquidity equation for investors. Jenny Johnson, known for really creating the mutual fund industry in a big way, and she now is very much at the forefront of trying to make private asset structures like this more mutual fund-like. And it's a conundrum because people like us would probably want a piece of the pie, but then they can't get their money back when they need it.
Mellon Pershing, who was like, yeah, okay, get it, but you got to understand that moving in and out is not like moving in.
Private equity is easy to buy on an iPhone.
Yeah, but you're supposed to be rewarded for that lack of liquidity.
Yeah, and up 2.3%, are you? Depends on when you bought in.
Bottom line, Blackstone Real Estate, big business. Okay, but we'll see. Time will tell, right? Longer term.
It's a pivotal moment, and they're new leaders. And honestly, John Gray has long been known. So it's a big moment for these new executives at the real estate business. It's certainly a big moment for John Gray as well.
All right. On it, Shanali Bosek, really good stuff and an important story. And as we said, there's just these great turns and twists. Story, so check it out at Bloomberg.com and on the terminal.
Hey, we got a mixed market on this Friday afternoon. 500 are both down about 0.1%, but the 5-day outlook or 5-day of these they're in the green, Carol. The Dow up 1.3%, the S&P 500 up 0.6% so far this week.
Forget data dependency and instead listen to companies. This, yes, has to do with the upcoming earnings season. So we're going to get on Bloomberg Business Week.
First, though, a check on the latest world and national news. We get Amy Morris in the Bloomberg 99.1 newsroom in D.C. Hey, Amy.
Firearm possession by people who are under domestic violence restraining orders. Duke Center for Firearms opens the door for future gun legislation.
It's somewhat narrow in that the court doesn't, even other related issues like banning convicted felons from possessing guns, convicted of nonviolent felonies, and sort of leaves those for another day.
Justice Clarence Thomas is the founder and majority owner of Bloomberg LP, the parent of Bloomberg Radio, and is a donor to groups that support gun. Steve Bannon has asked the Supreme Court to delay his prison sentence while he fights his convictions for defense. Committee that investigated the attack on the U.S. Capitol. Now, the request comes after a federal appeals court panel 4-month sentence. And this weekend promises to be a scorcher. The National Weather Service says the heat and humidity. New York, Boston, and Washington, D.C., possibly breaking all-time records. Global news 24 hours a day. And Amy Morris, and this is Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got that as, moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever speaking for me, I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actually.
Intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing,
long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead and so you need long-term investments in science and research.
you have an ecosystem of companies coming together.
Covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
The valuation environment has fundamentally changed. Private equity sponsors are just going to have to hold companies longer, are going to need to get things done, and returns are going to be lower over the next few years.
If you go back all the way to 2007, we used to have high prices, and if you look at those vintages, even the GFC vintages have done
everything.
Liquidity is the lifeblood of an airline. Conservative decision-making about when we raise funding and how we raise funding. We try to diversify. And we like to build in flexibility in these financing
space. Say is that we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg, Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Triple Witching Friday. We've got stocks trading mixed right now. The Dow Jones Industrial Average holding on to a gain. The Dow has been all over the map today, swinging between gains and losses in a volatile session. Up 21 right now, up less than 1/10%. S&P in the red, down 9, drop there of just about 0.2%. NASDAQ down 36, a decline of 0.2%. 10-year yield, 4.25%, with the 2-year that's yielding 4.73%. Spot gold down 1.6%, down $37 the ounce to $23.22, while West Texas Intermediate crude down 0.9%, $80.59 a barrel on WTI. NVIDIA has shed $200 billion in market cap or in value, I should say, amid a 2-day sell-off. We've got NVIDIA down now by 3.3%. Heading in the other direction, Sarepta Therapeutics, that stock up 30%. Its gene therapy has received expanded approval to include more children with a deadly muscle disease, expanding the market for a controversial treatment that still has not proved its benefit in clinical trials. Again, Sarepta Therapeutics up now by 30%. Recapping stocks trading mixed, the Dow higher by 18, S&P down 9, down 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie there with the lowdown on the trade today. It is Triple Witching Friday. We've all been saying it a lot.
It feels a little spooky, doesn't it?
I don't know. Is it really? You know what it's all about.
Let me have
witching,
it, Carol.
derivatives, contracts tied to equities, index options, and futures, all maturing.
Yeah, easy for you to say.
Yeah. Okay. So it's a reminder, too, that we are almost halfway through the trading year, which is kind of phenomenal. A year when we constantly debate over when the Fed may cut rates. And as the Fed reminds us constantly, we are data dependent. We talk about it. Nancy Tengler says, don't focus on that. Here with what we believe, or what she believes we should be keeping our eye on, is the Chief Investment Officer at Laffer Tengler Investments, Nancy Tengler, back in our studio. It is nice to have you back with us. How are you?
I'm well, thank you. Thanks for having me.
Well, thanks for being here, because we do talk about, we kind of as a joke, we'll be like, but we're data dependent. You say maybe don't be so focused on that?
Yeah, I think what for me, Carol, was when Christine Lagarde at the ECB came out and said, we're raising our inflation estimate. We didn't hit our wage criteria, which was wages rolling over. They actually went up in the EU, and we're cutting interest rates. And then you follow that on the heels with Chairman Powell, and maybe I was over listening, but he said a few things. I mean, previous meeting he was like, well, we'll react to weak labor, and I do think the labor market is softening.
Yeah.
And then on top of that, he said, well, if you're at 2.6 or 2.7%, that's a pretty good place to be. That's a direct quote. And so I'm wondering if the Fed is kind of preparing at least themselves, if not the market, and they raised their inflation estimates for the year.
And yet still said we're going to get a cut.
And we're going to get a cut.
We were all talking about that. Mike McKee was talking about it. Like, what changes Fed Chair Jay Powell at the end of the year, if you think it's going to be okay time to cut,
right.
And yet we're pretty much in the same economic scenario, right?
Yeah. Yes, absolutely. And I think one of the reasons that they are eager to cut is you have the Treasury funding this massive amount of debt. Now it's over 50% at the short end of the curve. And so the weighted average cost of the debt has gone from 1.8% last January, not this one, the previous year, to over 3.3%. And the net payments this year are going to be $870 billion according to CBO, which is always wrong. So count that as $1 trillion in just interest payments. Something's got to change.
It's not. You don't actually hear politicians talking about that right now, interestingly enough. it's like a sort of a lonely chorus of folks who are talking about the risk that exists there. How big of a risk do you think that is?
I think it's significant because if you're, the CBO quotes debt as net debt. So they say we're at 80% of GDP, but they don't count the debt on the Fed's balance sheet. So we're really at 130.
Yeah.
And that's third world country-ish. In a growing economy with a really tight labor market, we should be reducing the deficit, not exploding it. And so stocks don't care yet, so we're still pretty bullish. Yeah.
When will they care?
I don't know.
What will make them care?
What's the hissy fit that happens in stocks as a result of
Well, you keep hearing will it be a Liz Truss moment? I do think that's a risk, that the markets, the bond vigilantes just come in and say enough. And then there's even more volatility. I mean, I've been doing this for 40 years. I've never seen so much volatility in the bond market.
I will say it's really interesting. I do feel like investment professionals like yourself are talking a lot about it. And at some point, the government has just so much money to play with. And so where do they cut back? And then how does that impact the economy? I feel like that's when maybe citizens start to sit up and take notice, perhaps.
Yeah. I think they're starting to, because what I think the average person knows is that all of this fiscal spending has driven inflation. And there's only, as critical as I've been of the Fed, there's only so much they can do.
Yeah.
I mean, they've got one hand tied behind their back because the spending just continues. And, we still have a lot of appropriated but unspent funds, in the trillions of dollars that the administration is going to try to get as much of that spent this year as they can. I don't know how much that will be, but
you've been critical of the Fed, but one thing that we've heard from Fed Chair Jay Powell several times in recent months has been talking about the Fed's independence and his own independence. And there have been some questions about what happens if President Trump wins in November to the independence of the Fed. How are you thinking about that?
So I think he doth protest too much. I think he waited a long time to raise rates. And I was at a dinner with...
You think Jay Powell protests too much or Trump does?
About his independence, because I don't think he acted very independent. I think it was a pretty political move to hold off on raising rates as long as he did. And that really allowed inflation to get out of control. I was at dinner with a prominent senator, and he basically said, we all know that he was waiting. And I've never heard anybody say that out loud. So I think they should be independent. I don't think there's anything Trump can do if he is elected except go on X and berate him.
Right. Well, I do want to point out that perhaps if Jay Powell were sitting here right now, he would push back and say,
"Oh, he would."
At that point, we thought that inflation was indeed transitory. It was
right.
Supply chain driven. We didn't think it would become as entrenched as it did in the American economy at that point." But
yes, he would say that, and I would say you were still way too late. The rest of the world saw it, and they waited way too long. And we didn't see a hike until March, when inflation had been really bubbling up pretty dramatically since the previous year. And we were writing about the fiscal spending back then. It was very lonely, but
back in
2021, yeah.
The other thing, I think it's also fair, right? There's been so much liquidity thrown into global markets, right, Nancy, because of the pandemic, and we're still kind of figuring out how it all plays out. Right, and keeping up with it.
Right.
And that's what we're talking about. There's still a lot more liquidity out there.
Yeah, and it's interesting because if you just think about all the old rules, like what did everyone think when rates went up? They thought it would hurt technology stocks. They've been the biggest beneficiary because they had fortress balance sheets. They'd already refinanced their debt, and their interest income. No, it's exploded.
Yeah.
And so
they're making money on all that money.
That's right.
It's on their balance sheet.
A
basically.
lot of money, Carol.
Yeah, exactly. Yeah. All right. Having said that, the thing you say we should though is listen to what companies have to say.
Yeah.
I mean, I get excited about earnings because I do feel like
earnings.
I feel like it's a gut check.
We love it.
We peel back a little bit of the layer, right? We hear from companies about how things really are and whether the narrative, the valuations, whether or not they make sense. So that's important.
Yes.
We've got a great chart, and I think if we can bring it up, but it just talks about what we've seen in terms of earnings expectations, blended forward EPS, which is the blue line, and the orange line is the S&P 500. You can see how they've been tracking really well together, but the outlook for earnings continues to rise. That's important, though, what we see and what we hear from companies.
Yeah, it's everything. I mean, that is ultimately what stocks trade off of. That's why I think you ignore at this point what the Fed is saying, what data they're depending on this next meeting, because the trend line in corporate earnings is positive and margins are expanding. Now, Not every company. We saw it last quarter. If you missed on any metric, you got clobbered. But if you just look, generally speaking, like in our 12 best ideas portfolio, we had a number of what Bespoke calls triple plays: beat, beat, and raise. And that's sustainable. It's frequently in the area that we've been talking about ad nauseum, which is generative AI, cloud computing, but also in our investing theme of old economy companies that are embracing those technologies. Think Walmart, think Chipotle, which is one of our 12 best ideas. Those are companies that are benefited from utilizing digitization and all of these technologies.
Avocado, anyone?
Avocado.
You know the avocado?
No.
It's a machine that takes care of the avocados for guacamole at Chipotle.
Because they're all fresh. It's so time intensive
it takes so much time to make
all the guacamole.
Got the avocado.
So
Brian Nichol tells us about it all the time.
And the Chipotlanes, and they've got their own language.
Yeah, they absolutely do. Nancy, thanks so much. Have a good trip home and a good weekend.
Thank you.
Nancy Tangler, Chief Investment Officer at Laffer Tangler Investments. Coming up next, more on the markets. Options Insight is next.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Apple is withholding a raft of new technologies from hundreds of millions of consumers in the European Union, citing concerns posed by the bloc's regulatory attempts to rein in big tech. Apple up today by 0.3%. The company says it will block the release of Apple Intelligence, iPhone mirroring, and SharePlay screen sharing from users in the EU this year because the Digital Markets Act allegedly forces it to downgrade the security of its products and services. Again, Apple shares, they're up 0.3%. Four of the biggest banks on Wall Street must improve their blueprints for a hypothetical wind down after top regulators in Washington found weaknesses in their plans. The FDIC and the Federal Reserve say the so-called living wills of J.P. Morgan Chase, Bank of America, Goldman Sachs, and Citigroup all had a shortcoming. Shares of J.P. Morgan Chase down today by 1.3%, Bank of America down 1%, Goldman Sachs down 1.4%, and Citigroup down 1.3%. American Express has agreed to acquire Talk for $400 million from Squarespace, adding a service that helps customers book dining and other hard-to-get reservations at exclusive venues. American Express today down 0.2%, Squarespace up 0.1%. And CarMax shares are gaining after the used car dealer's first quarter earnings slightly beat the average analyst estimate. Analysts, including Morgan Stanley's Adam Jonas, say first quarter results were largely in line with expectations. Again, CarMax down by 0.6% after initially trading higher earlier on. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, a very interesting week. Records for both the S&P and the NASDAQ 100. No trading Wednesday because of the Juneteenth holiday. And then we wrap up with triple witching, which brings us to Options Insight. And let's get to Bloomberg News Chief Markets Correspondent Abigail Doolittle with Alone Rosen, Head of Derivatives over at Oppenheimer. Abigail, all yours.
Thanks so much, Carol and Alone. Great to have you with us. And what a day it is. I understand from our conversation earlier that today could be a record expiration day, more than $5 trillion worth of options expiring, stocks, indexes, and ETFs. Why is that, and what does it mean?
Great to be back, Abigail. And what we're seeing is just a big volume push up in single names specifically. Stocks like NVIDIA are taking over even the SPX in terms of volume and importance. The 0 days to expiry phenom specifically, you're seeing that today in that stock. So we're seeing a big push of expiries coming off today. And what we're seeing out of that is ETF flows are a lot lighter. Hedging flows remain very minimal relative to the past. And all the action is the dispersion underneath the surface in single names, where you're seeing rotations into large cap tech for a while now with the AI frenzy. And now we're seeing maybe, can we get a rotation back into cyclicals, which you got a little taste of yesterday.
Super interesting. So next week, do you expect that big tech options won't be as well supported? Do you think that we will see that kind of valuation into, say, that rotation into value and away from growth? Or sooner rather than later, do you think the NVIDIAs and the Apples get going again?
You know, it's been the question of the year for that matter. NVIDIA almost tripling at the highs yesterday, and this AI frenzy is real. You know, we're even incorporating autonomous AI agents such as Agent Smith in finding actionable ideas. We use Perplexity for generic research assistance. So we just don't know how far this application can go. So the PE and the price to earnings and all of the fundamental metrics really aren't coming into play here, and it's all about sentiment. So we do feel like we are seeing that sentiment peak a bit. Everybody and anybody is talking about NVIDIA specifically. So, you know, can we see some sort of short-term top and get that rotation versus risk off? It feels like seasonally we could be choppy next week, but early July has been extremely positive, you know, up until mid-July where that turns. So, you know, we're being cautious on the short side, but you are respecting the ability. If you are long and you have a nice performance year to date, it's probably a good idea to spend some money on protection.
And in about 30 seconds or less Alone, what are your thoughts on this JP Morgan collar on the S&P 500 that I keep hearing about? I know that a lot of people are watching it.
So that strike is, I believe, 56.55 on the S&P 500 cash. We're a bit below that. We stopped around 5,500 the other day. It could act as a ceiling. It's not huge size, but it's something that's going to be on the radar until next week. And kind of why we're comfortable that maybe we might see a contained move, if anything, an upside grind versus maybe a collapse. So we kind of feel like the market could stall a bit before maybe moving into the quieter July 4th week with that upside cap in mind.
Great perspective. As always, look forward to chatting with you soon. Alon Rosen of Oppenheimer, thanks so much for joining us for Options Insight. Carol and Tim, back to you.
All right, Abigail. Thank you so much, Abigail Doolittle, our Chief Global Markets Correspondent. All right, joining us there with Options Insight. We're getting ready to wrap up this hour.
Yeah, it was a good hour, and we had a good couple of hours coming up on Bloomberg Business Week a little later. We're going to be joined by Dana Hull in just a few minutes out there in Silicon Valley. She covers Tesla and Elon Musk, and we're talking about something that we don't talk about a lot with Elon Musk. It's the fact that he's got 12 kids, at least as we know
yes.
of.
Whoa.
That's how it says in the story.
I know, that's true.
And we talk a little bit about his comments around population collapse and civilization collapse that he's been doing in the last few years.
He talked about it at Milken, and I got to say, I was taking notes. I mean, this fertility thing has been something he's talked about, but fertility rates are low around the world. There are implications of that, so we're going to get into that story. We're going to do a few other things. We're also going to talk about whiskey.
Ooh, that's
a rare one. It's coming up. The close, though, coming your way on TV. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
A risk-on start to the week, flipping to risk-off at week's end. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We are kicking off to the closing bell here in the U.S. Let's take a look at where things stand right now, especially when it comes to equities. The S&P 500 has been weaker for most of the day, though it did briefly go into the positive at midday. It really couldn't hang on very well. Most of the focus really on the expiration of options tied to stocks and futures, and so we see a big pickup in volume. NVIDIA is a big reason why the S&P 500 isn't gaining very much traction. Down for a second straight day, currently off by 3%. There's no fundamental catalyst for the two-day retreat, but it does speak to how quickly it's risen over the past month, the past 6 months, the past year and a half. All right, let's take a look at the 10-year yield. Little change right now, 4.25%. And dollar-yen, of course, we're keeping an eye on as it approaches that 160 level that, again, led to suspected government intervention from Japan.
All right, let's go back to the equity market. But remember, just take the price action today with a bit of a grain of salt here on this triple witching Friday. Expiration on $5 billion in derivatives contracts tied to equities, index options, and futures. A mass rollover event for investors out there to close out existing positions and open new ones. You're seeing a burst of activity here as we get closer to the closing bell. S&P volumes right now 30% higher than on average. Now, this quarter's triple witching will be unique given the outsized dominance of NVIDIA. That single stock, one stock, has more options contracts expiring than any other asset out there except for the S&P 500 itself. Unprecedented. Not surprising, though, when you consider 35% of the broad market gains since the last expiry in March are now directly tied to that rise in NVIDIA, which now makes up 7% of the weighting in the S&P. Let's roll that beautiful bean footage. Amy Wu-Silverman, here's her thoughts on it.
You know, people had benchmark FOMO. They really had to jump in the pool because NVIDIA was so much of a weight of the benchmark. But you're actually seeing the opposite happen right now.
Scintillating there. Now, one of the more intriguing aspects of today's rollovers won't be the contracts expiring, but rather some of the new contracts entered. Given the record rally in stocks, the question really is, will we see more downside bets? Or will folks keep plowing into those upside call options? Short interest right now in the two biggest stock ETFs out there, Scarlett, have right now plunged to record lows.
And I'm glad you bring that up because here's what that actually looks like. This is short interest as a percentage of the free float of SPY, the ETF that tracks the broader S&P 500, the U.S. market. You can see it's been steadily drifting lower since, let's call it, first quarter of 2023 and is now making new lows. JP Morgan strategists warn that this exodus of shorts signals a heightened vulnerability to negative news. It's become basically yet another risk that investors need to monitor, along with narrow market breadth and technical indicators that suggest the rally is getting pretty extended. Romaine?
All right, seeing some excitement as we get closer to those closing bells. Less than an hour to go. Let's kick things off right now with Steve Soshnick, Chief Strategist over at Interactive Brokers. All right, Steve, every time triple witching comes around, I'm told either by one half of the community out there there's going to be a snoozer, the other half says there'll be fireworks. The complexion of this one is a lot different, particularly given the record run up and particularly given the outsized importance of NVIDIA and some of the other big tech stocks.
Hi, Romaine. Well, yeah, today actually I think we have the chance for both because we got off to a little bit of a rollicking start. There was some, there's the AM expiration of futures and futures options and some cash index options. Those are off the board. Then we sort of have settled into the doldrums. But this afternoon around the close is when the excitement can really start because of the rebalancing in XLK, an $80 billion ETF, which is basically going to be forced to, by many estimates, buy $10 billion worth of NVIDIA and sell the same amount of Apple, give or take. That can get things very spicy in the last few minutes.
Well, that's what I'm curious about. I mean, we focus so much on the S&P overall, and even the NASDAQ for that extent, but should we be paying much more attention to the specific tech indexes or tech ETFs, if you will, because it seems like whatever people rotate in and out of is still somehow going to be related to big tech?
I've been saying various times, it's NVIDIA's market. We're all just trading in it right now. And, that to me is really why we're forced to watch tech. The S&P 500 is essentially a third or more of big cap tech. The NASDAQ 100, of course, is about roughly half that. And so that's what's driving the bus, including some of the statistics you gave at the top of the show. So we have no choice but to follow tech. And, it's what brought us to the dance. And we have to hope that with the narrowing leadership, it can continue to play the music because it's definitely getting a bit, scary out there in terms of the divergences that you've alluded to and that we've been seeing.
Steve, is it me, or does triple witching become a bigger factor today than it did, say, 2 years ago? I mean, we talk about it a lot more, but by the end of trading on the day that options expire, has it actually resulted in a material move?
Yes and no. I think when triple witching is combined with a major rebalance, it can be very interesting, and you have no choice but to pay attention to it. And today, as we just mentioned, is one of those days. There are other times when the market's sort of adapted to it. Remember, the part of the allure, let's say, of triple witching was options used to options used to expire once a month. Then they started, 2006 weeklies, and then 2016 thrice weeklies, and 2022 daily. So we've gotten less and less focus on the triple witching times, but because of the uniqueness of the futures markets, and some of the biggest turnarounds have come on triple witching days, and because of the uniqueness of the fact that S&P tends to rebalance on these days, that's where the fun comes in, or the volatility, or however you want to refer to it.
I like the first choice you made. The fun comes in. We'll certainly be watching for the fun in the next 40 to 50 minutes. Do you agree with this idea that the absence of short investors in the broader market, the broader U.S. stock market, that is setting new records every day, is a sign that the rally is vulnerable?
I do agree with that to some extent. And what's also very interesting to me, I didn't check the numbers today, but as of yesterday, we had, I believe, 6 straight days in a row of outflows in spiders to the tune of about 28 billion, which is, I think, about 5% of its float. So you've got shrinking short interest, and now on top of it, you've got actually some shrinking overall interest. So it actually means that the shorts are a shrinking percentage of a shrinking pie. I'm not even quite sure what that means. Probably nothing all that good, though.
Oh, wow. I mean, this gets us to a broader point here, Steve. We talk a lot about the narrowness of the rally, the need to broaden out. And I've had some people come on this program saying that maybe we don't actually need that. And they've sort of drawn historical parallels where we've had other narrow breadth rallies that didn't necessarily end in disaster. I'm curious as to why we should think that this time might be different.
Well, I don't think it is that different. I think typically these very narrow rallies do introduce a lot of risk. If everybody were to decide that they wanted to get out of these mega cap tech stocks, who's there to buy the dip if everybody's long? I wrote a piece yesterday where I called it stock market Jenga, where we're taking little bits each day out of the foundation of the market and laying it on top, creating an ever less stable but higher tower. Ultimately, that doesn't end properly. It ends in the end of that game. Actually, there are no winners. There's just a loser, the person who put the last brick on. Yeah. I don't want that to happen. But I think that analogy is relatively sound, where we keep taking money out of other parts of the market and laying it on top of big cap tech. We have to be very careful that if there's an exit, or if there's at least a rotation, it can be orderly.
Why don't you think we've seen maybe a little bit more hedging? I mean, I understand, look, everyone wants to join in the party, get all the upside here, but the lack of shorts, or not just shorts, I should say, but just really the lack of protection, whether it's in the options market or direct shorting, it's just minuscule right now relative to how high this market has risen.
During my 25 years as an options market maker, I used to, consider my job as being the guy who sold umbrellas. And it's not particularly popular to sell umbrellas during a drought. And that's basically what's going on with volatility. I think of volatility as a hedge. I like to think of VIX as much as anything else as a measure of the institutional demand for hedging protection. And quite frankly, we haven't had clouds on the horizon in so long. I think people have sort of put aside the need to think about hedging or to think about the protection that I think is important to consider at all times.
All right, Steve, always a great insights out of you. Steve Soshnick there. Have a wonderful weekend. Chief strategist over at Interactive Brokers, helping us kick you off to the close here on a very hot Friday afternoon in New York. When we come back, a focus on the world, a focus on the yen, the dollar rallying for a fifth straight week, partly at the expense of the Japanese yen, why it could prompt the BOJ to hike rates sooner than later.
Plus, a series of cyber attacks nearly send car sales across the nation screeching to a halt. And by the way, this is not the only industry being affected. We'll have all the latest.
And one of the highest rated stocks on the street among Wall Street analysts is Microsoft, and those consensus ratings just continue to get higher. Citi raising its price target on the shares. We're going to talk to the analyst behind that call in just a second. Stick with us. This is The Close on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Let's focus now on global central banks, which have had a couple of busy weeks. You have the BOE, the SNB, before that, the Fed, the BOJ. I want to focus in on Japan, where the weak yen is one of the main factors pushing prices higher. Inflation rising 2.5% in May compared to 2.2% in April. The data backing the case for the central bank there to consider raising rates in the coming months. Joining us now is Bloomberg's Enda Curran in Washington. Enda, how much can we pin the higher inflation on the weak yen?
I mean, it's part of the mix, but the biggest driver of the inflation story in those figures was actually energy costs. But there's no doubt that the weak yen does impact tradable inflation for Japan, given its reliance on imported energy, on certain foodstuffs, for example. And you had the yen this week hitting another low, another fresh 1990 low. It's on its worst losing streak since March. It's a loss of about 11% this year. And it's getting all close to that all-important kind of 160 area that the authorities seem seem to kind of draw a red line under. So yes, the weakened yen is part of the inflation story, and it's also stoking commentary now that the authorities will have to intervene to buy their own currency again. Remember, Japan stepped in to buy the yen a couple of weeks back. Well, there's chatter now that they're getting close to that point again.
And when they did that last time, Enda, or the time before, or the speculation of the time before that here, but yet we're still always circling back to this conversation here. So it raises a question about the effectiveness of what they're doing and why they would continue doing it.
It does. I mean, there's some degree of success, I suppose, in offering some stability to it. But I think a lot of people are noting that even with bets on Fed rate cuts increasing, the yen remains under pressure. And remember, so much of this reflects the U.S. yield story. So there's no real relief in sight for the yen. And then, of course, in a bigger picture, plenty of people will say that governments can only do so much when they're trying to buy their own currency or sell their own currency in a market as vast as the foreign exchange market. There is one other twist in this, by the way, and that is that Washington, of course, continues to keep an eye on what Japan is doing with its currency in terms of when it comes to the charges of currency manipulation. The difference with Japan, of course, is that they are looking to buy their currency and make it stronger rather than weaken it. So that's why this intervention idea is still very much alive for traders and analysts.
Yeah, actually, Romina and I were talking about that the other day, that it can get a little bit confusing if you think about a couple years ago, the U.S. was concerned that countries like Japan were perhaps manipulating their currencies and entering this currency war by trying to keep their currencies weak. Now we're accusing, or not, sorry, let's not use the word accusing. Now we're concerned that perhaps Japan is doing the opposite, artificially inflating the value of the yen by buying it. So exactly what does the U.S. want here?
Yeah, it's a very valid question, Scarlett. And of course, Japan is also a key geo-economic ally of the US, and others are also on that list, the likes of Singapore, for example. I think the critical point is the US and, say, the G20 writ large do not want to see anyone cheapening their currency for competitive edge, to sell more exports. I think that's where things get really tense. Central banks and finance ministers are given some wiggle room when it comes to intervening because their currency is just moving too fast. It's too volatile, it's too choppy, perhaps it's going up too much or falling too much, and that's where Japan gets a bit of a pass here. And of course, crucially, because in the case of Japan, the currency is, they're trying to strengthen the currency. I mean, that's not exactly a hard sell when it comes to speaking with their fellow trading partners. So I think there's a different dynamic in play, but currency tensions are never far from the surface, especially at the G20 level, and a lot of governments are keeping a close eye on what each other are doing with their exchange rates.
It's curious, though, too. I mean, when Japan's name popped up on the U.S.'s watch list for manipulation, there were a lot of questions as to whether the U.S. would even feel compelled to actually try to enforce or retaliate or do anything, given the relationship that we have with the Japanese economy and the symbiosis that we seem to have when it comes to certain economic policies. Is there any sense here that we could end up in an adversarial relationship, at least economically, the way that we have with China?
I think it's probably on a very different path. I mean, there hasn't been that much comment from Treasury on what Japan has been doing, but one of the comments that they have made is that Japan is somewhat transparent when it comes to their foreign exchange policy. So I think that's kind of code for, everyone's willing to look the other way on this. I mean, there's no doubt that when you have a government intervening with its currency, like that's breaching some of the kind of basic conventions of what all the G20 countries want to agree on. But as I say, Japan is getting a pass. When it comes to China, of course, it's a whole other story. Yeah. There's a lot of suspicion what China is doing with the yuan and trying to keep it suppressed from whether or not that's helping its exports. So I think a very different dynamic at play.
All right, Enda Curran there, down there in Washington. A closer look here at the potential implications there for the BOJ as the yen continues to weaken here. I was just taking a look, Scarlett, at the Bloomberg terminal. Worst performing of the major currencies so far this year, down something like 11-12% versus the dollar. But then I was looking. Incredible. It is incredible until you look at the returns on the yen versus the dollar in previous years. I kind of forgot this. In 2022, it was down 14%. 2021, it was down 12%. And last year, it was down, just a mere 8% here. So this isn't as rare as I thought it was, but still somewhat concerning.
So it's time to go to Japan. Spend your dollars.
I was at an event. I should say I was at an event here in New York this weekend that was all about Japanese Chinese culture. And they kept talking about, hey guys, now's a perfect time for all you Americans to get over there to Japan.
I was talking to someone at Bloomberg who worked in Tokyo, and I asked him how much he spent for lunch. He was like, oh, about $7.
Yeah.
$7. When was the last time you spent $7 for lunch here?
I know. Wait till you see what like a can of Coke costs over there. It'll make you weep over here. All right, coming up here, we're going to talk a little bit about that OpenAI partnership. Citi saying that the latest OpenAI partnerships could actually supercharge growth from Microsoft. The analyst.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at noon Eastern Time. Bloomberg Equality, celebrating inclusion this Pride Month.
All right, it's time now for our top calls. This is where we look at the big movers on the back of analyst recommendations. Let's start off with Palo Alto Networks getting a new bull. This over at D.A. Davidson with a buy rating and a 380 price target. The analyst starting coverage saying the cybersecurity company enables vendor consolidation better than anyone else in the game. He sees room for growth given Palo Alto has only captured 7% of an addressable market share, quickly approaching $200 billion. Those shares on the day up about 2.5%. Next up, Palantir, though, getting a sell rating over at Monness Crespi for what the analyst calls a, quote, gluttonous valuation. Flair for words there, and he goes even further to highlight the dismal earnings season for enterprise software. His words, not mine. It says Palantir failed to live up to the 18-month generative AI propaganda cycle. In short, this analyst don't like the stock. The shares 8% lower on the day. Let's end on Microsoft, though, a little bit more of a brighter note. Price target getting raised to $520 from $495. This over at Citi with the analyst Tyler Radke, really focused on Microsoft's stake in the ChatGPT maker OpenAI. He says while OpenAI's revenue growth headlines are positive for Microsoft, he feels consensus estimates may still be a bit too high, though, in the coming quarters. Nevertheless, Microsoft, which is already up about 19% on the year, adding about 0.7% to that on the day. We're happy to say that the analyst behind that call joins us right now to dive a little bit deeper into what he thinks might actually help Microsoft. Tyler Radke, director and co-head of U.S. software over at Citi. And Tyler, let's get right to it here. I mean, everybody loves Microsoft. I was going through all the analyst ratings here, but I think it's interesting how you're linking your latest call to its actual investment in ChatGPT itself. Explain.
Yeah, happy Friday. Thanks for having me. So obviously Microsoft and OpenAI have been partners for a while. I think what investors don't fully appreciate is Microsoft's stake in OpenAI is actually showing up on their financials. So if you go through the filings in the 10Qs, in the 10Ks, there is a non-operating other expense line where effectively Microsoft's stake in OpenAI is showing up as an expense. The reason why it's showing up as an expense is because OpenAI is generating a lot of losses right now, right? This is a lot of costs in buying GPUs in terms of training these high performance models. That negative cost was effectively $500 million last quarter. And as we look out over the coming quarters, the other models out there aren't taking that into account. Now, again, this is small in the scheme of things for Microsoft. We're talking about 3 to 4 cents of EPS.
Yeah.
But that was something we wanted to flag, despite our positivity on the top line.
Well, but let's stay there too, because it was a good flag. And I mean, let's face it, most of us don't read that far down the statements to even get to that, Tyler. But that's why, you know, you get paid the big bucks over there at Citi. Give me a sense, though, as to whether that can flip to something positive, because all we hear about OpenAI is they want to flip to being a for-profit company. They want to potentially IPO. And if we do start to see valuations, at least the valuations that people want to attach to OpenAI itself, wouldn't that, in effect, benefit Microsoft's holdings?
Yeah, so over time, and we actually built in OpenAI into our model. So we think it probably reaches profitability in 2 years, maybe 3 years, depending on the ramp of that. So this is something that you see with a lot of software companies. Recent IPOs, we often see how they're burning cash up front, but then they flip to profitability. So we think it happens over time. I think it's important to note, though, OpenAI and a lot of these AI startups are extremely capital intensive, right? I mean, you got to buy a lot of chips, you got to buy a lot of NVIDIA GPUs to make these models happen. So it's not like a lightweight traditional software as a service model. So, we think that they will go profitable just given their scale and momentum. Revenues tripling on a year-over-year basis at a multi-billion-dollar scale, but still probably a couple years away.
Okay, so when OpenAI gets profitable in 2 to 3 years, as you project, what will that mean for Microsoft's stake? Will it maybe pare some of its exposure, cash in, or is it likely to increase its stake, or is it just pretty much sitting pretty with what it has right now?
Yeah, look, Microsoft invested in OpenAI before ChatGPT was even released, right? So they had incredible foresight into where this technology could go. So that initial stake, it's hard to know their exact ownership of OpenAI. We estimate probably around 45%. Ultimately, when there is a liquidity event or an IPO for OpenAI, Microsoft is going to see a great gain on that. Clearly this is a big positive. I think just a very small nuance around the quarterly numbers here.
All right, good stuff. Tyler, really appreciate it. Tyler Radke over at Citi. It reminds me of that idea that Yahoo
from the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
So looking now to the market on close imbalance. S&P 500, 780 million to the buy side. NASDAQ 100, 1 billion to the buy side. Dow 30 to sell side of 70 billion. While Mag 7 stocks seeing 160 million to the buy side.
Combined with a major rebalance, it can be very interesting, and you have no choice but to pay attention to it. And today, as we just mentioned, is one of those days. Because of the uniqueness of the futures markets, and some of the biggest turnarounds have come on triple witching days, and because of the uniqueness of the fact that S&P tends to rebalance on these days, that's where the fun comes in, or the volatility, or whatever, however you want to refer to it.
Steve Sashnikov, Interactive Brokers, kicking off today's show. Just a little while ago, Romain Bostic here alongside Scarlett Fu. We are counting it down to those closing bells with about 10 minutes to go. Volume and volatility on this triple witching Friday. Elevated S&P right now looking at volume roughly about 20% higher than the 20-day average.
Yeah, but in terms of price action for the S&P 500, it really hasn't done a whole lot, or at least moved within a large band. NVIDIA, on the other hand, extending its decline in the last 30 minutes or so, now off by 4.25%. And this is a two-day loss in which it's raised more than $200 billion in market cap. It's no longer the world's biggest company. It's fallen behind Microsoft and Apple yet again. Yeah, for those keeping track.
Oh my gosh. All right, this is going to ruin my weekend. All right, let's get right to it here as we continue to count you down to those closing bells now. With less than 9 minutes to go, Linda Dissel joining us, senior equity strategist over at Federated Hermes. And Linda, I think that today's triple witching is kind of a reminder that we are upon basically the end of the quarter, the end of the first half, and there have been a lot of questions about what the second half of this year is going to look like for equities, particularly in those sort of summer dog days where we tend to see volume go down and we tend to see interest in equities go down as well. What's your general expectation?
Well, thanks so much for having me again. And yes, as the second half approaches, we at Federated Hermes continue to have a 5,200 target on the S&P 500, and we're just around 5,500 now. Once we, and that used to be consensus, and once we reach that number, maybe a couple of months ago, a lot of people, a lot of Wall Street firms quickly lifted their expectation for the year to 5,500 or higher.
Right.
We're bullish on the market, and we're bullish to get to 6,000 sometime next year. But we have said that we really expect a summertime that has volatility, notwithstanding the volume today. Summertime trading is less trading, and it's as narrow of a narrow market. It's not a healthy thing right now. So we expect some pullback for the second half. We expect some fireworks with the election, maybe as it gets closer, and then finish the year strong.
So you think so? I'm just curious. Just going back to that 5,200 target, standing by that with the S&P at 55 or more or less, and of course, as you mentioned, a lot of the other strategists raising their outlook. Your general sense, though, is that we will see a resumption of this rally. It's just basically kind of a rally interrupted because of some of the things you talked about. Is that true?
Yes, that is true. We are bullish, but it's really difficult to figure out what you should guess the S&P is going to finish the year at when you have such a concentrated market. We saw what happened to Tesla. Nothing bad particularly probably going to happen to NVIDIA, but if it's going into a correction, that could quickly take some points off the S&P 500, and a bull can look at that and say, you know what, we bulls here are looking for broadening, and we still are, and you would too if you didn't think there was a recession anytime soon.
So, Linda, looking ahead to the second half, obviously with July comes earnings season, and the focus will be, as always, on whether companies meet or beat their estimates and the kinds of forecasts they give. But margin outlook is going to be critical here because we know that costs have been continuing to rise, albeit at a slower pace, and consumers are now holding off a little bit more on purchases, and that's going to trickle down to all kinds of things. What are you looking for in terms of actual cost management from these companies?
Well, that's exactly what we at Federated Hermes are looking at, and will be looking at and listening to on management calls is the margin outlook. The reason why the market's done so very, very well, one of the major reasons is that companies have been unbelievably strong in maintaining their margins, even as inflation has come down and they've not been able to push through higher revenues that takes you to the bottom line. So they will start to see the squeeze, more and more will. And so what we'll be watching is how can you save money? What could you do? You could lay people off is what you could do. And that's what we'll be watching for very closely. I saw kind of a very an unhappy statistic earlier this week that said new entrants to the job market are finding a very low job opening rate. They don't think the job market is strong at all. So this is something that we have to watch. And the labor hoarding might be done now. And then we may start to go the other way. That could really make a difference.
Yeah, the anecdotal certainly pushes back against the strong job data that we've been getting officially, at least from the government. When it comes to the inevitable talk of a rotation, of market breadth widening, and not just people chasing up the big cap tech names, but looking to some value names because they are cheap and their time has come. Where does the 10-year need to be for people to be convinced that a rotation can take hold?
Well, we've got 4 to 4.5% on the 10-year. It seems that the 10-year being there, markets are pretty happy, pretty benign within that range. That's where it very well likely may settle. And for some time to come. I acknowledge that the last 2.5 years, the market has been very, very closely correlated with whatever was happening in the 10-year government bond yield. And I think more and more people will come to agree that, inflation is not going back up again. The question is, how low can it go? Will it go below 3 and stay there? And indeed, inflation expectations 1, 3, and 5 year out say that it will go below. And the Fed watches that closely. It's hard to see how that really goes up when we think there may start to be some weakness in the job market, and when we really expect to see some of the rental numbers come through on the CPI with the lag that they always do.
All right, Linda Dissel there. Going to have to leave it there. Senior equity strategist over at Federated Hermes, helping us count down to these closing bells. And it's interesting, her last point there, Scarlett, particularly when it comes to rates and more importantly, benchmark rates, because everyone's been looking at that 10-year saying, look, when we start to get down closer to that 4% level, that could actually open up some possibilities for some of those mid-tier companies and smaller cap companies where the valuations do change more favorably if you do have a lower baseline there on benchmark rates.
The last time the 10-year was at 4% was back in early February of 2024.
Oh, right.
So it's been a while.
Okay,
And
that's not that far back. I thought you were going to say like back in the halcyon days of like 2022 or something. But I mean, look, we're getting there, right? I know this week kind of broke that trajectory. Yields are still up on a weekly basis here. But when you consider what happened the previous 2 weeks, maybe, and more importantly, you look at CFTC positioning and things like that, the position is still toward the downside for yields.
Yeah, absolutely.
Yeah.
The conviction is that the Fed will need to do something soon.
Yeah.
And it's going to happen in the second half, although there's a lot of pushback that the inflation data is not going to cooperate that much.
Stick with us. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic and Scarlett Fu here to take you through the closing bell. And that's our global simulcast. It begins right now with Carol Master and Tim Stinovic in our radio booth as we welcome our audiences across all of our Bloomberg platforms. And that includes, of course, our partnership with YouTube. Closing out the week here on a slightly different tone than where we started. Carol Master, though, some price distortions because of the options expiries happening today.
Also known as triple witching. I know you guys have been talking about it. We all have at Bloomberg. But yeah, that's a really good point. Having said that, in a week that was an interesting one, right? No trading on Wednesday because of the Juneteenth holiday. We had some records on the S&P 500 and the NASDAQ. But it's interesting to see kind of things settle down a little bit. But we are still looking for an up week on both the NASDAQ 100 and the S&P 500.
Interestingly enough, even though we're not seeing the S&P 500 move significantly today, volume is up 42% of its 20-day average, above that, as a result of that triple witching. So it's pretty incredible to see the increase in volume despite the fact that we're not seeing big moves on an index level.
Yeah, absolutely. You do have a ton of money moving through SPY, the ETF that tracks the S&P 500, $25 billion worth. But you know what's double that? The amount of volume in NVIDIA, 52 and counting, almost a $53 billion worth of shares changing hands.
Yeah, and it gets to a big question, though, too. I mean, everyone's so focused here on the options expiry, what people are exiting, but I am kind of curious to see what people enter into. Is this sort of people will just re-up new contracts in the same old stocks like NVIDIA? Do they rotate into something else that isn't NVIDIA, isn't AI?
Right, what comes out after this, right? Where do they go? That's an important thing.
And that's going to really set the tone, I think, for the next few months of the year. Let's walk you through the numbers here on this Friday afternoon. Again, take some of this price action with a grain of salt because of the triple witching, but you are seeing some green on the screen, particularly for the Dow Jones Industrial Average and the Russell 2000. The Dow up about 14 to 15 points. That's only a fraction of a percent here on the day, but some people will take it. The S&P lower by about 8 points or 1/10 of a percent. The NASDAQ down by a similar amount on a percentage basis, 0.2 of a percent to be precise there. But the Russell 2000 holding in the green, up about 0.2 of a percent. S&P 400 midcaps and Dow Transports also posting similar gains on the day, Carol.
All right, back to the S&P 500, Romain, I go, and you've got about 295 names actually gaining ground.
Can you name all 295?
If we had time, but would you guys really want me to do that right now? Probably not. All right, 204 to the downside and 4 unchanged. Scarlett, over to you.
All right, let's take a look at how the sectors fared on this fairly mixed day for the S&P 500 at least. Only one sector finishing up or down by more than 1%. That would be consumer discretionary, and that's largely on the strength of Etsy. Communication services gaining about 2/3 of 1%. Healthcare eking out a gain there. And on the flip side, NVIDIA, Broadcom, and Micron driving the tech sub-index lower by 0.75 of 1%. Energy and utilities also weaker.
Do people still use Etsy?
Some people do. I think it's good for birthday presents.
They are. Actually, you can find some really cool things.
NVIDIA's 2-day 6.7% slump erases $222 billion in market value.
What should we get? What should we get?
Don't worry. I'll put a list on your desk.
Okay, thanks.
Knitted socks?
Yes, sure.
Okay, we're on it. All right, let's get to, I can't name all of the gainers in the S&P 500, but here are some that were moving to the upside. I have to say, it was really kind of tough to come up with names. Tim giving me a little bit of an assist here. SPR, Spirit Aerosystems. This went up about 6%. You guys know the news. Rallying after there were reports, Reuters reporting Boeing is nearing a deal to buy back the company after substantial progress in separate talks over the work its former subsidiary undertakes for rival Airbus. Basically, Airbus and Boeing are kind of, dividing it up, if you will. And the programs that they do for each of them. But so Spirit, definitely an outperformer in today's session. A company with almost kind of a similar ticker, Sarepta Therapeutics, up 30% in today's session. Company's gene therapy receiving
For the week, the S&P 500 gained 0.61%, the NASDAQ was flat, and the Dow climbed 1.46%.
Still hasn't proved its benefit in clinical trials, but nonetheless, investors moving into this one in a big way. And then we have FactSet. FDS is the ticker. What?
I thought you were going to stick with the S's.
You thought I was going to do what?
Stick with the S's.
I know. I tried.
Looking for patterns here.
Alliteration a little bit. Yeah. FactSet, top of the S&P 500, $16 billion market cap, as I mentioned, up almost 4%. The company, it's a financial data and software company, boosting its adjusted earnings per share forecast for the full year. And Gilead Science, up for a second day in a row. It's up about 10% in the last 2 days. Remember the news yesterday that this company, experimental twice-yearly shot preventing 100% of HIV cases in women and adolescent girls in Africa. So this is a big